In London, and here are your top stories. Not there yet. Key Fed officials Lael Brainard and John Williams say high interest rates will be needed for some time to maintain the pressure on inflation. Military aid. The Biden administration announces a major new package of hardware for Ukraine ahead of a defense ministers' meeting in Germany today. Plus, the World Economic Forum in Davos comes to an end. We end the week on a high note with more top interviews, including the CEOs of Suntory and Fidelity International. Both those interviews this hour. Let's take a look at the futures then, looking a bit brighter than what we saw across the trading yesterday. 3 straight days of losses across Wall Street. Futures, though, pointing up. And you're seeing prospective gains as well in the European markets after pretty heavy losses yesterday. Of course, we're digesting the comments from Christine Lagarde when it comes to the ECB and the rate hike trajectory. JP Morgan's Kalanovic says that maybe recession risks are not yet fully priced into these markets, particularly the US market. Goldman Sachs, Bank of America, saying that the European equity market, which has been a record start to the year, it hasn't got much further to run. That is the view of Bank of America and Goldman Sachs. The FTSE 100 gaining 0.4% in the session today, adding 36 points. We'll wait for those other main indexes to open again. Christine Lagarde yesterday in Davos saying the case for higher rates for longer is still there. Again, pushing back on some reporting from Bloomberg that officials are looking potentially a step down to 25 basis points at the March meeting. The Spanish IBEX performing pretty well in the first few seconds, adding 49 points. Over in France, gains of 0.6%. Let's switch it over and bring you up to speed what's been happening across the Asian session, of course, as much of that region goes on Chinese Lunar New Year, the Lunar New Year holidays, of course, and mainland China closing in on a bull market before that holiday. The tech sector as well. Chinese companies, tech companies listed in Hong Kong performing very well today on the major index there, gaining 2.6%. So the optimism continues around the reopening story and the relaxation around some of those curbs related to technology. Jack Ma back in focus as well in Hong Kong. Futures in the US pointing to gains of 0.3%. The single currency, euro dollar, 108. Just range bound. Again, investors being a little bit whipsawed by what we've been hearing from the officials in reporting from Bloomberg earlier in the week, suggesting that maybe they need to step it down. But again, Villeroy and then Madame Lagarde yesterday, of course, pushing back on that narrative, suggesting further rate hikes are needed to get inflation under control across the Eurozone. Interesting in terms of the oil market as well, $86 a barrel, closing in to 87. That's a gain of 0.9%, and that is setting oil up for 2 straight weeks of gains. Yes, we have had concerns about a recession in the US with that weaker print in terms of data, particularly retail sales coming through this week. But the narrative around the China reopening seems to be central for these oil markets, and you are now setting yourself up for 2 straight weeks of gains, again, across the oil markets on bets that there will be more demand from China. So yes, the central banks remain in focus. Of course, we had those top officials, notably within the dovish camp, Lael Brainard, suggesting that yes, there need to be still higher rates to get inflation back under control. She didn't pin her hat, though, on 50 basis points or 25 basis points. Of course, it's worth recapping that the terminal rate, at least the dot plots, are pointing to a terminal rate of 5.1%. The markets are now looking at 4.9%. So there is still some divergence, marginal divergence at least, between where the markets see the terminal rate and where the dot plots are. And the commentary, of course, from one of the lead doves there, Lael Brainard, and the vice chair of the Fed. Talking of which, let's get some analysis on how all of this has been digested across these markets. 2 top Fed officials, as I mentioned, making the case for keeping interest rates at elevated levels to keep inflation in check. And one of those officials, Vice Chair Lael Brainard, says rates will need to stay up to further cool inflation. That is still too rapid.
as we move the policy rate closer to what we call a sufficiently restrictive level, taking into account the risks around both our employment and inflation goals. In parallel, the balance sheet is continuing to run off. That said, inflation remains high, and policy is going to need to remain sufficiently restrictive for some time to make sure it gets down to 2% on a sustained basis.
Okay, for more, very pleased to say I'm joined by Christine Aquino, Managing Editor for Bloomberg City Latest. Christine, talk to us about the skew in these markets when it comes to how they are positioning, or at least how they are interpreting the rhetoric from the Fed as we lead up to that end of January, early Feb meeting.
Well, John, we've seen quite the rally in both stocks and bonds this year, and I've seen declarations that 60-40 is back and things like that, right? And so I think there really is a lot of optimism in markets brought about by the fact that, or speculation at least, over the fact that the Fed could potentially slow down that pace of rate hikes this year, possibly even think about pivoting to rate cuts toward the end of the year. Lots of debate over that still, but I think the message that markets are receiving at the moment is that the Fed will eventually slow down. Now, whether that actually happens, still very much up in the air, as we've heard from various Fed officials this year. That is very much far from settled, what the Fed is going to be doing in terms of the pace of rate hikes.
And indeed, you hear from the likes of JP Morgan's Kalanovic, who, of course, for such a long time have been bullish on these equity markets, warning that the Fed is going to hold for longer. It will create a recession in the US, and that isn't being fully priced into earnings and across the markets. And that's the warning from Kalanovic, who says that the S&P could retest 3,500. When it comes to the ECB, again, this has been pretty interesting to watch this unfold over the week, given the exclusive that we had, naming officials, or at least quoting officials within ECB, suggesting there is a debate about stepping it down from 50 to 25. And then you had the pushback from Villeroy and then from Madame Lagarde yesterday.
Absolutely. And I think it's a very similar debate that's going on at the ECB as well, right? Is really what are they going to do about the pace, especially taking into account the recessionary risks that are swirling around the region. And, you know, we've heard a lot of pronouncements from European officials at Davos this week saying that they think the euro area is going to avoid a recession. We've heard specifically from the German Chancellor, Olaf Scholz, this week from that interview exclusive that we have. But it still remains to be seen whether that plays out. I mean, one of the advantages, of course, that Europe has at the moment is that receding fear over the energy crisis, given that we have an unseasonably warm winter. And so maybe potentially a recession could be avoided, but it's too far in the future to kind of see it for ECB officials, I think, and that's why we're having this debate. Ultimately, it really is, how do you balance still elevated inflation with building growth risks on the horizon?
And let's loop back to the comments from Lael Brainard then, because really interesting when you read the details of what she was saying around the labour market and suggesting that maybe you can engineer this soft landing and this environment where, in fact, the labour market doesn't have to break to get back towards that 2% target. How do you pull that in and tie that into the data that we've been seeing, whether it's retail sales, producer prices, or indeed on the earnings front, and get a clear assessment of what the trajectory is for the US economy?
Yeah, it's really interesting. I think, you know, I've seen a lot of commentary that the job market in the US is turning weird because we have seen, exactly, it's getting weird. Yeah, that's what the experts call it. But and it's true, you know, because it is, in a lot of ways, it is potentially going to be a jobful recession if we do, in fact, get there. But at the very least, it is still quite a tight labor market heading into a potential slowdown, as indicated by all these other economic indicators. And so I think that would be the ideal for the Fed, is having to the ability to engineer a bit of a slowdown, taking some heat out of the economy without ultimately breaking the labor market. But I think given just the inflation numbers that we've been seeing, I think depending on how sticky that gets, they may have to resort to causing some damage to the labor market if that still remains well above that target. And remember, their target is what, 2%, and it's still more than twice that at these levels, even if it has come down a long way. And so it really will depend on how sticky inflation gets and how much robustness we see in the labor market in the face of that, and what the Fed's going to do with all of that.
And that call from BlackRock and others that it's the move from 4% on inflation back down to 2% that is going to be the most challenging for the Fed. Christine Aquino, always excellent with the context. Thank you very much indeed for breaking down some of the key market drivers this morning, the action from the central banks, at least the rhetoric coming out from officials both at the ECB and the Fed. Coming up, we discuss the food and beverage sector in the high inflation environment. We're going to speak to Takeshi Ninamil, the Chief Executive Officer of Suntory Holdings. That is next. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, you know, there's 100 companies, Breakthrough Energy's funded.
By mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, you know, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, you know, now 4% of new cars are electric, you know, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges.
Britain's next
was going to keep rain World Cup. This is a 3
as the economic picture does.
Is it the OK is getting ready to make a decision?
This is Bloomberg.
Today, Bloomberg's Michael McKee speaks exclusively with outgoing Kansas City Fed President Esther George. What has she learned? Where does the Fed go from here? An exclusive interview with Kansas City Fed President Esther George. Today at 10 a.m. Only on Bloomberg TV and Radio.
Welcome back to the Open. We are 11 minutes into the European trading day. Some modest gains making up for some of the losses of yesterday across the benchmark, gains of 0.2%. A rally in mainland China and in Hong Kong, particularly within the tech sector. Futures in the US, the S&P E-minis pointing to gains of 0.3%, and some marginal selling of US treasuries, yields up between 1 and 2 basis points. Let's get back to what's happening at the Bloomberg Economic Forum, at least the World Economic Forum, of which Bloomberg is covering, of course, fantastically. We are live in Davos. Francine Lacquet is on the ground for us with another great interview, and the owners of a portfolio of wines, beers and spirits. Francine, good morning.
Good morning, Tom. I am absolutely delighted to be joined by Takeshi Ninamil, the Chief Executive Officer of Suntory. Thank you for joining us. I mean, I have many questions about the Bank of Japan, you know, Japanese wages, but let's maybe start with what you're seeing, the impact of a China reopening being on your business.
Definitely, we can create a further footprint in China, and we are excited because we are not dealing with the sensitive items at all. So we want to go into China furthermore. This is a great opportunity.
So you think the reopening of China, of course, is with great opportunities for you. How much more do you think sales will increase in China?
I think more than 20-30% we expect. But we started from a very small number because we got shrunk because of the COVID, obviously, but 20-30% easily. And consumer aspiration toward the premium products like ours, it's very high. So pent-up demand is coming up.
Do you have an idea of is it 10% increase? Could it be 20, or is it still up in the air because could it be a stop-start reopening from China?
Well, because they wanted to buy something like products from us, and they've been waiting, and we could not export pretty much. So because of the supply chain challenge.
Takeshi, talk to me a little bit about wage growth. So we saw another company, Fast Retailing, announcing a 40% wage increase for their staff. What does that mean for other companies in Japan? How much pressure is it on others?
I think well before, we announced to increase as much as 6% to people. Yep. The reason behind it is people are suffering because of bad inflation. And that means we need to support our employees. So I think the current general norm is to pressure big corporations to increase wages. I think that's going to be prevailing. So it's a good sign for Japanese economy.
So will you stick to the 6% increase, or do you need to go higher potentially because other companies are going much higher?
I think 6 is pretty much a good level. And how we can continue this trend to increase the wages, it's questionable because how to increase the productivity. So that is another issue we have to be worried about. But definitely, this is a great trend and a tipping point for the Japanese economy. People are, expecting to see the wage hikes, but except the small and medium-sized companies, and they are still struggling.
So is this because of wage increases? So small and medium-sized companies, I mean, this is what we've been waiting for, right? Higher inflation in Japan for a long, long time. How does it change the composition of the economy?
Well, first of all, there are two aspects as for inflation. Good side, it means a wage hike. The other side is people are suffering. But I guess the total norm is, I think, even SMEs will increase eventually. But we big corporations have to give the fair amount of, increase of price. So SMEs is still in question for the Japanese economy to be better. But I'm sure that will be happening among even the SMEs.
We talk about the Bank of Japan a lot. We've always talked about it a lot, but it's now really front page news, certainly in the last 5 to 6 weeks. Is it confusing what they're trying to do?
Yes, confusing, because if we take a look at the market, it's really, confused. But I think down the road, we need to exit, and we need the roadmap to avoid the negative surprise to the people and the corporates. But I think now is the right timing, because that entire landscape of our economy has changed. No peace dividends and the inflation, so we got to change the entire policy taken by BOJ and the government. But we are not ready, but we need a roadmap proposed by BOJ and the government.
Do you think it will be under this governor, Governor Kuroda, or will it be up to the new governor appointed in April?
New governor.
The new governor, and you're confident that actually it will be a framework that markets will understand and that you think will make more sense for your country?
Yeah, well, because people got to know already down the road, the interest rate will go up. For example, already mortgage rate is going up. Yeah. So people, general public, feel something will happen, like increasing of interest rates.
Does a new policy help at Suntory?
I think so, because we are moving toward the further premiumization. And plus, definitely wage hike should follow.
What's your biggest challenge in the next 12 months? I know we talk about supply chain shocks, we talk about shipping, we talk about demand being quite volatile. What are you most worried about?
Gas price. And the energy crisis is still going on. And China is participating in buying commodities again. We don't know about that. And that might offset the Chinese economic growth. That is helpful to the world. So we don't know how they will take action to buy more commodities, buy more oil, buy more gas. That might increase, gas prices.
So how can you protect yourself? Do you buy energy in advance or options in advance?
Well, we are moving toward the more premiumization to enjoy higher gross margins. So resilience for our business is so important. So always innovation. So we are putting more money to R&D.
There's a lot, of talk about people's tastes changing. I don't know whether they want sweeter or less sweet, if they're more conscious about their health. Have you seen any changes in the way people consume your products?
Definitely less sugar. And it's experience of COVID, but the people love sweet. So we need something very much sweet, but no sugar. So that should be natural. So R&D is needed, but we are ready almost.
And so this is what, through research and development? How much time does Suntory actually spend trying to, taste or look at the palate and how tastes change?
More than 5 years. We invested because, our country has been so much aging, and the diabetics and the chronic diseases have been so much issue. So we put huge resources to natural sweetener, such as stevia, but more sophisticated stevia, for example.
Yeah. You have such famous brands. What do you get asked the most? I mean, they recognize you, they recognize the brands. When you're here in Davos and corridors, or when you meet with business leaders, what do they ask you?
Yamazaki Hibiki. And my job is to apologize because it's in shortage. But that's true. We didn't produce because we could not forecast this much of sales in the world. But that's a
good problem to have.
Yes, definitely.
Yeah.
And yes.
Takeshi, thank you so much, as always, for your time. Takeshi Ninami, there, the Chief Executive Officer of Suntory. With that, Tom, I'm going to send it back to you in London. And, of course, we'll have plenty more interviews throughout the day.
Yeah, fantastic stuff, Fran. Thank you very much indeed. Speaking to the CEO of the company that owns Jim Beam Bourbon, amongst a whole portfolio, of course, of liquors, spirits, and soft drinks, on his concerns about the energy crisis going forward and the lack of clarity in terms of the BOJ's policy framework. Right, coming up, defence ministers of Western nations are meeting today to discuss military aid for Ukraine. We have the details next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open. Happy Friday. 23 minutes into your European trading day. You're seeing gains of 0.2% across the benchmark. A pretty decent session over in Spain. The IBEX up 92 points, a full percentage points. A warning note from the survey done by Bloomberg of forecasters suggesting that 452 is where the European benchmark is going to end up by the end of the year. It is 451 right now. Goldman Sachs, Bank of America also saying that the rally that we've seen year to date in European equities has probably run out of steam. Right, let's check in on some of the individual movers to bring to your attention. We've got a couple of stories in the earnings sector, but also the earnings space, but also a deal story as well. So some pretty decent earnings out of SSE, the energy utility company here in the UK, gaining 2% on the back of increased four-year earnings forecast. GSS is a potential deal, gaining 0.5%. It is Belgium's biggest insurer. Apparently, investor group BE Group making a fresh takeover attempt of that business that has a market value of about $9 billion US. Ericsson taking a big hit, down more than 8%, a bigger than expected drop in fourth quarter earnings, and warning that that will continue into the first quarter with pressure on margins for the telecom equipment maker. A couple of individual names that we are highlighting for you this morning. Let's get back to some of the geopolitics, though. The White House announcing that it is sending Ukraine a fresh $2.5 billion military aid package that includes over 100 armored vehicles. This comes just before defense ministers of Western nations meet in Germany to discuss weapons donations for Ukraine. It is a really, really important meeting for Ukraine and, of course, for those Western allies and whether or not they can hold the line in terms of unity. For more, let's get to Bloomberg's Oliver Crook on the ground in Berlin. Oliver, what are we expecting then?
Right, so Tom, we had this meeting today at the Ramstein Air Base outside of Frankfurt, and the big question here is, will the West step up its military support of Ukraine, and in what way? So the first answer is yes, as you've mentioned, $2.5 billion worth of equipment additionally going to Ukraine from the United States, some similar things from other NATO allies and non-NATO allies, but it doesn't answer the main question, which is, will the U.S. and Germany send battle tanks? This is the debate that has coalesced around the German Leopard 2 tank, and we spoke to Olaf Scholz about it earlier this week.
We always act together with our allies and friends. We are never going alone. We support the Ukraine as long as it is necessary with all the means we can use, but also always avoiding that this war is escalating to a war not between Russia, which is the imperialistic aggressor, and Ukraine, but to avoid that this is going to be a war between Russia and the North Atlantic Treaty Organization.
So Scholz there very sensitive about potential escalation and saying that he won't act alone. The U.S. would have to do something similar, like sending potentially their own Abrams tanks. However, overnight we've had some comments from the new defense minister here in Germany saying that these two decisions of Abrams and Leopard tanks are not necessarily connected and that the Leopards are on the table. So this is what we're going to be watching for at this meeting. Where is the appetite for getting more involved in this conflict, and where are the red lines?
Okay, Oliver Crook on the ground in Berlin ahead of that really, really important meeting between defense ministers in Germany. And the question, of course, around the Leopard tank, of which there are hundreds across Europe. And the question, of course, many Germany's allies, including Poland, have stockpiles of these and are prepared to send them to Ukraine, but need Berlin's approval. Coming up, we have an exclusive interview with Fidelity International CEO Anne Richards. Checking on your markets right now, the benchmark, European benchmark, is currently range-bound, so it's paired some of the earlier gains. It had been up about 0.2%. It's now flat. Futures in the US S&P even is just holding on to very modest gains of 0.1%. Stay with us. This is Bloomberg.
Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people?
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back to the Open. We are 30 minutes into the European trading day this Friday morning. Here are your top stories. Not there yet. Key Fed officials Lael Brainard and John Williams say high interest rates will be needed for some time to maintain the pressure on inflation. Military aid. The Biden administration announces a major new package of hardware for Ukraine as ahead of a defense ministers' meeting in Germany today. Plus, the World Economic Forum in Davos comes to an end. We close out the week on a high note with more top interviews, including the CEO of Fidelity International. That is coming up in just the next few minutes. Let's check in on these markets. There's been a bit of a turnaround in terms of the sentiment here in Europe, just gaining 0.1%. You'd seen a little bit more strength at the start of the session. The Spanish IBEX is still performing fairly well. And the last time I checked, the FTSE 100, here we go, still up 0.3%. The DAX adding 34 points. On the geopolitics, of course, we watch what is happening on the defense ministers meeting in Germany later today. And of course, we digest the comments from ECB's Madame Lagarde saying that there is a case still for higher rates to get inflation down, as, of course, economists debate whether or not the Eurozone can avoid recession. Also, a survey by Bloomberg of 19 forecasters, market forecasters, suggesting we may be seeing as good as it gets when it comes to European equities for the year. 452 is the average call by the end of the year. You're just at 451 right now on the benchmark. Let's have a look at how things are playing out across the sector. When it comes to oil and energy, that remains fairly uplifting. At least 2 straight weeks is what you could be looking at in terms of the gains across oil. Again, on the expectations that demand out of China is going to do more for that space than the risks around recession out of the US. Energy, as a result, is getting 0.7%. Banks also performing fairly well. Rates are up. There's a bit of sell-off across treasuries and sovereign debt. 0.7% in terms of the gain for banks. We're watching the earnings story as well, and that continues to come through. At the bottom of the list, autos and parts down 0.3%. That's a brief look at your sectors, 32 minutes into the trading day. Let's get back to what is happening, the action on the ground, of course, in Davos for the World Economic Forum. Francine Lacroix is there for us and comes to us with another really fantastic interview. Good morning, Francine.
Good morning again, Tom. Now we're joined by Anne Richards, Chief Executive Officer of Fidelity International. And as always, thank you so much for joining us.
A pleasure as always.
What's the mood like here in Davos?
Well, it's interesting. I think people came into this week, feeling maybe a bit gloomy. But the data points that have been coming through this year on the economic side have maybe not been quite as bad as people expected. And although I've seen some reports that say, the mood here is very optimistic, that this week. I don't think that's right, but I think definitely at the margin, people are thinking, well, maybe we're avoiding the really bad scenarios, the really deep recession risk. Maybe the risk of that's got a little bit less. So I think people are probably leaving a little bit more positive than they came in, and I think that's a good thing.
Are capital allocators asking the right questions about where capital needs to go next?
Now, I think that is a super interesting question, because I think when I look at the set of conversations I've had this week, and I've had conversations with at least 5 or 6 different regulators, I think there is a bit of a disconnect between the fear of systemic risk, the continued drive from a kind of macroprudential point of view to get as much risk out of the system as possible, against the fact that if we're going to continue to accelerate plans on decarbonisation, to get capital, to get into some of these projects and some of these initiatives so that we can really start to move on the decarbonisation agenda. Also Ukraine up there, there's going to be a rebuilding agenda on Ukraine coming through over the next few years. If we're going to get the capital for that, it needs to come from somewhere. And if you're constantly trying to squeeze the risk out of the financial system, no risk, no return. Yes. So I think there is a disconnect. And I think this week we've seen some of these conversations try to be initiated to bridge that gap, which I think is really constructive.
How do you square that circle?
Well, I think you need to think about what sort of risks. I mean, the question I've posed to more than one regulator this week is, what sort of risk are you willing to tolerate, and where do you want that risk to be? So, is it leverage? Is it liquidity risk? Is it volatility risk? Is it absolute risk of capital loss? What risk are you willing to tolerate? You can't take it all out of the system. How much and where? And think through that framework, because if we have a little bit more guidance on that framework, whether it applies to banks or insurance companies or asset management companies or anywhere else, think about where that risk should sit, and then we can start to figure out how we get the capital to the right places within that context. But I think we need to square that circle.
And you think we'll have answers pretty soon?
Yeah, you're talking about regulation, right? Nothing is ever pretty soon on that. But I think we can see a little, if we can see a little bit of a change in thinking and approach, I think the FSB and other regulatory umbrellas like that can help us think through where do we want that risk to be, and then we can start working on constructive suggestions.
What's your outlook for active investment managers in 2023?
I'm an active investment manager for the most part, therefore, of course, I'm positive about it. But I think it's been fascinating. I think you have, if you look at the C-suite in the companies that we follow, the many thousands of companies that we follow around the world, companies have had to deal with a lot over the last 3 years. They're very seasoned. They understand how to react quickly when they need to. That muscle is really well developed, and it's more, businesses are more resilient than they were, for sure. So what we can see is that, as the world chucks different things at us, I sometimes call it, we're in like this kind of multiverse, everything everywhere all at once. Stuff keeps happening, right? Companies are better at adapting, and we are seeing move to digitization, the move to automation, building, broadening supply chains. That's happening quite quickly. And for active managers, we can differentiate between the companies that really get it and are moving fast on some of this stuff versus some of the others. And that is a great environment for an active manager. So I think we're pretty positive. We do see stuff coming through now that we get quite excited about.
Do you have hiring plans, or will you get bigger?
So hiring is interesting, because I think everybody knows everywhere. Actually, the war for talent has been really tough. Some of the challenges have been actually, how do you hire people?
And finding the right person.
It's finding the right. We are increasingly tech businesses, and we're putting a lot of emphasis on that. Now, if you go back, I was speaking to the head of one IT services company yesterday. A year ago at this time, they were experiencing well over 30% attrition. By the end of the year, it was down to 20%. First quarter actually has started, it's like 11% annualized. And I think that's quite interesting. So I think the attrition environment has improved. That means you don't need to hire as many people because you're not replacing those that have gone. But I think it also shows you that this sort of spur towards automation, which when unemployment is as low as it is, you need that automation, that productivity improvement. So I think you see a changing shape in our industry, and that's kind of what we're saying. There's a little bit of a change in the jobs that we have, but the sort of broad picture is pretty steady state.
And how are you thinking about compensation? This is kind of a hot topic.
Yeah, well, it was obviously 2022 was a tougher year for compensation than the previous year, which was a terrific year for us. It was one of our best years ever. So it was tougher and this year, but our people, they understand that it's a kind of profit share kind of model, and in good times they do well, and in bad times or more difficult times, then they'll do a little bit less well. So, in general, I think our compensation round was well taken. So, but I mean, there is a bit, clearly in this environment, there's more pressure on compensation than in a really hot market.
Yeah, fair. And talk to me a little bit about crypto. So what does the FTX demise actually mean for crypto investments?
So if you look across, the conventional financial system, if you want to put it like that, there are certain key premises which are out there. Independent custodians or depositories, segregation of client assets, and some of these things it looks like just weren't adhered to in what was a relatively unregulated activity. So we certainly see more demand for, if you like, quality and separate custodianship, and I think that the good providers of that will continue to do well. And I think we will see some more of these principles that you see in other parts of the financial system come to the crypto world. So I think it's been a chastening experience. It shows that if you're doing similar sorts of activities, there's reasons for the regulations that we have in other parts of the world, and I think that's the approach regulators in general are taking, although there are different regulatory views on this, but similar activity should have similar types of regulation, and I think that will be the direction of travel over time.
Does it change your relationship with crypto and some of the offerings that you may have put in place?
Not really, because we've tended to adhere to those principles anyway, because that's what our business is built on. It's different for some of the startups in this space who've never sat inside a regulated entity and therefore don't know what those principles are quite as intuitively. So I don't think for us, I think we still see interest in, I wouldn't say crypto per se, I would say digital assets more generally, because they do bring certain different characteristics to it. The continued research that central banks are doing on around digital currencies, so more broader than just crypto. We tend not to talk about crypto, actually. We talk about digital assets. And I think we've talked about this in past years as well. It's the underlying technology, the distributed ledger technology, the tokenization of other assets that can come from that is possibly in the long run going to be the thing that the industry benefits from most from the invention of crypto, 10, 15 years ago, whatever it was.
And as always, thank you so much for your time with us. That was Anne Richards, Chief Executive Officer of Fidelity International. With that, Tom, I'm going to send it back to you in London, and we'll have plenty more interviews throughout the day.
Fantastic. Francine, thank you very much indeed. Francine Lacroix, of course, on the ground at the World Economic Forum for us. Now, coming up, Morgan Stanley's James Gorman says the global financial situation is not as bleak as it seems. A little bit of optimism there from the CEO of Morgan Stanley. We'll get more on his views coming up. The question of compensation for top banking executives. Stay with us. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Welcome back to the Open, 43 minutes into the European trading day, and it has been a choppy session so far. You're back up to 0.3% in terms of the gains on the European benchmark after having been flat about 10 minutes ago. The futures in the US are reflecting similar upside, about 0.3 on the S&P E-minis. Slightly stronger than expected producer prices out of Germany seem to be feeding into a modest sell-off in terms of sovereign bonds. German yields up about 3 basis points on the 10-year at 2.1. Italian yields higher as well. The 10-year at 3.83. That's a move higher by 6 basis points. So that is the picture. In the UK, the FTSE 100 up 0.5% retail sales for the month of December. If you strip out fuel, the worst and the biggest drop since records started in 1989. That is a drop of 6% for retail sales in the UK. If you strip out fuel, just really illustrating the consumer squeeze that we are seeing here in the UK. Now, time for some banking news, and JP Morgan has kept CEO Jamie Dimon's total compensation at a mere $34.5 million for his work in 2022. It was a year in which the firm's profit fell by almost a quarter, and the stock notched its worst annual performance in over a decade. Meanwhile, Morgan Stanley CEO James Gorman has told Bloomberg that the global financial situation is not as bleak as it seems. We spoke with him at the World Economic Forum in Davos.
There's clear evidence inflation has, in fact, peaked and is coming down, right? How quickly, whether the Fed will get us to 2% and when, remains the debate. But is clearly the slope of the line is positive, is to everybody's favor. And the second is not just the opening up of China, but China has embraced the rest of the world more aggressively in the last few weeks, witnessed by the Vice Premier meeting with Treasury Secretary Yellen this morning, I think it was this morning, in a way that we haven't seen for some time. So the big question coming out of the Party Congress and President Xi, being re-elected by the Congress, was where does China go from here? Does common prosperity mean effectively dividing the pie up so everybody gets a piece of it, or by growing the pie? And what we're seeing is the tilt is now from divide the pie to grow the pie.
Does that mean that you've got more confidence to expand in China?
We've got a very good business in Greater China. Obviously, we have a huge business in Hong Kong, and we continue to have, I think, on the mainland up to 1,000 people in various functions. But no, I think we need to see a little more clarity of Chinese policy, a little more, sober discussion around global trade relations, right now I think we're certainly in a watch, but tilting more positive than we would have been 3-6 months ago.
Okay, that was Morgan Stanley CEO James Gorman speaking with us in Davos. By the way, he vaulted ahead of JP Morgan's Jamie Dimon in terms of the pay on the pay front back in 2021. Let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Morning, Tom. French unions are calling for another national day of strikes on January the 31st, unless President Macron backs down from his plan to raise the minimum retirement age from 62 to 64. Railways, schools and the energy sector were all disrupted in yesterday's mass walkout. Unions say 2 million people took part in the marches, double the government's estimate. The US Treasury has begun using special measures to avoid a payment default after the federal debt limit was reached yesterday. It's altering investments in 2 government-run funds for retirees to allow scope for payments without increasing total debt. Speaking to Bloomberg in Davos, Democratic Senator Joe Manchin called for a bipartisan approach to avoid default.
Kevin McCarthy, it's a wonderful opportunity for him to say, listen, let's act like adults. We've got a debt. Whose fault? We're all at fault. How do we fix it together and move forward?
Peruvian police have fired tear gas outside Congress in Lima as protesters try to topple the fragile government of President Dina Boluarte. Authorities have also reported clashes with security forces outside the capital and more than 100 highway blockades. The nation is now in a 7th week of a political crisis that some are calling the takeover of Lima. UK opposition leader Keir Starmer has met executives and investors in Davos. Starmer, whose Labour Party is ahead in opinion polls, was introduced on a panel as the UK's likely next Prime Minister. Shadow Chancellor Rachel Reeves told Bloomberg the Labour Party is open to business.
Since the last general election in December 2019, we've had more than 20 tax rises from the Conservatives, and they've become a high tax party because they've become a low growth party, and because the money is not coming in through a growing and prosperous economy, they're having to resort to tax increases. I want to grow the economy so we can keep taxes as low as possible, whilst also having money to ensure that our schools and our hospitals are functioning properly.
Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins here in London. Thank you very much indeed. Now, cryptocurrency lender Genesis Global Capital has filed for bankruptcy. It is the latest firm to collapse in the aftermath of FTX's swift downfall. Bloomberg's Joanna Ossinger has the details. Joanna, good morning from London, good afternoon where you are in Singapore. This was foreseen, wasn't it? But is no less significant within the crypto space.
Exactly, Tom. We have known that Genesis and its parent company, Digital Currency Group, have been having a challenging time. And of course, this is just the latest in this string of trouble for the crypto industry. It does tell you also that even though Bitcoin is back above 20,000 from its lows around 15, 16,000, we're still not out of the woods in crypto overall. There still could be more things happening, and this is a pretty big one. So we'll see where the chips fall. We've already had Cameron Winklevoss from Gemini saying that they may sue Barry Silbert and Digital Currency Group. So, it may be a pretty interesting bankruptcy proceeding.
Yeah, the pretty public and nasty spat there between the Winklevoss streams at Gemini versus the team at Genesis. Joanna Ossinger in Singapore, thank you for bringing us the latest on the bankruptcy of Genesis and the potential implications then for the broader crypto industry. Right, coming up, it is Lunar New Year this weekend in China. How will a surge in holiday travel affect a country that has only just ended its COVID-0 policy? We will find out next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
DOJ or other authorities
Could face bigger challenges.
Britain's next
was going to keep rate World Cup. This is a 3.
as the economic picture down.
The BOK is getting ready to make a decision.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open. 53 minutes into the European trading day. Gains of 0.3% across your sectors. Energy leading up 1% at the bottom of the list. Food and beverage down 0.4%. On the energy front, it is looking like we're set up for 2 straight weeks of gains for oil on the back of expectations that there is going to be growing demand out of China, offsetting risks and concerns about a recession in the US. Let's take a look at some of the events we're following today then. At 10 a.m. UK time, ECB President Madame Lagarde is due to participate in a panel at the World Economic Forum. Then Philadelphia Fed President Patrick Harker discusses the economic outlook at a bankers forum. That's at 2 p.m. UK time, following, of course, comments from Vice Chair Lael Brainard that there is a need for further rate hikes. That's followed by US existing home sales data. And finally, at 6 p.m. UK time, the Fed's Chris Waller is going to be speaking at an event in New York. So a number of Fed speakers. Let's get back to the China story then. It is China's Lunar New Year. It's going to be this Sunday. Millions of people traveling back to their hometowns after restrictions, of course, were scrapped in a shock and surprise move back in December. The event is stoking fears of a rebound in COVID cases. To talk about the impact this will have on the world's second largest economy is Jinshan Hong, Bloomberg consumer and healthcare reporter. Jinshan, how does travel for the Chinese New Year then compare to last year's? What are we talking about in terms of numbers?
We have been closely following daily traffic in terms of people making their trips back to their hometown. So if we compare to last year, it's a very big improvement given China's sudden change of COVID policy. But however, when we compare to 2019 levels, this year is still only half of the pre-pandemic level. So we are seeing a lot more people making their trips, some of them maybe first time in 3 years to celebrate the traditional holiday with their family. So there's jubilation, but also worries that COVID could spread from urban areas into rural areas where hospital resources are more scarce.
Yeah, so jubilation mixed with trepidation then. What is the vulnerability of those rural populations?
We have seen COVID rip through like Beijing and Shanghai and other major cities in China, and a lot of them reported the COVID outbreak has peaked. But however, if we look at rural areas, some of them are still very new to this virus, and our reporting on the ground showed people even not very familiar with what's COVID after 3 years of the pandemic. So that shows the vulnerability where people could need to travel like hours to get to a nearest hospital. So that's like a very major issue that China is looking at right now.
And Jinshan, what have Chinese officials been saying about these risks?
President Xi Jinping has mentioned this rural outbreak as a concern in his speech, and in particular, like this kind of countryside outbreak, it's harder for outsiders to decipher because we don't have like travel or internet search data in those areas. So right now, according to London-based analytics firm Airfinity, they said COVID could hit 30,000 deaths a day in China during the Lunar New Year because of this massive migration.
Okay, excellent update. Thank you very much indeed, Jinshan Hong out of Hong Kong. Go and enjoy that Lunar New Year holiday. We appreciate the update. Checking on your markets, by the way, it was a decent session over in mainland China, closing in on a bull market, and tech stocks listed in Hong Kong performed very strongly as well, up 2.6%. Here in Europe, gains of 0.3%, a little bit more optimism. 56 minutes into the trading session, futures in the US pointing up by 0.2%. That is it for the European market open. Surveillance early edition is up next. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lackwell here live from Davos. Now, today we'll be wrapping up our coverage from the World Economic Forum 2023. On the show, we'll be hearing from the UAE Minister for Foreign Trade, Thani bin Hamed Al Zayouidi, as well as the Carlyle Group co-founder David Rubenstein. But first thing is first, before we get on to geopolitics, let's look at the markets today. Danny Berger is in London. Danny, what do you have?
Hi, Francine. Well, European stocks are trying to claw back from the large losses they posted yesterday. They declined some 1.5%. Where are we this morning? We're up 1/3%. So not a huge retrenchment. Still, some of those economic concerns weighing on this market. Speaking of economic concerns, the euro had been up by at least 0.2% earlier. It's come down slightly, but there's still those nerves in this market. We're at around an April high for the euro, with Lagarde saying that the inflation fight, it is not yet done. Of course, she's going to be speaking on a panel there where you are, Francine. The 10-year, that rally is taking a pause. Yields pushing higher by about 3 basis points. But we did start the week at 3.5%, so we have come in since there. NYMEX crude, that is also rising today, almost 1% there. It is headed for a second weekly advance. Now, NASDAQ futures, those are also strong today. I don't have them on the board for you, but we should have Netflix's opening price. Pre-market trading just began. That is up 6.4% thanks to two surprises. One, CEO Reed Hastings is out, but he is leaving on a high note, which accounts for the gains here. 7.66 million new subscribers. Francine, the estimate had been for 4.5 million.
Yeah, it's big news out there. I mean, you stand down as CEO and your share price is up 6%. You wouldn't be too pleased with that. Now, French unions, thank you, Danny. French unions are calling for further strike action later this month after more than 1 million people took to the streets on Thursday. Demonstrators are opposed to the French government's plan to raise the minimum retirement age from 62 to 64. Now, the strikes are the biggest wave of protests since Emmanuel Macron became president.
We can understand that there are some oppositions. We are a democracy, so we fully recognize the rights of everybody to oppose the reform. But we also strongly believe that this reform is a necessity for France. So we will stick to that reform, even if, of course, there will be a debate in the French Parliament, and in the framework of the debate within the French Parliament, there might be some improvements of the reform.
How much France is losing because of the strikes economically? How much are they costing?
I don't think that strikes do have a very important economic impact
on the economy, the French economy. The French economy is doing well. We have a pretty strong level of growth. We are creating jobs. We have a high level of investment. We have a very low inflation. So I'm deeply convinced that France is doing well and the French economy is doing well. And I really think that the strikes will not hurt the French economy.
Minister, do you think the US and Europe are aligned on how to treat and deal with China?
I think that there is a slight gap, I would say, and we are all aware of that. The US want to oppose China. We want to engage China. And I strongly believe that in the world game, China must be in. China cannot be out. Let's have a look at the reality. Everybody is speaking about the tensions, the oppositions between the US and China, and the determination of the US to decouple from China. Yes. But the reality is that the level of trade between China and the US has never been so high. So between the statements and the reality, there is a gap. And let's have a look at our own interest. Our own interest, if we want to be efficient and successful in the fight against climate change, is to have China on board. If we want to build prosperity and have more trade, our own interest for both the US and Europe is to have China on board. We want China to obey by the same rules.
The French finance minister there, Bruno Le Maire, speaking with me earlier today in Davos, I have to say, also ruffled some feathers, saying Brexit has been a historic mistake. Now, pressures abroad mean that either higher inflation in Switzerland or a strong Swiss franc. That's the view of the Swiss National Bank Governor, Thomas Jordan. Now, he told me that more tightening could come in order to meet the below 2% inflation target.
Well, I believe there are a couple of reasons. An important one is that energy has a lower weight in our CPI than in other countries. A second point is that we started at relatively low levels of inflation. And the third one, which is probably the most important one, is that we have a very strong Swiss franc. So the nominal appreciation of the Swiss franc helped us a lot. And we let the Swiss franc appreciate already in 21, so we could absorb some of this inflationary pressure coming from abroad.
But so how do you see the complex of inflation moving going forwards? We see I guess, baseline going down a bit, but core inflation creeping up to 2%. Could this be a problem for the future?
But this is exactly, I think, the key point. We have to be very careful. I am assuming that headline inflation will come down everywhere quickly, but we have to focus on the medium to long term, and that means also core inflation. In Switzerland, core inflation is at the moment roughly 2%. We aim at an inflation rate that is consistently below 2% in the medium to long term. Yes. So we do not exclude that we have to tighten monetary policy further.
President, you were one of the first ones actually to hike interest rates, and you've commented in the past that other big central banks should have maybe acted more quickly. Is that still your judgment today?
Well, I think in 21, both fiscal and monetary policy was extremely expansionary, and that pushed inflation down everywhere. We realized already in 21 that there is an increased inflationary pressure. That was the reason why we let the Swiss franc appreciate in nominal term, and that helped us quite a bit. So, and then we started to increase interest rates. Interest rates are still very low in Switzerland. We have only 1%. But as I said before, we do not exclude that we have to tighten further.
But are global central banks behind the curve?
Well, I think every country has to see exactly what is their situation. It's extremely important, in my view, that central banks really commit to price stability, that there is no doubt that central banks will bring inflation down back to 2%, and in our case, below 2%.
Do they need to get there quickly? I mean, you have a small open economy, so of course, if inflation is high somewhere, you get some kind of impact.
Yeah. Of course, inflation abroad is a factor that is very relevant for us. So we have to take that into account. When inflation is abroad very high, either we let the Swiss franc appreciate, or we have also inflation in Switzerland.
Well, that was the SNB Governor Thomas Jordan speaking to me earlier in Davos. Now, time for some banking news. And JP Morgan has kept the Chief Executive Officer, Jamie Dimon's total compensation at $35.5 million for his work in 2022. It was a year, of course, in which the firm's profit fell by almost a quarter, and the stock notched its worst annual performance in over a decade. Meanwhile, Morgan Stanley Chairman and Chief Executive Officer James Gorman says there are clear signs that inflation is peaking in the U.S. He also told us he has his eyes on China's next policy.
There's clear evidence inflation has, in fact, peaked and is coming down, right? How quickly, whether the Fed will get us to 2% and when, remains the debate. But is clearly the slope of the line is positive, is to everybody's favor. And the second is not just the opening up of China, but China has embraced the rest of the world more aggressively in the last few weeks, witnessed by the Vice Premier meeting with Treasury Secretary Yellen this morning, I think it was this morning, in a way that we haven't seen for some time. So the big question coming out of the Party Congress and President Xi, being re-elected by the Congress, was where does China go from here? Does common prosperity mean effectively dividing the pie up so everybody gets a piece of it, or by growing the pie? And what we're seeing is the tilt is now from divide the pie to grow the pie.
Does that mean you've got more confidence to expand in China?
We've got a very good business in Greater China. Obviously, we have a huge business in Hong Kong, and we continue to have, I think, on the mainland up to 1,000 people in various functions. But no, I think we need to see a little more clarity of Chinese policy, a little more sober discussion around global trade relations, right now I think we're certainly in a watch, but tilting more positive than we would have been 3-6 months ago.
Morgan Stanley Chief Executive Officer James Gorman speaking to Bloomberg's Lisa Abramovitz in Davos. Coming up, we'll speak with Thani bin Ahmed Al Zayoudi, the UAE's Minister of State for Foreign Trade. That interview is coming up next for the perspective from the Middle East. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded.
And by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
Economics, finance, politics. Good morning, everyone. I'm losing my voice because it's still so cold. We've had some great interviews, of course, and coverage throughout the week. I'm Francine Lacqua here in Davos. Now, Davos has helped edge investors in an optimistic direction. That's according to the Fidelity International Chief Executive Officer, Ann Richards. Now, we spoke to her earlier and asked her how the current mood is also impacting asset allocation.
I think there is a bit of a disconnect between
the fear of systemic risk, the continued drive from a kind of macroprudential point of view to get as much risk out of the system as possible, against the fact that if we're going to continue to accelerate plans on decarbonisation, to get capital, to get into some of these projects and some of these initiatives so that we can really start to move on the decarbonisation agenda. Also Ukraine up there, there's going to be a rebuilding agenda on Ukraine coming through over the next few years. If we're going to get the capital for that, it needs to come from somewhere. And if you're constantly trying to squeeze the risk out of the financial system, no risk, no return. Yes. So I think there is a disconnect. And I think this week we've seen some of these conversations try to be initiated to bridge that gap, which I think is really constructive.
How do you square that circle?
Well, I think you need to think about what sort of risks. I mean, the question I posed to more than one regulator this week is, what sort of risk are you willing to tolerate, and where do you want that risk to be? So, is it leverage? Is it liquidity risk? Is it volatility risk? Is it absolute risk of capital loss? What risk are you willing to tolerate? You can't take it all out of the system. How much and where? And think through that framework, because if we have a little bit more guidance on that framework, whether it applies to banks or insurance companies or asset management companies or anywhere else, think about where that risk should sit, and then we can start to figure out how we get the capital to the right places within that context. But I think we need to square that circle.
And you think we'll have answers pretty soon?
You're talking about regulation, right? Nothing is ever pretty soon on that. But I think we can see if we can see a little bit of a change in thinking and approach. I think the FSB and other regulatory umbrellas like that can help us think through where do we want that risk to be, and then we can start working on constructive suggestions.
What's your outlook for active investment managers in 2023?
I'm an active investment manager for the most part, therefore, of course, I'm positive about it. But I think it's been fascinating. I think you have, if you look at the C-suite in the companies that we follow, the many thousands of companies that we follow around the world, companies have had to deal with a lot over the last 3 years. They're very seasoned. They understand how to react quickly when they need to. That muscle is really well developed, and it's more, businesses are more resilient than they were, for sure. So what we can see is that, as the world chucks different things at us, I sometimes call it, we're in like this kind of multiverse, everything everywhere all at once. Stuff keeps happening, right? Companies are better at adapting, and we are seeing the move to digitization, the move to automation, building, broadening supply chains. That's happening quite quickly. And for active managers, we can differentiate between the companies that really get it and are moving fast on some of this stuff versus some of the others. And that is a great environment for an active manager. So I think we're pretty positive. We do see stuff coming through now that we get quite excited about.
Did you have hiring plans, or will you get bigger?
So hiring is interesting because I think everybody knows everywhere. Actually, the war for talent has been really tough. Some of the challenges have been actually, how do you hire people?
And finding the right person.
It's finding the right. We are increasingly tech businesses, and we're putting a lot of emphasis on that. Now, if you go back, I was speaking to the head of one IT services company yesterday. A year ago at this time, they were experiencing well over 30% attrition. By the end of the year, it was down to 20%. First quarter actually has started, it's like 11% annualized. And I think that's quite interesting. So I think the attrition environment has improved. That means you don't need to hire as many people because you're not replacing those that have gone. But I think it also shows you that this sort of spur towards automation, which when unemployment is as low as it is, you need that automation, that productivity improvement. So I think you see a changing shape in our industry, and that's kind of what we're saying.
Well, that was the Fidelity International Chief Executive Officer, Anne Richards. Now, we're also looking at live pictures that are of the Ramstein military air base in Germany. The U.S. Defense Secretary Lloyd Austin giving opening remarks ahead of a key meeting with NATO defense ministers. Now, the U.S. has announced it's sending fresh aid to Ukraine. That includes over 100 armored vehicles. Later on Bloomberg, we go to Berlin, where we speak to one of the most outspoken defense hawks in Chancellor Olaf Scholz's coalition. Now, it's the final day of the 2023 World Economic Forum. We're still bringing you all of the best interviews from the world's top leaders in industry and politics. This is where we focus, of course, on some of the great interviews that Manus Krani has been bringing, and, of course, perspective from the Middle East. Manus, over to you.
Francine, thank you so much. We brought in the UAE Minister of State for Foreign Investments. It is Thani Zoudi. Minister, thank you very much for joining us. There is this building consensus at this Davos that the worst is past, that we're going to have a very mild recession, and that we've passed the worst that we felt before Christmas. Would you agree with that? Just let's start there.
I'm very optimistic. Looking at the numbers in the last quarter of 2022, the prediction was much worse than what we achieved globally. And the expectation for this year is very pessimistic. But from the discussion, I'm very optimistic that we'll exceed all the numbers which has been predicted. And even when it comes to the recessions, I don't think there will be a major recessions globally. It's going to be very mild or even much.
Do we escape in the Emirates? Do we escape any downdraft? Are we immune?
We're very immune. We did very excellent last year, and we're going to do an excellent performance this year as well.
Your job is to bring home the free trade agreements. That's what you hear talking about. I understand there's 3-4 more free trade agreements to come. Let's break some news. Will you tell me who they are that'll come near term this year?
We're going to conclude with Cambodia next month, and we're going to conclude with Georgia the month after. So first quarter, we're going to have 2. We're almost done with Turkey. It's the last step, usually takes a bit longer. And we're kicking off with Ukraine this month. Hopefully, we're going to conclude before the mid of this year, and more to come.
What about the Philippines?
Philippines, we're in discussion. We initiated this discussion last year. The government election happened, slowed down, but reactivating the things now.
So look, this is the escalation of the policy you and I caught up with last year at a federal level when it was launched. That clutch of additional free trade agreements you just announced, how much more will that do for the economy?
This is going to boost at least 3.4 to 3.8% of our GDP by 2030. So this is another big boost to our GDP.
You've also you signed the FTA with India last year. There's a huge contingency here. Rupee dirham trade, I understand, is set to happen when, and what kind of commodities will you settle in rupee?
We're still in early stage discussion with India on this dirham rupees trade, and this is going to be focusing only on non-oil trade because of the other factors. It's at early stages. The minute that things are done between our central bank and the counterparts in India, things are going to move.
Is the infrastructure between the central banks there? Is it just a question of getting the last T's crossed and I's dotted? Is the infrastructure there?
Well, it's technicality. I will keep it to the financial people, but it's still at early stages.
I don't want to make the same mistake as I made with the Saudis. Can we just square it away that you're not going to trade? Are you going to trade oil in rupee? Is that something the UAE would or would not consider?
No, it's not under consideration.
Okay, that's squared away. Obviously, there's a huge contingency in Saudi Arabia from China. The Emirates were there. All the GCC leaders were there. How close are you to a China FTA? Was there significant progress made? Any constructive discussions?
The discussion is happening. The negotiation is happening on the GCC front. We're part of the negotiation. Things are progressing. It's taking, as usual, longer than the bilateral, which is the natural of the negotiation.
What do you want from China? What do you want that relationship to be?
Well, with Russia, China is our first trade partner, and for sure more is going to be good for consumers, for workers, for peoples, for businesses.
But do you want that to be tech? Do you want that to be manufacturing, Tani?
We wanted technology, we wanted industry, we wanted services, which we are very strong with, and we want it for our main industrial and export products.
The other dynamic that you and I touch on from time to time is tax. We have corporate tax going live in the UAE in the middle of the year. And the last time we chatted, you said, look, it's about a balance. I'm going to remove certain fees when I put this corporate tax in. We just had a massive alcohol tax reduced. What other business fees can you tell the audience today that you're really considering reducing?
Well, there will be an overlap for some time between the normal fees and the corporate tax until we know the basis and the foundation, and things will be left out. So it's going to be taking some time until things are going to be balanced. It's the first time we're applying it. It's going to take some time. The good thing about it that we're not going to apply the corporate tax on anything below $100,000, which just to make sure that SMEs are benefiting from the new ecosystem that we're encouraging and pushing for in the country.
Two things that the UAE are benefiting from. One are passports and that ability to get a passport while Europe closes those doors. How many passports did you issue to non-Emiratis last year? It's a big business.
Well, I don't have the number, Manos, on this, but we want people to feel home. So it's not only about the passport. It's the golden visa, which they feel that they're attached to the country and the whole ecosystem. There's no big differentiation between locals, residents, and the one who wants to live in the country. And that's why it's part of our welcoming signal to everyone. The UAE is a center to do your businesses and to grow from the UAE.
Let's just close off on the tax, because I come from Ireland, and they made hay with their corporate tax reduction. Taxes are rising in Europe and in the West. Here you are at 9% corporate tax. How important is it that that is continuity, that that's not going to ratchet continually upwards? Taxes rarely go down, Minister, as you know. What is the message on tax continuity? If I look at the EU at 22%, globally 23.5%, you're 9%. Message to the market on tax continuity.
We're always going to be an attractive hub and center destination to all businesses, as low as possible when it comes to taxes.
Danny, thank you very much, Minister for Foreign Trade from the UAE. My final interview here from the slopes of Davos. Lovely to be with you, Fran, on the first one. Fran.
Manis, thank you so much. Thani bin Ahmed Al Zawadi, the UAE Trade Minister there, Foreign Trade Minister. Now, we're also looking at live pictures of the Ramstein military airbase in Germany, where defense ministers of Western nations are meeting to discuss weapons donations to Ukraine. Now, just ahead, we get the view from Germany. I have to say we've gotten the view from Germany pretty explicitly over the last 4 days ago. First of all, here in Davos, we've had huge delegations. We spoke to the economy minister. He was very clear about what was needed in terms of military help. And then our editor-in-chief had a great conversation with the Chancellor, also Olaf Scholz. We'll be speaking to the Bundestag Defense Committee member, Markus Faber, one of the most outspoken defense hawks in the Chancellor Olaf Scholz coalition. But first, let's listen in to this press conference in Lunchtime.
And as the United States increases our support on multiple fronts, we're also prioritizing accountability with cooperation from the Ukrainian forces. And we're proud to stand together with our valued allies and partners to support Ukraine's self-defense. Poland has been a leader in providing armored vehicles, in training Ukrainian forces, and in providing shelter for Ukrainian refugees. Our German hosts have announced that they will also provide a Patriot air defense system for Ukraine, complementing our own Patriot contribution. Germany will also donate Marder infantry fighting vehicles for Ukraine. And last week, Canada announced that it would provide a NASAMS air defense system to Ukraine. Now, that's a major investment in Ukraine's ability to defend its skies. France also announced a significant donation of AMX-10 light tanks. And many European countries have announced their own training initiatives as a part of the EU's military assistance mission to Ukraine. These announcements, especially on air defense donations, are direct results of this contact group.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos, Switzerland. Now, you're looking at live pictures of the Ramstein military air base in Germany. This is where U.S. Defense Secretary Lloyd Austin is giving opening remarks ahead of a key meeting with NATO defense ministers. Now, the U.S. and German defense ministers are discussing tanks for Ukraine amid differences. It is actually the first time that the U.S. Defense Secretary meets the newly appointed Germany Defense Minister Boris Pistorius. So we'll see how that goes. Now, in an exclusive interview with Bloomberg this week, the German Chancellor Olaf Scholz reaffirmed his support for Ukraine.
We always act together with our allies and friends. We are never going alone. We support the Ukraine as long as it is necessary with all the means we can use, but also always avoiding that this war is escalating to a war not between Russia, which is the imperialistic aggressor, and Ukraine, but to avoid that this is going to be a war between Russia and the North Atlantic Treaty Organization.
The German Chancellor Olaf Scholz speaking to Bloomberg's editor-in-chief John Micklethwaite in an exclusive interview earlier this week. We also spoke to the economy minister, of course, of Germany. And then on the other side, we spoke to the Polish prime minister saying, look, he has the tanks available, but he's just waiting on the stamp of approval from Germany. So for more on all of this, let's bring in Oliver Crook in Berlin, who's joined by someone who definitely knows a little thing about defense. Ollie.
That's right, Francine. Thank you very much. We're joined by Marcus Faber. He is an FDP lawmaker. He sits on the Bundestag Defense Committee. He just got back from Ukraine a week ago. Welcome. Thanks for joining us this morning. Let's begin with the topic that everyone is talking about today, and that's the Ramstein Air Base. Tanks. Will Germany send tanks? You stand notably, you're part of the government, you stand notably in opposition to their stance on not sending the tanks. Why is Olaf Scholz wrong?
There's a debate in the coalition whether to send battle tanks or not. I've been in Ukraine for 9 days, and there was not one discussion where Leopard 2 was not mentioned. So I think our chancellor says we should not go alone, but when everybody is going in Europe, Polish are going, Finland is going, Great Britain and France, we should also be not left alone in Germany. So I think we should do what our partners are doing, and we should also deliver battle tanks to Ukraine.
Do you think we'll have meaningful movement on this today in the discussions that are going on right now? Do you think that Germany will approve either sending the tanks themselves or give permission for other nations that hold those tanks to be sent to Ukraine?
Yes, I do think so. Yesterday was the first day of work for our new defense minister, Boris Pistorius. So he has a lot of questions, and I think those questions can be answered today. And I think with some convenience and some discussion between our partners, he will be convinced, and we can also give the permission to other countries to deliver Leopard 2, but we can also deliver ourselves to help Ukraine against the Russian aggression.
Marcus Faber, good morning from Davos. We had great conversations here also on the ground with the finance minister, with the economy minister, and they were very cautious about actually going ahead with this plan. What do you think is holding them back?
I think what's holding them back is the current discussion. I think the aim of Germany is to go allied with its partners in the NATO, with its partners in the European Union. So we did a lot of military support, we did a lot of financial support, and we will continue this. So we have laid the groundwork for this in our budget for 2023.
Yeah. But there must be an underlying reason why they're so reluctant. We also spoke to the Polish Prime Minister, and he says, look, it's maybe because of the history of the country. Why do you think, for the moment, ahead of the discussions, we almost had, a very cautious stance, if not a no, from the German government?
Germany is a very pacifist country, obviously because of our history. And I think the idea to defend democracy with military issues is very new to Germany, and that is something that the USA, Great Britain and France are much more used to. So there's a learning process in Germany, and it has not come to an end yet.
Do you worry that there is so much high-tech, high-powered artillery, tanks, weapons of the highest grade being sent to Ukraine, and once we have peace, we don't know what to do with all of these materials, that it could go in the wrong hands? Should we start thinking about that now?
The Ukrainians have been very, very responsible with all the armament, all the military aid we gave them. And I think something has to be clear. A small Soviet army cannot beat a big Soviet army. So the only way for Ukraine is to have modern Western weaponry to actually fight off the invasion and to defend their own country. This is the only way to solve this issue and to prevent Putin from also invading other countries.
And are you concerned at all about one of the things that Olaf Scholz has pointed out, and I think everybody's very conscious of, is over-escalating the conflict? It's very difficult to anticipate how Putin views these things and where the red lines are there. If not tanks, where is the sort of red line for Western support of Ukraine, do you think?
So what's the over-escalating? I've stand next to mass graves in the city of Liman. I've been in the torture prison in the city of Kherson last week. So what kind of escalation when it comes to war crimes is there? I think it's not escalation we see from the Ukrainian side. It's a Russian invasion. And we are helping the Ukrainians to fight the invasion off. So I think Ukraine is not invading. They have been very responsible also to just use the weaponry we give them on their own soil, I think, which is very hard for them. So I think by what they did right now, they have really earned more support by Germany and other countries as well.
Yeah, but Mr. Faber, we do hear, especially here on the ground, from politicians and also, very prominent thinkers of world history, that they don't want to do anything that could aggravate Vladimir Putin at this point. So we can, yes, the Russian army, make sure that Ukraine wins without aggravating him. When Putin says that he's ready to use nuclear arm, do you believe him?
The Russian military doctrine is very clear on that. Russia is supposed to use nuclear arms when the existence of Russia is scared. This is not the case. The Ukrainians will not be in front of Moscow tomorrow, whatever we do. They are trying to fight off the invasion troops from their own soil. And when they have finished this job, they will be very happy to go to peace again, because the Ukrainians are paying the highest prices. I've talked to soldiers that had been in combat. I have talked to soldiers that had left legs, and everything they want is peace, but not peace under all circumstances, but peace in freedom and peace in justice, and that's what they are fighting for. And I think they have the most interest to have it as soon as possible, as soon as the invasion troops go home.
And Poland says that they are considering sending tanks without these Leopard tanks without the permission of Germany. First, what do you think about that? And do you think that there's a risk of sort of unity in the West kind of falling a little bit apart or being fractured?
There are contracts between the partners in Europe. So all the countries that gained Leopard 2 from Germany signed that they will just export them when there's a license and export permit from Germany as well. So I guess the Polish will stick to it, and even more important is that Germany gives them those export permit.
Great. Well, Thank you so much, Marcus Faber. He's the Bundestag Defense Committee member and a lawmaker for the FDP. Fran?
Yeah, a great conversation there, of course, on where we go forward. For the moment, we don't see much consensus. So we'll have plenty more, of course, from Davos and beyond, as we also follow what's going on over in Germany, where we're expecting negotiations on sending tanks. We spoke to the economy minister of Ukraine. We spoke to the Polish prime minister. We also spoke to the Polish economy minister. And, of course, all of their focus, especially when you look at Poland, and the fact that they're a front-line country, the fact that there are more than 8 million refugees from Ukraine crossing into Poland, with 2 million of them actually settling, means that this is something that we not only need to talk about, but also find not only maybe a defense, way forward, but also we need to talk about rebuilding and the economy and extra support in terms of financing. Now, coming up, don't miss our interview with David Rubenstein, co-founder and co-chairman of the Carlyle Group. That's next, and this is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Ahead of Lunar New Year on Sunday, China's COVID czar says infection levels have dropped to a relatively low level. Outgoing Vice Premier Sun Chulen said China's doing a good job as it moves to a new stage in the pandemic. Chulen previously spearheaded Beijing's hardline approach to the virus. Now, Netflix co-founder Reed Hastings is stepping down as CEO after more than 20 years. Greg Peters, previously the chief operating officer, will join Ted Sarandos as co-CEO of the streaming giant. Shares jumped after hours as Netflix reported almost 7.7 million subscribers in the last quarter, well ahead of estimates. Netflix is also forecasting improvements to its profit margin and free cash flow in the coming year. Now, French unions are calling for another national day of strikes on January the 31st, unless President Emmanuel Macron backs down from has planned to raise the minimum retirement age from 62 to 64. Railways, schools and the energy sector were all disrupted in yesterday's mass walkout. Unions say 2 million people took part in marches, double the government's estimates. The Netherlands and Japan are close to joining a Biden administration-led effort to restrict exports of chip technology to China. Sources tell Bloomberg that Dutch and Japanese export controls may be agreed to and finalized by the end of January. The two countries are home to key suppliers of semiconductor manufacturing equipment. The EU has fined Meta's WhatsApp 5.5 million euros and given the companies a 6-month ultimatum to bring its data processing in line with EU law. The privacy watchdog says WhatsApp violated data protection rules by forcing users to opt in to data processing without clarifying what the information would actually be used for. Meta, Facebook and Instagram were all fined earlier this month. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, it has been an interesting Davos. For as much as a lot of people came, the UK delegation was not that present, especially if you look at different years. The Prime Minister, Rishi Sunak, did not come. His Chancellor did not come. However, the opposition came. They were very visible. They were at all the parties. They were on a lot of panels. And we caught up with the Shadow Chancellor, Rachel Reeves, and I asked her simply what she wanted to achieve in Davos.
The only way to resolve these industrial disputes is to get round the table with the people who work in that sector and the trade unions that represent them. We heard from the head of the Royal College of Nursing before Christmas that she was willing to call off the strikes if only Rishi Sunak would get in a room with her and have a meeting and discussion. The RCN and others have said they are willing to negotiate on pay, but to negotiate, you need a partner to negotiate with. And we're now in a situation where the railways, the nurses, the ambulances, the teachers, industry after industry taking industrial action at a time when our economy desperately needs our public services to be functioning properly, and when our public services are not just on their knees, but in some cases flat on their face. And the government have got to take that responsibility and negotiate. Now, look, I'm not going to just pick numbers out of the air. That's not what we would do in government, and we won't do that in opposition either. But if we were in government today, we'd be round that table resolving this dispute. That's what Labour did when we were last in government, which is why we didn't see industrial action on anything like this scale.
Inflation was, not as high as now, so it's a little bit of a different kind of environment. Are you worried that this will just last on unless they get fair wages or higher wages, even if it's not what they ask, at least much higher than they have now?
Anyone in business knows that disputes are only resolved through negotiation and discussion, and also a building back of trust. And that trust between the government and so many public sector workers has been undermined by the way they've been treated. A couple of years ago, we were all in Britain standing on our doorsteps clapping the nurses, and the government just this week introduced into Parliament legislation that will make it easier to sack nurses if they take industrial action. That is no way to treat key public sector workers. Labour wouldn't be doing that. And the risk is that that sort of legislation to make it easier to sack public sector workers is only going to make these disputes worse. It's not going to resolve the problem.
Well, that was Rachel Reeves, the UK Labour Party Shadow Chancellor of the Exchequer. Now, the one thing I did ask about the strikes, we did also talk about why she was in Davos. She wanted to talk about to the business community. So let's get the view from the UK and what he's been following, who he's been chasing. He's the one and only Phil Aldrich. Phil, thank you so much for joining me. We also did a podcast at the beginning of the week saying what Labour's messaging here would probably be. What have you been most surprised by?
Well, they've had a pretty positive reception from the business community, because obviously Jeremy Corbyn really set back Labour among corporates and executives, and so there's been as one leading banker put it, they've been happily surprised. They're surprised on the upside by briefing. Well, they had breakfast and they had private meetings. So there's been a lot of business people who've been meeting Keir Starmer and Rachel Reeves, and so it's worked. They've built some relations here with this community.
Phil, I mean, it's very clear that the Labour Party, the New Labour, basically Tony Blair won because he had the business community on side. Are they going to be the final decisive, factor, given the kind of upheaval we saw in the UK economy?
Yeah, I mean, the point about getting the business community on side is not that their votes necessarily matter, but it's the endorsement of the business community provides the sort of security of among the general public that this is a government that means business, and that this is a government that can be trusted, and so that's the vital sort of element that they're trying to win over. I mean, they haven't just come to Davos out of the blue. They've been doing this for over a year. They've been having meetings and lunch meetings, and they've eating a lot of sandwiches, drinking a lot of coffee, and getting to know these people. And they're saying, familiarity is what is going to help the Labour Party, because obviously there are lingering concerns. As Grant Shapps, the business secretary, said, Keir Starmer was part of the cabinet under Jeremy Corbyn. So how has he changed? Does the leopard change its spots? It's that kind of issue. So the familiarity, the more they get to know them, the business leaders are feeling more and more comfortable with Reeves and Starmer.
Phil, thank you so much. Phil Aldrich there, braving the wind, braving the corridors to really chase a lot of the UK delegation down and trying to get some comments from them. Coming up, don't miss our interview with David Rubenstein, co-founder and co-chairman of the Carlyle Group. That's coming up next, and this is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded.
And by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come on. So that's the package that you're talking about, mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
The moment news breaks, no one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
Our WEF 2023 coverage from Davos continues this hour. Joining us now is David Rubenstein. He's co-founder of the Carlyle Group. David, thank you so much.
My pleasure.
A Davos veteran. What's it like for private equities in 2023?
Well, private equity people do come to Davos. We've been coming for quite some time, and you see a lot of your investors here and a lot of other people that you want to do business with. So it's very productive, I think, to be here.
Well, how is the allocation of capital changing, given interest rates are rising, but also the world economy and geopolitics is changing everything?
Well, first thing you should know, or I like to remind people, is when the economy is a little bit tricky, sometimes that's the best time to invest. You don't really want to invest when the economy is doing well and everybody's saying how great it is. So there's some challenges in the economy, but it's actually a good time to invest. The prices are going to be lower. We have a fair amount of capital to deploy in the private equity world. Debt is more challenging to get, but a lot of deals in private equity don't require that much debt compared to what it was many years ago. It used to be you borrowed 90% of the purchase price. Now it's much less.
Valuations are still quite high with some of the companies that actually private equities but also venture capitalists hold. When do they come to a more realistic perspective?
You always have this problem when you have a potential recession coming, because people who are sellers want to kind of sell out before the recession comes. The buyers are afraid that they're going to be buying into a recession price. So you have a gap of maybe 10 or 15%. So it does take a while to get deals done, and there are fewer deals getting done last year than we would have liked. This year, I suspect they'll be better.
So what does it mean for financing and lending actually in your space? Do you need to become bigger to weather the storm?
Well, obviously, there's some big firms, and they are doing pretty well, but there's plenty of room for small firms. There are about 20,000 different private equity firms in the world of all different types. So I'd say the private equity industry has done quite well. We've done much better in giving the returns that people wanted than people thought we would in this environment. I think the industry's in pretty good shape.
What industries are you most interested in at the moment?
Well, let me mention one, healthcare. When I worked in the White House, probably before you were born, but it was in
You're too kind. It's a lie.
1977 and 1981 for President Carter, the GDP of the United States in healthcare was 7%. Now it's about 22%. And why is that? Well, people are living longer. They want to spend more money to live even longer. People have all kinds of access to better health care. I mean, not everybody does, but if you have the ability to afford better health care, people want it. And so health care expenditures are going way up. And also people are living much longer, and that generally requires more health care expenditures.
But how do you play that? So is it biotech? Is it the AI, for example, that folds the protein so you find the drug that you need quicker?
Well, obviously, the biotech is one thing. That takes a long time usually for things. But I think one of the things we learned during COVID is telemedicine is actually pretty attractive to people. You don't have to go to a doctor, and a doctor can actually analyze your charts and so forth and give a diagnosis over the telephone or over the Zoom, and that's really taken off a fair bit. Also, around the world, as the world is getting wealthier in certain parts of the world, people there are saying, well, I want to live longer too, and so they want better access to medical treatment. So when people get wealthier, what do they want? They want better food, they want a better, longer life, more health care, and obviously all this for their children as well. And as the world is getting, in some parts of the world, wealthier, you see more health care expenditures going up.
David, thank you so much for joining us. David Rubenstein there with his latest thoughts, of course, on the private equity. He's a co-founder of the Carlyle Group, and we'll have plenty more from David throughout the day. I'm a big fan of your show, David. So
thank you very much. It's
keep
on a
it
very
going.
good network.
It is on a great network. Coming up, Mike McKee speaks exclusively to the outgoing Kansas City Federal Reserve President, Esther George. Don't miss that. That's it for us from Davos 2023. We've had some great interviews. We've spoken to prime ministers. I think three main themes. Inflation, what does that mean for the allocation of capital? Why we have not seen more zombie companies given the trajectory of interest rates rising so quickly. And of course, then geopolitics at the forefront with Prime Minister Morawiecki of Poland asking really the U.S. and allies to send more tanks to Ukraine. This is Bloomberg.
somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful on society?
Well, I think the first thing you've got to believe in something that you really care about. You know, I've been fortunate that over the course of my career, I've come up with things that have mattered to me, and I've pursued them. You know, the best advice I ever got was from Mike Bloomberg. And he said to me at one point, he said, show me somebody who's never lost, and I'll show you a loser. And I believe that if you believe in something, go after it, take risk. Obviously, they should be smart risks, but they should be around things that you really care about.
So you would see your legacy as being actually target ALS and helping to moderate the impact of ALS, if not curing it.
That's my final legacy. I'm proud of some of the other stuff that I've done as well. Transformation of New York after 9/11. I'm also incredibly proud of a lot of the companies we created at Sidewalk, but I feel like I've done a lot.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate while
This is a 3
as the economic picture does.
The OK is getting ready to make a decision.
Inflation, by all accounts, however you look at it, is way too high.
Although we're seeing some signs that inflation is moderating, it remains far too high, and it is my #1 concern going into 2023.
Policy is going to need to remain sufficiently restrictive for some time to make sure it gets down to 2% on a sustained basis.
There's clear evidence inflation has in fact peaked and is coming down, right? How quickly, whether the Fed will get us to 2% and when, remains the debate.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Making the case for high interest rates, 2 top Fed officials argue that it's too soon to back off in the fight against inflation. Another crypto casualty following the collapse of FTX. Crypto lender Genesis files for bankruptcy protection. And Netflix CEO Reed Hastings steps aside after more than 2 decades. The news comes as the streaming giant reveals it's added a better than expected 7.7 million subscribers. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Well, we made it to Friday, Kaylee. It seems quite a bit of optimism on the slopes of Davos this week in terms of the narrative being told there. But some of the US data and the need for higher interest rates, that conversation carrying on, taking the edge off the gains that we can make this week.
Absolutely, Anna. You still have Fed officials talking about the need for more restrictive policy at the same time that in certain pockets of the economic data, you're seeing a real deterioration, like in retail sales and industrial production this week, even though the labor market is still immensely strong with initial jobless claims at just 190,000 yesterday. So that's definitely a puzzle this market has to contend with. But as you said, we finally made it to Friday, and it was a positive end to the week in Asia overnight. The MSCI Asia Pacific Index rising by about 0.5%. Really, that was a move led by Hong Kong and specifically the technology sector there. The Hang Seng Tech Index up about 2.7%. That may be just some buying ahead of the Lunar New Year holiday break, which will be taking place next week. The other noteworthy story out of Asia, though, was Japan. Inflation rising to 4% 5%, the highest since 1981. So we're talking more than 4 decades. That may fuel speculation about the policy pivot from the BOJ, but you didn't necessarily see that showing up in Japanese assets overnight because you actually had a drop of about 5.5 basis points on the 10-year JGB yield, which now sits at about 38 basis points. Remember, the cap is 0.5%, and the yen weakening against the U.S. dollar by about 0.8% today. Dollar yen trading at 129.58, Matt.
All right, well, we don't see a lot going on in terms of U.S. futures. In fact, they're pretty much unchanged right now at 39.15. In the cash trade, we dropped down yesterday again to now below 3,900. So we're at 38.98 on the cash trade as we continue to see declines in stocks. Now, at least we had a turnaround in yields. You know, yields had been declining as investors were buying bonds. Now they're selling bonds and the yields are floating back up. 342.56 is a level on the 10-year. And we also have a gain again in crude after it had fallen down below $80. Now West Texas Intermediate is trading back above that at $80.78. And then finally, I think Bitcoin is interesting. Little changed at $21,000, but even after the bankruptcy of Genesis, you don't see Bitcoin being punished, although we don't know the full fallout of that bankruptcy filing. We're going to continue to talk about that today. Anna, what do you see in Europe?
Yeah, more details on that shortly then. Matt, here in Europe, we see a little bit of green on the screens, actually, but it is quite modest. So we're up by less than 0.5% in most of these European markets, trying to turn around yesterday's weakness. We had quite substantial weakness in Europe yesterday, down by more than 1% on many of the major markets, in keeping with the US trend, really, but trying to turn that around a little bit in the face of the flat futures picture in the US. Maybe that is something of a challenge. Goldman Sachs and Bank of America both talking about the extent to which we maybe have seen the best of that European outperformance that we've talked about a lot so far this year. That's been one of the stories year to date this January. Here are some interesting stories that are on my radar this morning. Ericsson, certainly one of those. The stock down by just over 6%. The telecom equipment manufacturer weighing on other names in the sector after its numbers came in lower than expected. And actually, they supply 5G operators, of course. And it seems that those 5G operators not willing to spend as much as had been anticipated. Fears about the global economy starting to hit in terms of that capex. Here's the pound at 123.41, down 0.4%. Actually, this is the best performing developed market currency against the US dollar so far this week. That's been the story up to now, but that meant the retail sales data, which came in much weaker than had been expected for the UK economy, the market was kind of poised to fall, I suppose, on that weak data, so down 0.4%. And here we've got the Italian yield and the German yield. I picked the Italian 10-year, the German 30-year, but really there's a story across European bond markets at the moment. Matt, to your point about what you're seeing in the US, we're certainly seeing that here in Europe with the selling of bonds and those yields going higher. And this has been something we've been tracking for the last few days as we've seen pushback against the idea that we'll step down in interest rate hikes at the ECB.
All right, let's talk about interest rates at the Federal Reserve right now, because two top officials came out yesterday, Lyle Brainerd and John Williams. They're making the case for high rates to keep pressuring inflation for some time. Brainerd says interest rates will need to stay elevated.
Inflation has declined in recent months, but inflation is very high, and it's going to take time and resolve to get it back to 2%. Financial conditions have tightened considerably over the past year as the Federal Reserve and central banks around the world have tightened policy considerably.
Bloomberg Markets reporter Valerie Teitel joins us now. And Valerie, these are two very important voting members of the Fed, Williams and Brainerd. Did they change the calculus, the market calculus for the terminal rate at all?
Look, Matt, they really didn't, but I want to mention a few things that Brainerd did speak about. She raised a lot of questions and skepticism around this idea of a wage price spiral, claiming that it remains possible to have a reduction in inflation without a significant loss of employment. And these specific wage-driven sectors, this core services ex-housing, maybe those are just reflecting pandemic one-offs and they're not solely because of the tight labor market. Now, that is a very dovish tilt we've heard from Brainerd, but the market didn't really react. We're still pricing in below what the Fed believes is the terminal rate at 4.9%. But look, Matt, you can argue the market didn't react because the market is pricing for a dovish tilt. We now have 100 basis points worth of cuts priced from now until February of next year.
Okay, so that is kind of on the monetary policy side. Let's talk about fiscal questions and the battle going on Capitol Hill right now over the debt ceiling, Valerie. The Treasury is going to run out of cash later this year. Already, Janet Yellen is using those extraordinary measures. She informed Congress about that yesterday. Is this yet a concern for the market?
Look, Kaylee, those special measures have been used over a dozen times since 1985. And Francine Lacqua asked one of our guests at Davos the same question, the Algebra CEO, and he answered no. It's political posturing and it's the last of our problems. It's a non-event. I think most of us in markets for now agree with him.
All right, Valerie, thanks so much for joining us. Valerie Teitel talking to us about the Fed. Let's get to the fallout, really the fallout from, I guess, Terra Luna, Three Arrows, FTX. Now Genesis has become the latest crypto firm to collapse in the wake of all of those things. The crypto broker, once at the heart of Barry Silbert's digital currency group, DCG, has filed for bankruptcy here in New York. Bloomberg senior crypto editor Anna Herrera joins us now to tell us, Anna, what we've learned so far. You know, we're getting answers to questions we've been asking for weeks and weeks.
Yeah, so we're learning who some of their creditors are. We know they have the top 50 unsecured claims amount to $3.4 billion, which is a lot, especially if you think how much money has been drained from the crypto ecosystem. You're thinking now of other firms who have big claims, who might survive that. Is the hit going to be big for many others? So clearly, as you mentioned, this is a saga that keeps going since May. It's hard to tell what will happen next, but obviously, you know, this is the next step. It wasn't totally unexpected. As you see, the market, like Bitcoin, hasn't reacted very negatively because we've been expecting this for a while, even right after FTX collapsed.
Okay, so there's been some expectation because of the links between this business and others in the space. Could this be the last bankruptcy, though, that we see here, Anna? I suppose it's too early to say that as well.
Yeah, it's too early to say. I guess we have to wait and see how some of these creditors react if they're able to take the hit. I would imagine that they've been knowing for a while that they had money locked up there. But, you know, it remains to be seen. I think, you know, very few people would have expected such a massive chain of collapses. But I mean, imagine FTX. I don't think anybody, you know, in September would have thought this would have happened, and yet it keeps happening.
All right, Anna Herrera, thank you so much. And of course, friendly reminder, you can catch Bloomberg Crypto every Tuesday at 1 p.m. New York time, 6 p.m. in London, where each and every week we will break down any further players that have fallen victim to the fallout of the collapse of FTX. Let's turn now to corporate news. Netflix is ending 2022 on a high note, adding almost 7.7 million subscribers last quarter, handily beating estimates. Plus, CEO Reed Hastings also announced he is stepping aside after 2 decades. Joining us now is Bloomberg Quick Takes Alex Webb. So, Alex, Netflix did it. I mean, this is really solid after they were on really shaky ground just 6 months ago.
Yes, although it is worth looking at some of the underlying earnings where profit maybe was a little bit disappointing, which points towards how they did it. Namely, you spend on content. They have massively had some massive successes with the likes of Wednesday, the Addams Family spin-off, and Glass Onion, the sequel to Knives Out from Rian Johnson. They're being quite successful on that front, but it shows that in order to not only keep growing but retain the subscribers you do have to invest in content. The other piece, of course, is the advertising supported tier, which is a lot cheaper on the front end. There is potential further down the line that it could be more profitable per subscriber in terms of, I should say, revenue per subscriber. Once it's built that out a little bit, for now, it's maybe helped add subscribers, but the advertising model itself remains not quite fully developed.
Okay, so there's a lot to say about the content that they've got and the ad model, the way that that's being introduced, so the business model shifting really right before our eyes, I suppose. Alex, as we see, well, the season finale for Reed Hastings, I mean, he's stepping away from the CEO role at this business. What does that mean for the company?
Well, I mean, he is the person who created Netflix, right? He's been there as CEO for 20 plus years. He was a co-founder already before then, but he, of course, led the pivot towards, you know, digital streaming and away from the DVD business, DVD by mail business they formerly had. But for the longest time, while he was CEO, the messaging coming out of Netflix was that they would never consider an advertising model, that it was anathema to the way they thought about digital content. Needless to say, guess what has happened? They are now introducing an advertising-supported model. So it does herald very much a sea change that maybe that it kind of rubber stamps the idea this is perhaps a new Netflix. The co-CEOs, one is Ted Sarandos, the head of the content business historically, but the new guy is the person who's been building the advertising model. So it does say something about that.
All right, Bloomberg Quick Takes, Alex Webb, thank you so much. Now let's pivot to some other stocks moving in pre-market trading here in the U.S. because Netflix's peers are kind of going along for the ride here as Netflix rises much more in pre-market trading, more than 5%. But you have other streaming competitors like Roku and Disney getting a bit of a lift as well. Roku is up about 1.5%, Disney by about 0.6%. One stock moving lower, though, that's noteworthy is Nordstrom. It also reported earnings after the bell yesterday, and the issue really is on the forecast. The company cut its outlook. They now see full fiscal year profit of between $1.50 to $1.70 a share. The prior guidance was as high as $2.60. So that is a pretty sizable cut, and the company is talking about weakness in the holiday shopping period. So that taking that stock down by about 4.3%, and that is weighing on other department store stocks as well. Kohl's and Macy's each down about 2.5% before the bell, Anna.
And Kaylee, we saw quite a lot of disappointment around earnings stories yesterday, didn't we? That's one thing moving markets. Also, the macro backdrop, though. We'll get into the weak points in the U.S. growth story right now. Christian Keller joins us, Barclays Head of Economics Research. We'll touch on the strengths and weaknesses of the global economy. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Today, Bloomberg's Michael McKee speaks exclusively with outgoing Kansas City Fed President Esther George. What has she learned? Where does the Fed go from here? An exclusive interview with Kansas City Fed President Esther George. Today at 10 a.m., only on Bloomberg TV and Radio.
Breaking news, more job cuts in the technology sector. Google's Alphabet is planning to cut roughly 12,000 jobs globally. That is approximately 6% of the company's global workforce of just under 187,000 employees. Alphabet CEO Sundar Pichai says in an email that he takes, quote, full responsibility. And this is just another example, Matt, of a tech company that ramped up hiring over the course of the pandemic, and now, given how economic times are changing, is having to cut back. We saw this earlier this week with Microsoft announcing 10,000 job cuts, or roughly 5% of its workforce. Amazon beginning layoffs of 18,000 people. And now here we are, Alphabet cutting 6% of its own workforce, Matt.
Yeah, absolutely. Even though the employment picture in the U.S., as you said at the top of the show, is incredibly strong, right? 3.5% unemployment and more than 10 million job openings, we are starting to see the pink slips fly in, certainly on the West Coast, but really globally. This is a story Michael McKee was mentioning a couple of days ago about Microsoft that is a global story, and Amazon comes out and says this is a global job cuts program as well. So we are starting to see the West Coast, the tech industry, cut jobs, and not just here in the U.S., but around the world.
Yeah, absolutely. So it is global, but there must be, as you say, the West Coast, the US expression of these job losses. And so there does seem to be some disconnect, doesn't there, between the micro stories that we're carrying and the macro picture being created by the jobs data. And we're looking for that gap to close somewhere. And certainly it seems as if it might close, in the sense that the data might catch up. The tech sector, then, I read, has cut 26,000 jobs in the first 18 days of this year. So this is a fast-moving story, and we're seeing it come across all kinds of areas. Parts of Wall Street are telling a different story, though, Matt, aren't they? I mean, Goldman Sachs is cutting jobs, but others are a little more optimistic.
Yeah, absolutely. And, you know, this is interesting as we see a much smaller proportion of jobs getting cut at Amazon. Kayla, you mentioned 18,000, but of course they have like 2 million employees, 5% at Microsoft. Now we're looking at more than 6% of Amazon. So companies firing a larger and larger portion of their workers. We're going to continue to talk about this. Again, Google's Alphabet planning to cut roughly 12,000 jobs globally. Let's get back to the Wall Street story, though, because Morgan Stanley CEO James Gorman says he is optimistic about the current global economic situation. He spoke with Bloomberg at the World Economic Forum in Davos.
There's clear evidence inflation has, in fact, peaked and is coming down, right? How quickly, whether the Fed will get us to 2% and when, remains the debate. But is clearly the slope of the line is positive, is to everybody's favor. And the second is not just the opening up of China, but China has embraced the rest of the world more aggressively in the last few weeks, witnessed by the Vice Premier meeting with Treasury Secretary Yellen this morning, I think it was this morning, in a way that we haven't seen for some time. So the big question coming out of the Party Congress and President Xi, being re-elected by the Congress, was where does China go from here? Does common prosperity mean effectively dividing the pie up so everybody gets a piece of it, or by growing the pie? And what we're seeing is the tilt is now from divide the pie to grow the pie.
Does that mean that you've got more confidence to expand in China?
We've got a very good business in Greater China. Obviously, we have a huge business in Hong Kong, and we continue to have, I think, on the mainland up to 1,000 people in various functions. But no, I think we need to see a little more clarity of Chinese policy, a little more sober discussion around global trade relations, and right now I think we're certainly in a watch, but tilting more positive than we would have been 3-6 months ago.
That was Morgan Stanley CEO James Gorman speaking to Bloomberg in Davos yesterday. And it's interesting to hear him talking simultaneously about the peak in inflation, but also the reopening of China, because, Matt, as we've discussed time and again, when China's full demand is unleashed, it could lead to higher commodity prices and once again start refueling inflation just as it's starting to come down. And that is something that central banks have to contend with as Fed officials say, hey, we still got to restrict a little bit more and we got to stay there for longer.
Yeah, I mean, this just gets back to the Goldman Sachs argument that commodities prices are going to be, unleashed to the upper end after the reopening of China as Europe avoids the worst of a recession, right? We heard from another national leader, this time in France, that he thinks they'll avoid a recession. We heard that from German Chancellor Scholz as well in his interview with John Micklethwait. And as the Fed, pauses or gets closer to a pause, I guess the last part is really a big question.
Yeah, so some better news, I suppose, in that sense. And in terms of the global economy, a lot of people are saying that maybe we're in a slightly better place. Voices at the IMF certainly saying that. Interesting that we got a different view on commodities, or rather the reopening of China and what that does to inflation yesterday, to the Goldman Sachs one you mentioned, Kaylee. JP Morgan talking yesterday about how the reopening could be deflationary because of what it might do to supply chains. I guess we'll have to wait to see just how blocked up those supply chains were and what the reopening does. Coming up later today, an exclusive interview with the outgoing Kansas City Fed President, Esther George, 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. CIA Director William Burns has reassured Ukrainian leaders that the U.S. will maintain support as the war drags on. Burns traveled to Kyiv last week. He met with President Volodymyr Zelensky and his Ukrainian intelligence counterparts. In Japan, inflation has hit 4% for the first time in more than 4 decades. That's twice the pace targeted by the Bank of Japan, and is likely to lead to more speculation that the central bank will change its monetary policy. The Supreme Court says it hasn't been able to identify who leaked its opinion overturning the constitutional right to an abortion. During an 8-month investigation, the court's aging computer system was examined and 97 employees were questioned. The court called the leak a grave assault on the judicial process. And David Crosby is being remembered today as one of the most influential musicians of the classic rock era. Crosby, who co-founded the Byrds and Crosby, Stills, Nash & Young, has died in Los Angeles. He performed for more than 5 decades, and his group sold millions of records. All the while, he battled drug addiction and a number of other ailments. David Crosby was 81.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's Renewable Assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Making the case for high interest rates, 2 top Fed officials argue that it's too soon to back off in the fight against inflation. Another crypto casualty following the collapse of FTX. Crypto lender Genesis files for bankruptcy protection. And Netflix CEO Reed Hastings steps aside after more than 2 decades. The news comes as the streaming giant reveals it's added a better-than-expected 7.7 million subscribers. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons over in New York. And Matt, we coming towards the end of the trading week, of course, here in Europe. And one of the things that's been really driving the bond markets this week has been some pushback from the ECB around the need to step down in interest rate hikes. There were some voices at the beginning of the week suggesting maybe that would be necessary. down to smaller hikes. But then we've heard a lot of ECB voices contesting that, and we continue to hear that this morning. The ECB's Christine Lagarde speaking in Davos, saying that staying the course is her mantra for policy. This another theme that's been driving at least the latter part of this week.
Right, and I think that theme is continued in the U.S. as well. You hear many Fed officials talk about the need for a step down, but you've got to differentiate the difference between the size of rate hikes and the duration of the terminal rate, right? So a lot of people, Raphael Bostok said 3 words, a long time. We heard yesterday from Lael Brainerd, for some time we need to maintain high interest rates. And now you're hearing Christine Lagarde saying, I think, stay the course. So many different ways of saying it's going to be a while, folks, at these high interest rate levels. And that just really doesn't signal a shift, a pivot in the second half of 2023 as the market is anticipating. Let's take a look at what's going on here in markets right now. The S&P futures picture getting a little bit brighter, up 0.1%. It was unchanged just a half hour ago. So we're starting to climb a little here as investors sell off bonds. That pushes the yields here up as well. So we're catching up a little bit with Europe in terms of yields, coming back up, a turnaround in the big drop that we've seen over the last 2 sessions. The 10-year now trading at 343.84. We're also seeing a turnaround in oil. It had been coming down on the recession concerns that we've had over the past few days, ever since those bad retail numbers came out of the U.S. NYMEX crude had dropped down below $80 a barrel. Now it's back up to $80.55 for West Texas Intermediate. And then Bitcoin, little changed, but still right at 21,000, at $20,932.87 to be exact. But it's interesting that Bitcoin doesn't move lower or much lower after we get the bankruptcy filing from Barry Silbert from DCG's Genesis. So we'll continue to see fallout of that and continue to cover that. Kaylee, what do you see in pre-market movers?
Well, one of the biggest ones out there this morning, Matt, is Netflix, which reported earnings after the bell yesterday and blew it out of the water, really, on subscribers. The analyst estimate was 4.5 million additions in the quarter they just reported. Instead, they delivered 7.7 million. So it really shows perhaps that that ad tier that they launched in November is starting to pay off for the company. Of course, the separate news is that the CEO, Reed Hastings, is stepping down. He'll just be chairman. Sarandos and Peters are going to take things over from here as co-CEOs. But add it all up together, and you do have a stock that is moving higher in early hours. Netflix is up about 5.5%, and some of its streaming peers like Roku and Disney are higher as well by about 1.5% and 0.8%, respectively. Then the other tech story to watch today is Alphabet. We got news just about 15 minutes or so ago that the company is cutting 12,000 jobs, or roughly 6% of its workforce. Sundar Pichai saying that he takes full responsibility for it. This is just another case, Anna, of a tech company that hired big during the pandemic and is now having to trim back its workforce in the face of slower economic times. Investors, though, seem to like the idea that Alphabet is pulling back on costs because the stock is up about 1.2% before the bell.
Yeah, we've certainly seen a lot of this from the tech sector, haven't we, as we mentioned earlier on, Kaylee. This is what Europe looks like this morning, up by 0.4%. So trying to turn a corner from yesterday's losses. We were down quite substantially in Europe in yesterday's session, down by more than 1% in many of these major markets. Ericsson is one stock that bucks the broadly upward trend today. Ericsson coming out with numbers, the telecom equipment company. It supplies the 5G operators around the world, and it says that they're not spending, they're not willing to spend in the way that had been assumed, and so their numbers have come in below estimates. That tells an interesting story on capital expenditure, doesn't it, from the telecoms sector? And here we've got the European bond market, a couple of bonds here, the 10-year yield in Italy and the German 30-year. The 10-year yield not a million miles away from 4%, but still at 3.9 over in Italy. As we watch these markets carefully, Kaylee, we've seen these yields coming up in the last few days as we get that ECB pushback to the idea that we'll see a step down in the pace of hiking.
All right, well, let's continue the conversation about the economy and monetary policy, Anna. The World Economic Forum is wrapping up in Davos after a big week of interviews with some of the world's most elite and biggest leaders, many of them sounding a more optimistic tone.
Soft landings are the triumph of hope over experience, but sometimes hope does triumph.
You've seen the over-optimism from some about soft landings and the economy's doing well, but equally you've seen the severe case downside also coming in.
We all anticipate a potential shock, but if we look at our indicators, they're all very good.
Having said that, I think the
big uncertainty this year is what will happen with global inflation when China kicks in.
We have many uncertainties, not only within China as to the trajectory of the pandemic.
I'm actually very optimistic that we can ride through this.
But again, this is still a tough year.
Let's have one more voice weigh in now. Joining us is Christian Keller. He is Barclays Head of Economics Research. Christian, it does seem like the tone is growing more and more optimistic, that people are betting on a greater likelihood of a soft landing rather than recession. Do you think that optimism is misplaced?
Well, I think there is a certain cynicism there. I think Davos has been often a counter indicator. If people were very optimistic at Davos, often it wasn't a very good year for markets, and the other way around. But I think the data, in a way, that we've seen so far in recent weeks does point to a scenario that is no longer as pessimistic as where we were, towards the end of last year. China is coming back. Europe's energy crisis seems a lot less severe than we thought just a few months ago. And I think that together means, that we have what we think much shallower recession than what we thought earlier.
Christian, good morning. Given what we've said there, there is plenty of talk about things looking a little rosier for the global economy than maybe we would have said a few months ago, and you've mentioned some of the reasons why. Given that, is it right that we keep hearing the more hawkish language coming through from the ECB? Christine Lagarde just saying this morning that, staying the course is her mantra when it comes to fighting inflation. Is that appropriate still?
Well, you could actually argue that it is exactly appropriate because of the better economies, because what we are seeing is in Europe and as well still in the US is that core inflation is holding up quite well. So we're getting relief from energy, in particular in Europe, and we're seeing, that in particular in the US headline is falling, but they are concerned about the labor market still at full employment. We got some good news out of the US in terms of wage data, but this battle, so to say, is not won yet, and I think central banks are probably right, and that has been our view, to warn markets not to get ahead of themselves. They're going to slow the pace in the US, but they're going to stick to the 50s in Europe. And they're very much aware that, in the 70s we had similar situations, things cooled off, and then they were a bit too quick to relax. And I think this time, that's why they give us a message and markets a message. They want to stay the course.
Yes. Who cuts first, do you think, Christian? I appreciate that's not the mantra at the moment. That's not where we are. We're still hiking. But who eventually cuts? At the beginning of this week, we saw a story that suggested that maybe the ECB cuts towards the end of this year. Other voices I've spoken to pushing back and saying, no, that's way too soon. It's not going to happen till next.
I mean, the market tells us it's the US, right? The market is still pricing cuts for the US this year. And if you look at the cycle, it started with the US. They seem to be 5-6 months ahead. Also, if you look at the inflation profile. So if someone cuts, it's the US. And so there is a chance, and that is what market is pricing, that the US, if the inflation develops as positive as models indicate, that they may want to give back a little bit of the tightening in the end of the year. But for the ECB to go ahead of the Fed, something extraordinary would have to happen.
Well, I don't get why people are so sure of a pivot. Why would they want to give back tightening? As long as the economy isn't in a deep recession, don't they want to save that dry powder for when they have a real problem?
Yeah, I think so. I think this is what the Fed should and probably will do. Markets are pricing the cuts. Well, I think one has to take into consideration that how markets operate. They think there's always a chance that maybe there is a deeper recession. Things could get worse. This week we saw the weaker than expected retail. Bond markets immediately reacted. So this is maybe why markets are, keeping those cuts in. But I would agree with you. That may be something that they have to price out at some point if, data continues to be coming in quite well. And we don't know yet really whether core inflation won't get stuck towards the middle of the year and not continue to disinflate as typically a model would tell you by now.
Kayleigh mentioned earlier the concern that maybe the reopening of China is going to boost commodities prices, and that could bring inflation back or at least slow down the drawdown. What do you think about that equation, Christian? Shallow recession in Europe plus reopening in China and peak rates in the US. Does that mean we're going to start to see, commodities climb like they did in 2008?
Well, the recovery in China, it's probably going to be a bit different than the recoveries we've seen in the past. It will be a little less resource intensive, and particularly if the real estate sector continues to grows more slowly than the past. But, you know, you're bringing back the second largest economy in the world that had very weak growth all last year, that for sure is going to do something to commodity prices. And we do think mobility is up. That should push oil and other commodity prices as well over time. So yes, I think that is true, that we're going to get firmer commodity prices. But probably central banks in the West are still more concerned really about labor markets, not so much about what commodity does to the headline.
Well, but on that point, Christian, you mentioned how we had a downside surprise on retail sales. We also got a downside surprise on industrial production. Housing continues to deteriorate. You are seeing softness in some data points. And then yesterday, initial jobless claims were at the lowest in September, 190,000. The labor market is still proving incredibly resilient. Does the Fed specifically have to see that labor market deterioration, or is the deterioration elsewhere enough?
Well, if we follow what you know, the Fed chair Powell told us since September last year, is that they do want to see that deterioration in the labor market. They probably don't like the word deterioration, but they want to see more easing. You know, with an unemployment rate of 3.5%, even if the Atlanta wage tracker tells us that wage growth has been slowing, you know, it's very unlikely how you get with such a tight labor market, so many jobs for each person who is looking for one, you know, that you really get that disinflation in core inflation that you need to see to be comfortable for the Fed, that they land the economy at 2%. And I think that is a point that we'll continue to make.
Christian, thanks very much. Thanks for joining us. Christian Keller of Barclays. We will get back to the earnings story shortly. Coming up, Netflix CEO Reed Hastings steps down as the streaming giant reports a massive surge in subscribers. The changing business model there next. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. And Netflix's outgoing CEO, Reed Hastings, is leaving on a high. He is stepping aside as the head chair, well, he'll be the chairman, but he's stepping aside of the chief executive of the company he's led for more than 2 decades, and is leaving the position to his 2 longtime associates, Ted Sarandos and Greg Peters. Meanwhile, this announcement comes after Netflix said it added almost 7.7 million subscribers in the fourth quarter, easily beating estimates. Joining us now to discuss it all is Geeta Ranganathan, Bloomberg Intelligence media analyst. So Geeta, let's just start with that frankly blowout number on subscribers, far ahead of expectations. How much can we chalk that up to the ad tier, and how much of that is just a really strong content slate in that quarter?
I think it's a little bit of, both of those factors, but I would attribute more of it to the content slate. And we really saw Netflix kind of deliver on that content front, kind of really blowing it out of the water. Because if you just look at the steady stream of hits that they had in the fourth quarter, I mean, it's tremendous. They spoke about 5 of their most successful shows ever in the history of the company actually coming in 2022. So what that tells us is that they've kind of reached the steady state of content releases, and they're able to generate more and more consistent hits. But of course, they spoke to the ad-supported tier as well, the launch. They didn't necessarily give us any numbers around it, but they did say that the launch has gone pretty smoothly, and they will continue to ramp that product through the quarter. But absolutely, both factors have contributed in that subscriber blowout.
What does this mean in terms of the succession, Geeta? The two names that have been running Netflix seem like they're going to continue. There's nothing new here in terms of personalities.
Absolutely, Matt. I mean, this move has been a long time coming. I mean, they have been discussing succession planning for a very long time. We kind of saw a little glimpse of that right in 2020 when Reed Hastings kind of promoted Ted Sarandos to become co-CEO, elevated Greg Peters to become the chief operating officer. So these are industry veterans. They know the company inside out. They've worked with Reed a long time. They kind of know his philosophy. And, it's pretty much business as usual at Netflix.
Geeta, can I ask you about the content here? We talked to Alex Webb earlier on, who was reminding us of some of the kind of hit content that they've made recently. And of course, those names, those real success stories do stand out. The other thing I think of when I think of Netflix, and possibly some of the other streamers as well, is dramas that maybe are set outside any particular cultural context, because the artificial intelligence says this will drive the maximum number of eyeballs. And I'm sure many people can think of their own examples. I mean, what do you think about when you reflect on the way that content has changed under this streaming boom?
That's such a great point. And I mean, Netflix has kind of really revolutionized that, I think, in so many ways, because they've gone after local content in so many different regions, whether it's South Korea, whether it's Spain. And in the fourth quarter, we saw a great example of, All Quiet on the Western Front, a German movie, Troll, a Norwegian movie, all of these great hits for the platform. And it has global audiences. It kind of resonates well with everybody across the globe. And that actually, it's not only is it good for great content, for globalization, as kind of an industry theme, but it's great for their bottom line as well, because a lot of these pieces of content are so much cheaper to produce than English language content in the United States. And so that's one way that they're able to kind of now keep their budget, their programming budget. They've talked about kind of keeping that in that $17 billion zip code, and they're going to be able to do that because they're able to find these hits and because they're able to grow across the world.
Well, Geeta, on that spending point, we have seen just today another job cut announcement coming from Applesauce Alphabet, cutting 6% of its workforce. It's not funny when people are losing their jobs, obviously, but this is just in a string of tech layoffs. Are we going to see that kind of cost cutting coming from Netflix, do you think?
I don't think we're necessarily going to see a reduction in headcount. I think where we're going to see a reduction in expenses is going to be the non-content costs. So Netflix already has a pretty efficient model. They've kind of shown us that operating leverage that they have when it comes to the content cost part of it. Now it comes down to, decreasing their marketing spend. And they are actually running pretty efficiently. But the marketing spend, the R&D expenses, the technology expenses, those are all areas that a lot of these media companies are going to have to make significant cuts in. They're going to have to kind of streamline and make that model more efficient. That's one area that Netflix is definitely going to look to. I'm not so sure we're necessarily going to see any big headcount reduction as such.
Okay, thanks, Geeta. Thanks for joining us. Geeta Ranganathan of Bloomberg Intelligence with the latest on the media sector. Coming up on the program, we will talk defense. Defense ministers meeting in Berlin to discuss more support for Ukraine. More on what to expect. This is Bloomberg.
stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is coming up on this Friday. More Fed speakers today, including Patrick Harker, Chris Waller, and also Michael McKee's exclusive interview with outgoing Kansas City Fed President Esther George at 10 a.m. Eastern Time. We'll also be getting some U.S. economic data with existing home sales at 10. Then at 10:30 a.m., U.S. Secretary of Defense Lloyd Austin will be holding a news conference with U.S. Chairman of the Joint Chiefs of Staff, Milley, in Germany.
Yes, that meeting taking place later. So staying on the defense ministers' meeting, pressure is mounting on the German Chancellor Olaf Scholz to deliver Leopard tanks as the U.S. announces a fresh $2.5 billion military aid package for Ukraine. For more, let's get to Bloomberg's Oliver Crook, who's in Berlin. Oliver, what are we expecting to hear from this meeting?
Right, so Anna, you've laid it out there. Will there be more military support for Ukraine, and what form will it take? So yes, there will be more support, $2.5 billion worth from the U.S. alone. That comes along with other things from other NATO allies and non-NATO allies. But the main question, which it does not answer, is will the U.S. and or Germany send these battle tanks in to Ukraine? And the debate in Germany and more broadly has really coalesced around these Leopard 2 tanks, which Scholz has been very reticent to send in. We spoke to the Chancellor earlier this week about this topic.
We always act together with our allies and friends. We are never going alone. We support the Ukraine as long as it is necessary with all the means we can use, but also always avoiding that this war is escalating to a war not between Russia, which is the imperialistic aggressor, and Ukraine, but to avoid that this is going to be a war between Russia and the North Atlantic Treaty Organization.
So the line from Germany and from Scholz has been, we will not do it alone. We basically will need the United States to send comparable military equipment like the Abrams tank. However, there has been some progress on that. Overnight, the new defense minister said that these are not necessarily connected. The Abrams are not necessarily a prerequisite for the Leopards. I spoke to an FDP lawmaker earlier today who sits on the Defense Committee who thinks that from this meeting, the Germans may not send their own tanks, but they may at least give permission for other nations who hold those tanks to send them to Ukraine.
Yeah, I was going to ask about that, Oliver, because you know, when I was there, for years, the Germans didn't even have enough equipment for themselves. They couldn't even fly Merkel around. They only had 2 A400s and enough staff for one. So how can they deliver tanks to Ukraine?
So you touched on a broader point. So we have a new defense minister, as you know, who's been in the job for about 24 hours. He was sworn in, met with Lloyd Austin as the first thing he's got to do, and everything has been basically eclipsed by this tank debate. But really, as you point out, there's a Herculean effort here to update the German military. Olaf Scholz has put 100 billion euros aside to do that. But how are you going to spend that money? How do you effectively spend that to modernize the German military, particularly in a time when there is a war in the eastern flank of Europe? So these are questions that are very large ones for Germany going forward, and the defense ministry is one that is a very difficult one to wrangle. And obviously there's a lot of military baggage associated with Germany on this subject.
Okay, Ollie, thank you very much. Oliver Crook in Berlin. And just as he was speaking, getting confirmation from a spokesperson for Scholz that Germany says sending tanks to Ukraine is not dependent on the US, as Ollie was leading us to believe there. He was sort of correctly pointing us in that direction. So that is it for early edition. Surveillance is ahead. They'll be sure to pick up on this theme, the defense theme, also tech jobs. This is Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Okay, traders, hello again. As you can see, I changed stop loss on the Bitcoin. Yesterday, if you remember, all of you guys who didn't see, we purchased Bitcoin at 20,760. If you follow trades, as you can see, we over 1% already in profit. Just to make sure we will have maximum profit we can take from Bitcoin, I will place stop loss on 0.5%. It will give us £500 in profit. So if it will go higher, I will increase stop loss. If it will it will go lower, and if it will reach level 0.5%, it will fill the order, and we will collect profit £500. Okay, guys. So all of you guys who purchased and decided to follow this trade, please place your stop loss at this level. I'll speak to you later, guys. Stay safe.
Brilliant. My tie fixed as well. Let's talk about these job cuts at Google, Tom. Alphabet, 12,000 jobs to go, 6% of the workforce. They join a pretty ugly club right now.
No surprise there, and the number 6% is key. I would suggest window dressing the end of the year into a new year, 2 to 4% is sort of the way all industries go. Clear out the deadwood. This is more than that, again, 6%.
It goes way beyond that, Tom. I think tech, and I said this a little bit earlier this morning, appearing to be going through its very own post-GFC moment for this industry, Tom. Years of excess. The good times aren't coming back anytime soon. And the austerity, it feels like, TK, is just beginning.
I can't say enough about how you're right on this, and it is a cultural moment for Silicon Valley. I'm going to go, and we make jokes about it, but this is not funny. Google used to hold court at the piano bar. Dave Drummond, their general counsel, Mr. Brin, and the others, and there was that Silicon Valley tone that permeated Davos, Switzerland. It's gone, finally.
They're throwing money. They had money thrown at them, Tom.
Fitbit. Please, where's my Fitbit?
What about Fitbit? What about it?
I wore it for 3 days. They bought Fitbit. That was one of their acquisitions to save the world. And, you know, I read a lengthy article, Vox, with a spectacular article on Amazon. Same thing, John. They just buy this, innovate, innovate. It's over.
The discipline of 4%, Tom. 4% rates, the discipline of 4% rates, 450 at the Fed and maybe 5, starts to bite.
Yeah, it's that, but it's also in the short rate market where finally money costs something. And I'm sorry, Google puts their pants on one leg at a time. And with the new cost of money, they, like Bed Bath & Beyond, are adapting and adjusting.
Well, let's talk about the cost of money right now. So this came from Vice Chair Brainerd yesterday.
You mentioned this.
We are determined to stay the course. These words from President Lagarde a little bit earlier this morning, Tom. Staying the course is my mantra for policy. They want to stay the course. Can they stay the course?
Yeah, but you did this brilliantly, John. It's really important, folks. John and I approach this differently. He really, really reads these documents. I'll be honest, rarely do I. And the fact is, go through the Brainerd idea of there was an intro like a good movie, there was an outro to get to the sequel, and in between it was a little different.
The in-between stuff is the more important stuff. So if you open the speech from Vice Chair Brainerd yesterday, at the start of the speech, she talks about staying the course. At the very end of the speech, concluding, you know, we need to stay determined, keep working, all of that good stuff. In the middle of the speech, and Kit Jukes referenced this over at SocGen this morning, thinking out loud about the potential of a soft landing. Reflecting on how much monetary policy tightening is already in the pipeline, Tom, and how much damage could be done in the future. We're shifting towards 25. That's the story of the Federal Reserve. We're shifting towards 25.
We're shifting towards February 1st after some difficult, hard economic data. And the market reaction, let's remember the Dow, I believe, I don't know where SPX is, I never follow it. But the fact is equities have come back from that early January rally.
I can tell you futures right now, just about positive by 1/10% on the S&P. Snapshot of the market, we look a little something like this on a 10-year in America. Your 10-year yield at the moment up 4 basis points to 343 on a 2-year up 4 basis points, also to about 417 on a 2-year. In the FX market, euro dollar, we're staying the course at the ECB. 108.40, euro dollar positive, 1/10%. Joining us now to kick off the program this Friday morning, and good morning to you, is Brian Weinstein, head of fixed income at Morgan Stanley Investment Management. Brian, there's a subtle change emerging here in the Fed speak. Are you picking up on the same thing?
Yeah, you guys are all over it this morning. I mean, at some point you have to move to 25 because you've done a lot. You don't know how much damage that you've done, but we know inflation numbers will fall. We know that there's some weakness in growth numbers forward and jobless numbers. Not today, but that 6 months from now we'll see weakness there. So you switch to 25. They have a different problem though. Risk assets then price in 200 basis points of immediate easing and go right back up and search for highs. So it's a delicate dance the Fed's trying to do.
Brian, very importantly, and Ben Emmons absolutely nails this morning, and it's the Brian Weinstein world. There's a massive fear of missing out, and that in the bond market, issuance is nuts. Explain to our audience why everybody and their uncle is putting out bills, notes, and bonds.
Well, I guess I would say there's at least two interesting factors. One, beginning of the year, I always find the first couple weeks of January very confusing as an investor looking for signals because people just have capital and they feel like they're missing out and putting it to work. But I do think behind that are yields, income, right? I mean, everyone wants to talk about recession and big corrections and huge moves. What if nothing happens this year? Well, if nothing happens, you get paid almost 5% to put your money into T-bills, right? You can make more if you put your money maybe out the curve and we get more of a rally. So investors aren't crazy. They haven't seen this in a very long time. But when you think about the safer credit markets, whether that's U.S. Treasury is a different story, but investment grade, municipal bonds, things like that, you actually get paid to buy. And so companies are issuing because we rallied and things feel better, but investors are buying because they get paid to wait.
Is your framework clip the coupon, or can I hope for a Dan Fussian-like total return?
Listen, I like clip the coupon for now. The bond market's, I think, a bit ahead of itself. Again, are we going to get 200 basis points of easing? Is that so certain you can continue to buy 10-year notes at 340? I'm a little skeptical, but longer term, Tom, listen. I don't know. We're going back to 4.25 where we were towards the highs. So you can get your coupon plus. I think you can be a little careful what you buy when, but if you maybe buy it or sell it, I'd buy it.
There's a bumper sticker. Brian, he's living large. You know how he's done at Morgan Stanley. He's got the Jeep Wagoneer with the wood sides. He puts the kids in the back and all that. He's got a bumper sticker. Coupon plus.
I'm not sure how many other people have that bumper sticker. Brian, I want to come to you on the difference between what you think is going to happen with treasuries and what you think will happen with US credit, corporate credit, high yield credit, to be specific. Do you really want to take credit risk here, going into what people think could be a recession, and at a time where spreads are in and around 400 basis points? And I keep saying this, the ISM is sub 50. So you've got spreads that have been tightening at a time where the data has been getting worse. Is that a good time to be buying high yield credit?
I mean, historically, no, right? High yield's been interesting in that it's pricing in a much rosier scenario than some other markets. That said, if you go back to 4.25 on 10-year notes, you were getting close to 9% or a little bit more on high yield. So at that rate, you get paid to make some mistakes, right? You're going to have defaults. It's okay. Back to my previous comment, I don't know you need to chase it here, but I'm not sure you're playing for 2008 where 10-year high yield spreads blow out to new wides. So I'd be a buyer of high yield spreads on weakness if yields went up, if spreads widened. But I think there's a relative cheapness of the more boring sectors. People don't love to chase those sectors, but I think you'll get better opportunities in some riskier sectors.
Brian, what are the boring sectors? What would you call them?
Listen, you've seen the huge amount of money into investment grade, right? A sector that people don't love to talk about, not nearly as sexy, but you get low defaults, you get another 120 basis points over treasuries, a little bit of duration to Tom's upside comment. You can rally, you can actually make more than your coupon. Municipal bonds got really cheap in October. They still look pretty good now. But places where you've historically had low default rates and better liquidity, I don't know that you have to be super fancy. Yeah. And I think T-bills, right? Money market funds look great now given where the curve is.
Brian, this weekend, are you going to worry about the debt limit, the debt ceiling, the default of the United States of America?
No, Tom, I'm not. I mean, I think it's political theater. There's real short-term risk if you're a bill trader. Other than that, I think you put it in the back pocket, realize it shows something about dysfunction of government, but we're not going to default in the U.S.
Should we bottle that sot and just replay it from now until
replay it until the summer? I mean, this is where Wall Street's at, Tom. This is the way they see things.
No, but for those of you that aren't sophisticates on this, you see how Mr. Weinstein just, professionally dismisses it, like, move on.
For now, I wonder how much more seriously you'll take this, Brian, when we do start to get towards that X date later in the summer. Do you not get a feeling in any way, shape or form that this could be somewhat different?
Again, yes, we've seen them come real close before, right? We've been downgraded. I forget exactly the year, but we played chicken with the debt ceiling real in a real big way. But again, that a major holder of U.S. Treasuries, or any of us as holders of U.S. Treasuries, should worry about not getting paid back. I don't think that's the number one thing on minds. It will have short-term impacts, as you said, when we get closer to mid-year, but it's not going to be my weekend. My weekend fear is more of the big picture things: recessions, job layoffs. People,
stop it, Brian, stop it. Giants or Eagles, which one?
Oh man, I'm a Giants fan. They look great. I hope the Giants win. I think they can do it.
There we go. That's what matters.
Are we starting the sports segment early?
We're starting with Brian. Okay. You got to start the sports segment.
Hey, Brian, thank you, buddy. As always, Brian Weinstein there of Morgan Stanley Investment Management. Is this time different? We're going to be asking that a lot through to the summer. I remember an address from the former president, Barack Obama. And I remember at the time that he wanted markets to take it more seriously. I remember there was this address from him, Tom, where he was almost pleading with markets to sell off. My words, not his, and you can reflect on some of the comments at a time around 2011. But Tom, it felt that way, that it would have been easier for him if markets had reacted in a much more violent way to what was taking place. And the fact of the matter is, in treasuries, that's not how it works for people. We discussed this yesterday. When you get into a dicey moment with the debt ceiling, what do investors start to buy? They go to treasuries.
Yeah,
and when I say is it different this time, I want to understand if that's going to change. And based on someone like Brian, who's in the fixed income market, he's telling you he's not going to shift away anytime soon.
And the FT has Katie Duguid has a beautiful article today summarizing the reverse repo market, the land of Ira Jersey folks, and the idea that when in doubt, do what you just said, John, and also put billions, if not trillions, into the cash in the overnight market. You go hide, and then it's over.
You saw what Bill Dudley said, the former New York Fed president, about the plans they had.
Yeah,
they had to look at this back in 2011, I think again in 2015, and take it seriously. And Tom, they were talking about buying in the secondary market and buying bonds if things really hit the fan. Doesn't that kind of encourage it, though, TK, to know that that's there? You've got that backstop.
Yeah, but they have an institutional responsibility to do it like a banana republic. But what I'm really going to listen to is Anne-Marie Horton. And I'm going to listen to Anne-Marie Horton because this time is different after what we saw with the speaker soiree here a number of days ago, and that you've got a certain group. How will they react when you get closer to those important hours at midnight?
We heard McConnell recently, the Senate Republican leader, Mitch McConnell. He was pretty emphatic and very clear about it. The U.S. will never default. Is he running his party in the way maybe he has done, Tom, in years gone by?
Again, I think Anne-Marie nailed it yesterday. We saw her way too much yesterday, I thought.
I think we're going to see her in a moment.
We are?
Isn't she joining us in a second?
She's off today. Everybody I know is off today. Shanali's off, Anne-Marie's off.
Shanali's off? I didn't know that.
They're all off. You know, you and I are the only ones working in the building.
Is Bramall off, or is she still with us?
Bramall's, I don't know what the Gulfstream's doing.
I heard a rumor she's going to join us at the end of the
Sam Moritz, maybe?
Is she going skiing again?
I think she's going skiing
I thought the snow in Europe wasn't good this year.
She doesn't care. She just goes and
That's
drinks.
what I hear.
You know, I don't.
Oh, she drinks on the piece, like the après ski.
Yeah, the very après.
The very après.
She's like out of a Bond movie, you know.
Futures up at 10 from New York. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The parent of Google has become the latest tech giant to retrench after years of growth and hiring. Alphabet will cut about 12,000 jobs, more than 6% of its workforce. CEO Sundar Pichai says the cuts will affect jobs across the entire company. Pichai says he takes responsibility for the decisions that led Alphabet to this point. The Biden administration is sending another major package of military hardware to Ukraine. It includes 90 Stryker armored personal carriers, 59 Bradley fighting vehicles, and millions of rounds of ammunition. The package, valued at $2.5 billion. The U.S. and its allies are meeting in Germany today to discuss more aid. In Japan, inflation has hit 4% for the first time in more than 4 decades. That's twice the pace targeted by the Bank of Japan. And it's likely to lead more speculation the central bank will change its monetary policy. And David Crosby is being remembered today as one of the most influential musicians of the classic rock era. Crosby, who co-founded the Byrds and Crosby, Stills, Nash & Young, has died in Los Angeles. He performed for more than 5 decades, and his group sold millions of records. All the while, he battled drug addiction and a number of other ailments. David Crosby was 81. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Today, Bloomberg's Michael McKee speaks exclusively with outgoing Kansas City Fed President Esther George. What has she learned? Where does the Fed go from here? An exclusive interview with Kansas City Fed President Esther George. Today at 10 a.m. Only on Bloomberg TV and radio.
We will pay our debts. We always have, we always will. How message is going to getting from point A to point B, we don't know yet. We're going to target basically the debt, an increasing of the debt to how we can basically prevent that from continuing to increase as it does and start a downward trend. And there has to be some discipline, and there has to be some sacrifice.
Discipline and sacrifice. That was Senator Manchin speaking in Davos, Switzerland, alongside David Weston. Fantastic conversation. You can find that on Bloomberg.com and on the Bloomberg terminal. Equity futures right now. Equity futures are positive by 0.1% on the S&P, trying to erase a weekly loss. Been a pretty ugly week so far, Tom, I've got to say, in the equity market. Yields are higher by 3 or 4 basis points, 342.93, euro dollar 108.35. For all the doom and gloom, let's go back to it. Just revisit it for a moment, Tom. For all the doom and gloom, jobless claims yesterday, 190,000. Does that scream? Does that scream recession?
4-week moving average 206,000.
Hey, unreal.
I believe it is. I got a
Unreal.
VIX at 20.49 that tells me the market's not as ugly as the ugliness that financial media is given. And again, if you're just joining us, Google layoffs this morning. John, this is original, and again, it comes out of a pandemic. I'm going to lean on Professor Summers, Professor L. Arian, Professor this, Professor that.
Yeah.
And the answer is really smart people are thinking as hard as they can about the shift from pandemic COVID over to something that they remember. Who says we're going back to something we remember?
Except you can't shift away from the pandemic too soon.
Yes.
You've got China reopening. And as we said a few times already this year, this is the 3rd year of pandemic economics complicated by China's reopening. I think this is really difficult. And Tom, what are we going back to? There's not a new normal. It's maybe the old normal of just rates at 4%.
One of the most intelligent.
We stay there for a while.
One of the most intelligent conversations of the week, folks. I believe we'll feature this in the 8 o'clock hour. Was James Gorman with Lisa Abramowitz, and he was heated about work from home. That folds into the labor picture. I'm not sure how, but Gorman was, I thought, brilliant, articulate, and heated, impassioned about where are we going in this new work-from-home society. How does that fold into McKee's Jobs Day? I don't know.
Well, industry to industry, and I think we can talk about the financial sector and we can talk about the tech sector as well. There is a feeling amongst a lot of people that, Tom, things got too soft. They got too soft at many of these corporations. Yeah. They were worried about first-year analysts at the banks. I wonder if that attitude has shifted in a very big way after the last 12 months. And tech, Tom, basically, if you worked at a tech company, you could work wherever you wanted. Now with these kind of job cuts, Tom, it brings discipline and I would say job insecurity back in a way that, yeah, James Gorman says get back to work. I think a lot of people will get back to work when they see the job cuts on the street.
Jason Del Rey at Vox, I can't say enough about the journalism here on Amazon. And he describes, John, exactly what you just said, which is he speaks to multiple ex-Amazon senior officers who say the company got soft. That permeates, I'm not sure it permeates every sector, that's unfair, but in tech, I think we can say yes.
Well, Twitter's an example of that. Weren't they selling,
that's a
weren't
unique
they
story.
empty in the office? Weren't they selling things like the pizza oven and all that good stuff?
I don't think it's appropriate for me to comment on Twitter. I'm afraid I'll get banned like Susan Lee over at Fox Biz. But
what, banned from Twitter?
Yeah, Susan Lee.
I think Susan Lee's back on that.
Our friend Susan Lee, she's back on.
Our friend Susan Lee is back on Twitter.
She went to Davos. She wore Bogner the whole time.
Is that right?
Yeah, and you know, I just think the whole tech thing's in a tumult. A la Bitcoin. Shonali Bassick, I told, was listening to us and maybe in the house here in an hour or so. And the bottom line is Bitcoin this weekend's blown up. And that's part of that tech zaniness right now.
It's years of excess. I've asked this question a few times, so let me ask it again. Is it the last 2-3 years of excess or the last decade of excess?
Oh, no, decade.
That we need to unwind.
No.
If it's
no,
the last decade of excess, okay, so let's talk about Amazon. Amazon going into the pandemic had about 800,000 employees. After the pandemic, that had doubled.
Yeah.
Tom, that had doubled to about 1.6 million. I think it's come down to about 1.5. Okay, so if you look at their job cuts recently, and we're talking about removing excess, have we seen anything close to what you expect to see from a company that's had expansion that large? And that's only the last couple of years. Never mind the last decade.
They'll do it. Speaking of excess, should we go to Anne-Marie? Speaking of excess,
we can, sure.
Speaking of excess, Anne-Marie Horton joining us now, our Bloomberg Washington correspondent. Anne-Marie, I want to do a Friday take here to get to the Sunday talk shows, many of which you can hear on Bloomberg Radio. Anne-Marie, it's real simple. Where's the Biden reset? 2 years into an administration, every administration known to mankind, back to GW, resets. Where's the Biden administrative reset?
Well, if you're talking about a reset in terms of personnel, because usually you do see people leaving midway through an administration, which is 4 years, it's not happening for the sense of, I think, 2 reasons why. One is a lot of these foreign policy folks are still deep in the trenches of dealing with ongoing crisis, right?
Okay.
In terms of Russia's invasion of Ukraine. The other is that this is just a Biden aura, right? He does not get rid of staff. A lot of these people worked with him when he was in the Senate and when he was vice president and now is president. So you don't see him firing people, and it's hard for people to leave. I mean, that's really the truth.
This is the critical question then, and this is something, folks, over my entire effort here at Bloomberg, every administration has a cadence of debate. Obviously, with the former President Trump, it was truly unique. What is the day-to-day method and process of debate, Anne-Marie, in that White House you're standing behind on the lawn?
Well, I think the cadence of that has changed, right? They've lost the House now. So it's gridlock on Capitol Hill, and there's only a few things they can really focus on and get through. I would say that the start of their year, while it was going well, has been completely overshadowed by the documents that were found in the president's former office after he was vice president, as well as his garage in Wilmington, Delaware. That has really overshadowed and created a lot of headaches for the administration. But obviously, with a divided Congress, they cannot push for the legislation and the debates that they had wanted to have and the ones that they did have the prior 2 years.
MH, what is happening with that? What's the next steps in that investigation, if there is one?
Well, we're just waiting for the special counsel, right? There's 2 special counsels now for one president, one former president when it comes to documents. The President Biden talked about this yesterday, though. He said he has no regrets on how it was handled because what he says is that documents were found, lawyers were brought in, they were alerted to the National Archives and alerted to the Department of Justice. He's really trying to paint this picture with how we handle these documents versus how the former president, Donald Trump, handled these documents. But obviously, there's a lot of criticism and questions about the timeline of this, about why was there only a public statement after there was a CBS report, and tons of other questions. But the president yesterday said there's no regrets, but this is something the media will continuously focus on and ask him questions about. But really, the answers we're going to be looking for, we're not going to get until, the special prosecutor wraps up the investigation.
The timeline is odd, isn't it? Can you run us through that? So he left the administration, the Obama administration, seemingly went away with some of these documents and then ended up at Penn with the same documents. How does that work?
It's a great question. These documents, similar for the former president, these documents are the property of the U.S. government. It does seem like when boxes were packed, in both instances, in one, there was a lot more in terms of volume of documents as opposed to President Biden's. But these documents ended up in private residences as they packed up their offices. And the timeline, Jonathan, well, 6 years in terms of Biden's documents, right? Because this is when he left the Obama administration. They were, though, these documents, in terms of volume, a little bit less. But the timeline of them is interesting because, and this is what the press continuously asked the administration, they found these documents before the midterm elections. So Republicans obviously are going after the administration for hiding this, saying that this could have impacted the outcome of the midterm election. Biden administration says we were going with protocol, which is what we did.
Anne-Marie, thank you. Down in Washington, D.C., I imagine this story, Tom, is not going away anytime soon.
Yeah, well, it's there. I mean, it's a little bit off our radar of what we do here at Bloomberg Surveillance, but at the same time, can we learn what the documents are without giving away the secrets? That would help, I think, the debate for all involved.
No idea. I just wonder how this keeps happening. How does this keep happening?
I asked...
Can't make sense.
I asked, did it happen before, but nobody noticed that President Farrow in 1953 had a classified document by the telly as he was watching Man U win 4 in a row.
I wasn't born here, so that can't happen.
Okay.
Could happen for you, though, Tom.
It could have happened for me.
Could happen for you.
Zachary Taylor, I think, had a classified document.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it.
You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual.
I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Friday morning, good morning to you. Equity futures positive about 0.1% on the S&P. Just a little bit of a shift higher. Equity futures grinding higher by 0.4% on the NASDAQ. We'll touch on Netflix a little bit later. Crushing estimates. Crushing estimates.
Crushing.
I tell you what, Tom, trying to guess these subscriptions, Netflix is like blindfolding yourself and throwing a dart.
I don't...
It's just,
you know,
the
we'll
guidance
get
seems
there.
to be absolutely garbage.
I thought Jessica Reif era yesterday was great.
She was great.
Geetha Raghunathan is the same kind of micro data on this. My major decision is, do I start watching Wednesday this weekend?
What's that?
That's why Netflix is. Come on, John, you're
Wednesday.
so behind.
I've got no idea what that
Wednesday
is.
is a series, and it's like Addams Family,
Okay.
and it's like everybody at home's vet bill's watching.
I've got no idea. I was watching the football yesterday.
Well, I don't watch it
on Peacock. That's another rant.
That's
to
another
have.
rant to have.
Here's the bond market.
Wednesday.
2s, 10s, and 30s. Look like this on a 10-year at the moment. Yields higher by 4 basis points. 343.29 on a 2-year, up by 4 basis points. 416.39 in foreign exchange. Euro dollar. You saw it from President Lagarde this morning. Staying the course is my mantra for policy. Echoing Vice Chair Brainerd, we're determined to stay the course. They all want to stay the course. Euro dollar 108.36. We're positive. Not even a tenth of 1%, up 0.03%. I think you can say that's unchanged. The Fed's last word before the quiet period begins. Philadelphia Fed President Harker and Governor Christopher Waller set to speak a little bit later today as top officials. You've heard them so far. Lael Brainerd, John Williams, making a case for high rates.
Inflation has declined in recent months, but inflation is very high, and it's going to take time and resolve to get it back to 2%. Policy is going to need to remain sufficiently restrictive for some time to make sure it gets down to 2% on a sustained basis.
That's the punchline, TK. We're going to stay the course to get back to 2%. The body of the speech, though, that we heard from Lael Brainerd there is far more interesting. Just opening up to this idea, Tom, that perhaps it is possible, and I'll use her own words, it is possible that a continued moderation in aggregate demand could facilitate continued easing in the labour market and reduction in inflation without a significant loss of employment. That is what the soft landing is all about.
You didn't see this on radio, but what's important there in the Brainerd speech is where she did it. It was a Chicago Booth School, and of course, Chicago is the land of microeconomic studies. Jeff Curry of Goldman Sachs taught micro at Chicago, which is the height of economic acuity. And what's important there is all of microeconomics is about finding the ambiguities in the debate, and that's what she's addressing with this garbage phrase, soft landing.
That drives you nuts, doesn't it?
Drives me nuts. There's ambiguities out there that we don't know, and people like Brainerd can't get there until they see the data.
Soft landing is just an easy way of saying, can we get inflation down without having unemployment rise too much? That's basically what it's about. Can we get a reduction in inflation, a softening in the labour market without unemployment rising too much? And right now, Tom, unemployment's at 3.5%.
Yeah, my problem on this, we've got to get to our good guest here, but my problem on this, John, is soft landing doesn't describe the socioeconomic structure of 2/3 of America. 2/3 of America in some form is flat on their back right now, including 10,000 plus people at Google. Those people aren't having a soft landing, because there's a group of people, including John Farrow and Tom Keene, who aren't having, we're living at large. And this is this non-aggregate approach to the challenges Vice Chairman Brainerd has.
Dr. Alarian writes in, would you like to know what he says?
I'm afraid
Wednesdays. Daughters love it. I'm like John, got no idea what it is. But daughters love it.
I think, I could see in Cambridge that, they tune in to Wednesday this weekend. I'll do the same thing. And it's very
I don't know if I'm going to watch that, Tom.
Do
you know what? Maria today I just wrote in as well. The only thing to watch on Netflix, I Am Georgina. That is mom influencer, businesswoman, and Cristiano Ronaldo's partner. If that helps. Does that help?
Red needle, and all my radar's up on Witty because so many people are telling me bonds is the only comfort zone. Is that a consensus call, and does that concern you?
Hi, Tom. Thanks for having me. It is appearing to be a consensus call, and for two reasons, I think it makes a lot of sense. One, the economic data so far, including the one that came out this week on Producer Price Index, is indicating that inflation has peaked. So all of last year was too much inflation, bad for bonds. This year, very simply put, inflation's peaked, yields are likely to peak, and that's what we have witnessed in the last 6 weeks or so, yields coming off pretty sharply. The second point from a multi-asset perspective is that they're once again acting like a hedge. So this week we saw Wednesday massive sell-off in equity space and bonds rallied. So the old ballast question is back on the table again. They are attractive because data is indicating this and they're acting as a hedge.
Let me go right to multi-asset then. So many of our viewers and listeners are going to say, okay, but I'm pitched by advisors and such, this tranche of fixed income or that. How do you look at the choices to make in fixed income? Is it a duration choice? Is it a credit quality choice? What's the most important factor there?
Both are two levers that bond managers use in trying to beat the index. The fixed income duration is the hedge part right now because as yields come down, duration rallies, and that provides positive returns. And credit is something that we are quite nervous about right now because all indications are that we are having whatever the term might be, a soft landing or some sort of recession this year. And you want to stay in good quality credit. So we are underweight high yield, we are underweight sort of the riskier tranches of credit and staying in investment grade credit.
What do your equity people say? I mean, Columbia Threadneedle does it all, and I'm interested in the equity prism that you have more focused on multi-asset and fixed income.
Sure, that's a great question. In equities, things are a little more hard to pin down, really, because if we look at the valuation lens on equities, they don't seem to have fully priced in this recession fear that's out there for this year. So in the US space, our managers are staying fairly defensive. They like the good quality components of the US stock markets. But from a multi-asset space, we are seeing attractive opportunities to actually hold emerging market equities where we have a massive valuation cushion that's built up in the last decade or so. And at the same time, there are improvement in sort of the dollar view and the growth prospects from China. So we from a multi-asset desk are liking emerging market, particularly emerging market Asia. But in the developed market, we're staying high quality.
So we're trying to stagger to Q2. I think there's a huge unknown on Q2. You've been doing this for a few cycles. Are you able to frame out the fourth quarter of this year?
In terms of earnings, you know, the market's doing the standard kabuki it does every earnings seasons. Expectations are brought down pretty sharply and then they're beaten. And so far, that's all we are seeing in data. And I would say it's early days. Expectations for 4Q is that earnings will be down about 2% or so. And so far, with about 10% or so of earnings that have been released, they're beating those expectations. So we might end up, if this current run rate continues, with, you know, flat earnings to mildly positive. But expectations for the remainder of the year for 2023 are quite bleak. Earnings are supposed to go down.
Thank you so much. Enrique Bagano with us here this morning with Columbia Threadneedle. John, I'm only discovering this, John, on what is it, January 20 today? I can't remember.
What if you worked out?
I'm discovering,
January 20.
Listening to her on January 20, I'm discovering what I should have known December 30. Which is? Which is the huge uncertainty of the actual allocation of a retirement plan. I don't think after last year in the blow up, I mean, last year is at least as bad as 1974, and we had one guest, folks, this week allude back to 1788. I don't think anybody, you know, with the good efforts of Bagano's world class, anybody has a clue how to allocate after a 60-40 blow up.
I think to your point, Tom, to make up the losses, particularly on the bond side of the portfolio, how long is that going to take? Some of the damage done.
Well, I'm not going to give an opinion here, but guests are telling us 18 months, 2 years, 3 years. I'll go out a little bit farther.
How far
further and farther? I don't know. I don't know.
This.
Anybody who says they know.
Very presidential when you whisper.
Well, I'm whispering because I'm rich.
That is great. Have you seen that comedian?
This is a comedian in England, Jen Bristow, I think, who does it. It's absolutely hilarious.
She's fantastic.
She's very good.
Wednesday was fun, Tom Keene, but it was very 2022. You and Ferro should try Kaleidoscope. That from Barry Ritholtz.
Folks do this. We're having fun with this on a Friday as we get into the weekend. There's some serious tone here to talk about. What's important about this is afterthought applied to Nevermore Academy. I mean, we're
going to have to translate that. I don't know, what does that mean?
We were going to send her away to school. She has such a discipline problem, and she looked at Nevermore Academy along with Choate and the rest of them.
Do you think it stems from the fact that you call your child Afterthought?
Yeah, well, maybe, but she's still at home. We have
might be the essence of the problem.
Day-to-day supervision here at home, but it's just come on, it's Chittenden, it's in the Woonsocky River. It's sort of southwest of the Wobbly Barn in Killington. John, this is where Wednesday is.
I've got to make this serious for 20 seconds, can I?
Come on.
Netflix is up this morning. The stock's up by 5-6%. The company added 7.66 million subscribers in the final quarter of 22. Guess what the average estimate was on Wall Street? 4.5 million subscribers. It drives me insane, Tom. If you just look at the earnings surprises around Netflix, I mean, are we going to stop this guidance around this company? Because to try and project where subs come in just seems like all over the place.
Paul Sweeney owns this with 30 and 40 years of serious entertainment analysis. He says, look, it's a whole new world. And to Mr. Iger's defense and Mr. Zaslav at Warner Brothers Discovery, there's a mystery. Jessica Reif Ehrlich yesterday,
she's great.
She's plus on WBD and Netflix.
Did you want the post-earnings price action on Netflix for the last 4 before this one?
Yeah.
Up 13%, up 7%, down 35%, down 22%. That's just how wild earnings days are for Netflix.
John Tucker emails in. He can see you at the Wobbly Barn, with a Budweiser in your hand. I can just see it.
Oh, no.
John, at the Wobbly Barn, there's no choice.
Really?
Yeah, then there's a pickup barrel.
An Englishman can't have a Budweiser, Tom.
I know that,
That's
but
just like,
when you're in Killington, Vermont,
we have a word for Bud. I'm going to give you that in the commercial break. Kelsey Barrow's coming up from JP Morgan. Looking forward to that.
If she dares.
This is Bloomberg.
Can't wait to hear that word. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, Google is joining the list of tech companies drastically scaling back operations. Its parent Alphabet says it will cut about 12,000 jobs. That's more than 6% of its global workforce. Google has been dealing with a slowdown in digital advertising, plus its cloud computing division still trails Amazon and Microsoft. In Germany today, the U.S. and its allies are meeting to discuss more military assistance for Ukraine. The U.S. has unveiled a new aid package that includes 90 Stryker armored personnel carriers and 59 Bradley fighting vehicles. Meanwhile, pressure is mounting on Germany's Chancellor Olaf Scholz to deliver Leopard main battle tanks. President Biden says he has no regrets about his handling of the discovery of classified documents at his private office and his home in Delaware. Now, he predicts an investigation will find no wrongdoing. The president told reporters he's cooperating and, quote, there's no there there. International sanctions are dampening China's demand for Russian oil. Chinese imports of Russian energy fell last month to their lowest since March. In early December, the Group of Seven imposed a price cap on Moscow's oil. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
With the exception of Netflix, everybody is losing a lot of money. Linear pay TV universe is declining and declining quickly. And the viewers are going to streaming. They want to watch what they want, when they want. The biggest issue facing streaming is churn. And consumers, it's very easy to turn on and off these services.
One of the best in the last 24 hours. Just a brilliant conversation with Jessica Reif-Ehrlich there of Bank of America. From New York this morning, good morning. Looking at equity futures shaping up as follows on the S&P 500. Positive 1/10%. Yields a little bit higher, up 4 basis points. 343.29. The focus on Netflix, positive in the pre-market off the back of earnings, Tom, which just absolutely crushed subscriber estimates.
We're making it up as we go. Let's get right to it. This is an important conversation. We had a lot of fun with this. Thank you for the many comments on Wednesday and the rest of it. The Mandalorian's coming out, I think, for Disney Plus. There'll be a huge splash there as well. We're going to get some true perspective here, like Jessica Reif-Ehrlich from a true adult in the business. Geetha Ranganathan is with Bloomberg Intelligence, but far more links in the social and the behavioral of this new world of streaming and Netflix with the math and the finance. Geetha, thank you so much for joining. With the uproar this morning on Wednesday, I will actually start watching Wednesday this weekend. Are Netflix's world, their numbers streaming, is it adjusted by binge viewing? Or is there any whisper of a Netflix that is like CBS and Gunsmoke 3 generations ago?
It is not adjusted for binge viewing. I mean, I think that if at all, they've really benefited from binge viewing, that this is something that they've spoken to always. And, you know, this is why we're seeing some of the biggest numbers, because they kind of give customers that choice, that ability to watch all episodes all at once. And I'm going to join you on Wednesday. I mean, this has become one of their biggest English language series after Stranger Things' 4th season. And, you know, yeah, it just kind of speaks to the power of their content, which I think was the main driver of that 4Q subscriber blowout.
The subscriber dynamics, do you see a trend, or is there so much noise, tumult, turmoil that you need more quarters to understand a stable vector of subscribers for Netflix?
I think there's going to be a lot of volatility, and I think the company understands this as well, which is why they're going to stop, or they have already kind of stopped providing guidance going forward. There are just too many different initiatives right now in the works, whether it's that new ad-supported tier, whether it's the crackdown on password sharing, and they kind of expect a little bit of bumpiness down the road as well as they kind of implement all those new initiatives. So yes, it is going to be a while before we kind of reach that steady state, if you will. For the longest period of time, we thought it was going to be this 25 million subscriber ads year after year until, you know, we kind of had that whole meltdown last year. So at the end of it, they actually posted 9 million subscriber ads for 2022, which is actually pretty good. But now as we kind of look forward to that number, where everybody's kind of trying to parse out what that number is going to be going forward as they kind of try to piece together their models, it's probably going to be anywhere from about 15 to 20 million is what I'm thinking. But again, it's hard to say with any huge level of conviction at this point.
Geetha, let's talk about austerity. It's hitting big tech. You can see that in Google this morning, 12,000 jobs to go, 6% of the global workforce. Has that austerity hit the streaming industry yet?
It hasn't, but it has to. And Netflix has kind of been the first example there in terms of paring down on content costs, which is really one of the biggest, cost centers for them. So they've kind of, taken that down to, it's about $17 billion is what they've kind of projected. The big question now for the rest of the streamers is, first of all, the rest of the streamers need to follow suit. Netflix is the only one, as Jessica Reif-Ehrlich pointed out, Netflix is the only company here that's actually making money. They generated about $5.6 billion last year in profits, while the rest of the streamers made about $10 to $11 billion in losses. It's going to be a similar situation again this year, but what we're seeing Netflix really do so effectively is not just bear that content budget, but also go after non-content costs. So whether it's marketing, whether it's, technology and development, whether it's other, operating expenses, we're kind of seeing real leverage there. And that is something where, Disney now really needs to execute. Warner Brothers Discovery really needs to execute. Kind of with that subscriber land grab phase coming to an end, they really need to see where all they can kind of trim costs.
Can we just build on strategy around the content? So if content spend is under pressure, can you tell me how that shapes the kind of money, the kind of content they spend money on, and how that content is ultimately rolled out? Does that change going forward?
I don't think it changes dramatically. I think Netflix, the reason we saw them kind of burning through $3.5 billion in cash just a few years ago, kind of spending so much upfront, was because they were kind of preparing for this day as they kind of made that shift from licensed content to originals. So a lot of their upfront investment is already done. And they kind of have now fine-tuned their algorithms, fine-tuned their formulas, their AI to kind of see what content actually resonates. And we saw great evidence of that in 4Q. Multiple titles performing so well, whether it's Wednesday, whether it was, Knives Out. And they actually said that 2022, five of their 10 most watched series ever actually came in 2022. So I think investors are now kind of finally comfortable with the idea that Netflix has that formula. They have that magic equation to produce hits.
Geetha, that's brilliant, and I see it, frankly, in the Keene household. It's certainly been a Netflix Q4 in terms of, what everyone's watching. And Geetha, to me, it's about the margin. In the old world of Brian Roberts and Comcast, there's 30 cents on the dollar down to EBITDA. Netflix has modeled out a very successful lower EBITDA margin of about 20 cents. Do you have any confidence at all that their brethren can get to a 20% EBITDA margin, or are they all going to be taken out by 3 lone survivors?
Yeah, that's a great question, and that's the the big head scratcher right now in the industry. So they've already achieved 20% margins. They're guiding to about 22% for 2023. And yes, it's going to be a very, very long road to profitability, because at this point, nobody's making money. Other than these guys, nobody's making money in the business. Yes, we do finally see this kind of light at the end of the tunnel where a lot of these companies will probably get to that 20% margin, but it's going to take a while.
Okay, I don't want to put you under any pressure. Nobody's listening this morning, except Muhammad was listening, but he went over to start watching Wednesday on Netflix.
Is that what he's doing?
Yeah. Geetha, who would Netflix buy? Give me the Geetha Ranganathan fit. I wasn't rude to Jessica and did this. I'm going to be rude to you. Give me the single best buy for Netflix now to really make a consolidation splash.
I think they've already kind of got the content piece. I think what they really want to go after right now is gaming. So probably a gaming studio, but we'll have to wait and watch what happens with Microsoft, Activision, and then there are so many targets that kind of come up. I think the one area that they feel that they can, because remember, the one thing that they really want, and everybody in the streaming industry wants, is engagement. And that's exactly what you get with video games, kind of that captive audience, people spending 2-3 hours at a stretch. And that works perfectly for a platform like Netflix.
Geetha, wonderful, as always. Geetha Ranganathan there on Netflix and beyond. The stock is up by about 6% in the pre-market. Tom, after absolutely crushing subscriber estimates.
So that's like Call of Duty and all that stuff. It's like where kids sit at home.
They just, to Geetha's
do you do
point,
this? Do you do gaming at home?
Absolutely not. Do you want my rant on gaming? Let's save that for another time. We'll save that for another time. I think once you get to a certain age, you shouldn't have a games console, but that's just my view.
Be careful.
There is a whole industry dedicated to get people to stare at a screen, Tom, so they can sell whatever they want to sell around.
That's the game.
That's the game.
That's the game. Yeah.
It doesn't matter if it's content or gaming. It's the same thing.
My answer here is, and I feel like I'm channeling Robert Iger of Mr. Iger of Disney. It's still about content, and as Geetha said, what we can say now that we couldn't say 90 days ago is that Netflix right now is hitting the ball out of the park. They have this one. I don't know what they are. I mean,
Austerity. Can we discuss that just a little bit more?
Yeah, okay.
In Google, in
British
Microsoft, in Amazon, they're all starting to cut back. And to Geetha's point, they're going to have to cut back on content too, Tom. I wonder if it does change the way things are rolled out. Are the days gone where they just used to dump the whole series all at once? You could binge it in a couple of days.
Disney's working
and move on.
I sort of like the way Disney does it. I'm sure they'll do this with Mandalorian, where you sort of know in your head in your busy week that on Wednesday or on Friday,
episode's going to drop.
It's going to drop, and I'm speaking as an amateur, I think that's where the industry's heading rather than the binge thing.
Isn't that what they did with House of Dragon? I think it is.
I never saw that.
Did you not watch that?
No, I didn't.
But I thought you loved Game of Thrones.
I just, there's only so much time. I'm like everybody else watching this. Where is the time to watch this when I am riveted by the excellence of the Tottenham Spurs?
Oh, were you riveted by that yesterday?
Riveted.
We've got a minute left on the clock. Do you want to talk about Spurs City?
I didn't watch the game. I watched carefully the afterwards. They don't have a defense. Forget about the goalie. Blame the goalie. Shoot the goalie. No. Where's the defense?
They've got one good defender.
Which defender do they need to buy?
Romero. They've got one good defender.
But who should they go out and get? Help.
It depends how much money they've got.
Oh, come on.
I don't know what the budget is. I don't know
Call
if Antonio
up Adele.
Conte's going to stay.
Call it. They could do a concert with Adele
with
there.
With Adele to raise
Adele
money.
could do a concert.
You want to do a fundraiser with Adele so you can buy a defender.
Do a fundraiser. Emma Raducanu can show up.
Is that what it's come to for Spurs? Is that what it's come to for Spurs? Fundraiser for transfers. Okay.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
There are
too many problems that investors have to overcome in the first half of this year.
Now we're starting to see more dispersion in the data, in the economic outcomes.
It's going to be a harder environment to see fiscal and monetary response, and we think that leads us to an equity market that can have some healthy declines this year.
I think we are very much revisiting more normal dynamics now.
The story this year is the earnings risk and the recession risk, not the inflation risk anymore.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide, this is Bloomberg Surveillance on TV and radio. Good morning to you all. Alongside Tom Keene, I'm Jonathan Farrow. Equity futures on the S&P totally unchanged. The headline of the morning so far, TK, comes from Google, cutting 12,000 employees, 6% of the global workforce to go.
It continues. You know we're going to see a lot more of this, and I think far more importantly, within other sectors away from tech and the luxury tech has had for 10 years, you're going to see 2 and 4% kind of cuts from many, many other companies, some of which won't even make the news cycle, but they're out there. It is a layoff America.
Doesn't this feel like the banks after the financial crisis, Tom? All that excess and then just cuts, huge cuts, tens of thousands, 20,000.
I mean, we've addressed this across the show today, and folks, we're doing asset allocation here, really in the first two. Like, what are we doing into February? John Golub and who do we have? Hollenhorst is with us in the next hour?
I believe so, yeah.
That's the interview of the morning.
Cassie Barrett coming up in 30 minutes too.
Yeah, it's going to be interesting as well. But to get back on this, John, there's a shift going on, and Silicon Valley's not the banks. It's an attitude adjustment.
Sure.
And this is the word, and you know I hate this word, we're going to innovate. John and I haven't innovated in like 30 years. It's the same thing as they were doing 40 years ago.
So let's clarify this.
Innovating.
Let's clarify this. I'm certainly not saying it's the financial crisis. What I am saying is you've got one industry that has built up a ton of excess, not just over the last 2 or 3 years, but over the last decade, Tom. They've had money thrown at them. To your point, they just scream the word innovate. Here's some money. I'll write a blank check for you. Those days are over with rates through 4%. Those days are gone.
Shonali Bassett keeps next to her desk. It's white walls here, pencil all the buzzwords that she gets from Wall Street.
Innovate.
And bankers. Innovate is about 20 words.
Disruption. Do you remember disruption? Disruption. The disruptors.
You know, there's others we make
I tell you the
fun
phrase
of,
at the moment from the C-suite in
Yeah.
Silicon Valley, this one right here. I take full responsibility for the decisions that led us here. That is coming from Sundar Pichai this morning of Alphabet. We have heard similar things, Tom, come from Salesforce. We've heard similar things come from Satya Nadella of Microsoft this week. Satya Nadella of Microsoft, I think, is being so upfront, Tom, about the challenge they face, not just the rest of this year, but for the next few years. They're being very, very open and transparent about it.
Here's the Google comment from Alphabet, I should say, excuse me, as my folks pa, I should say Alphabet CEO, full responsibility for the decisions that led us here. These are important moments to sharpen our focus, re-engineer our cost base, and direct our talent and capital to our highest priorities. Does this mean they're going to get rid of Google Glasses?
You think that's what's going to go?
Is that,
to your point, you joke, but ultimately there was that division where it was like to throw money at the wall and see what sticks. I don't think people have the luxury of having those big divisions done where you can just throw the money at the wall and see what sticks.
Under the radar today, Ed Ludlow told me this, there's the virtual reality silliness. Okay, and Apple's
getting in on it.
Pulling back. They're doing some kind of, Mark Gurman, I believe, has a reporting on this. They're doing a low-cost idea. What is that about? They're listening to there's no audience. And that's what Google and the others are dealing with.
There's a rate story here as well. Vice Chair Brainerd yesterday, we're going to stay the course, determined to stay the course. President Lagarde this morning in Davos, Switzerland. Guess what? Staying the course is my mantra for policy.
Are we staying the course?
We're going to stay the course, hopefully, through to 9 a.m.
Try to
Eastern
get to
time.
9 a.m.
After 9 a.m. Mohammed's coming up a little bit later.
Oh, we have, I have
great
Mohammed.
lineup. No, I have Mohammed.
Oh.
Great lineup in the 9 o'clock hour. Do you want to hear it?
Oh, please.
Al Arian, just to open the hour. And then to close the hour, Robert Koenigsberger of Gramercy Funds on EM. On EM, so it's going to be very, very cool.
That's good.
You looking forward to that?
Yeah.
You can drop by from radio and join in if you want.
I think I've got Tuesday to talk about Wednesday.
Equities right now on the S&P, just about unchanged. Futures positive by almost 0.1%. No real drama here. Yields a little bit higher by 4 or 5 basis points on a 10-year. 343.84 is where your 10-year is at the moment. And no real drama on euro dollar, 108.24. Though, Tom, you've said it. Look at crude. It goes from 80 to 81. $81.04. We're up 0.9%.
Will Kennedy was great on this the other day, $86 on Brent crude, and that's the quiet story here of a persistence in oil discussed at Davos. You know what? It doesn't matter about the great and mighty at Davos. It's about EM recovery, and that seems to be the mystery.
Let's start the market conversation right now. We can do that with Tracy McMillan, the Global Head of Asset Allocation Strategy at Wells Fargo Investment Institute. Tracy, great to catch up with you. I think you've picked up on a theme that I'd love to talk about. What's bad for the economy is good for the stock market. That mentality has persisted for a long, long time. Have we finally crushed it to pieces?
So we do think that investors are now focusing on growth as opposed to bad news is good news, and that will change the direction that the Fed is taking with interest rates. But we have a Fed here who's not backing down, and as you mentioned, we have an ECB that's not backing away either. So investors are really realizing now that a serious growth slowdown is probably ahead of us, and that's consistent with our view that there's probably going to be a recession later this year.
Tracy, Wells Fargo Economics has a glorious heritage of measuring the American unemployment, the American labor situation. The numbers yesterday were stunning. We have, I believe, a fully employed America, and then there's a debate about that. How do you asset allocate if you believe at some point labor breaks and becomes a higher unemployment?
Yeah, so the way that we have been positioned really since about March of last year is overweight fixed income, underweight equity. So we're taking that more defensive approach, but we're not completely out of equities. And we are allocating within those broad asset classes. So within fixed income, we like investment grade over high yield. And specifically, we like short term and long term over intermediate term. And we see that short term in particular is a source of funds for equities when the time comes to put money back into equities. We just think we've got to get further through this cycle before we do that.
This is critical. You say further through the cycle. Is it further through a corporate earnings revenue cycle, or is it further through the Fed Babel central bank cycle?
So actually, those two are in some ways going hand in hand. Of course, the Fed policy will lead the corporate earnings cycle, but the Fed policy cycle, we do think will probably end early this year, and they'll pause and potentially even start cutting by the end of this year. And that's consistent with history and how they raise rates. Then earnings tend to be hit afterwards, market bottoms, and then the Fed starts cutting. So that's the cycle that we're anticipating this time. We don't necessarily think it's different this time. We don't think that we're necessarily going to see that soft landing or Goldilocks scenario. We think we've got to go through this recession.
Tracy, as we speak, Neil Dutter of Renmac writes in, a serious slowdown with initial jobless claims cratering to fresh lows, ? Tracy, how is any of this consistent with what we're seeing in jobless claims in America at the moment, which yesterday came in at 190,000, which is exceptionally low?
Yeah, so we do think that there is going to be, like I said, a contraction, a recession, but it doesn't necessarily mean that jobs are going to crater. We are starting to see layoffs in the tech sector. We're seeing layoffs in those industries that really overhired during the pandemic, and we think that will filter through eventually to other industries, other sectors, as we move through a period where their earnings just can't sustain the workforces that they have. So we do see unemployment in the 5% range by the end of the year. That's not cratering, but it is a slowdown in labor.
Where's the growth backdrop against that?
Yeah, so the growth is probably going to be in areas where there's more pricing power. So we like things like energy, we like healthcare for the defensive posturing, and believe it or not, we actually like information technology here at these prices. We do think that longer term, what we're going to see out of information technology is companies moving more towards technology to supplement a labor force that is likely to have low participation for a very long extended period of time. It's a demographic shift.
Is it too early to make that move to tech, given the cyclical challenge they might be facing? Look at the decisions they're making right now. Those days of that secular story seems to have faded. This seems to be about the cycle now, the discipline of 4 or 5% interest rates. Are you worried about that?
So we are. Of course, interest rates are hard on companies that depend on growth. And certainly technology is among those sectors that depend on growth. So as we move again through this cycle, we do think that interest rates are going to come back in a little bit, and that is going to provide support. But we also see it as a longer term kind of play. So we would be dollar cost averaging in here, but we wouldn't necessarily be overweighting technology significantly.
Tracy, thanks for being with us and giving us your thoughts. Tracy McMillan there of the Wells Fargo Investment Institute on the challenge at the moment, Tom. You've got bond yields lower off the back of people worrying about the economic data in our present and in our future. So you've got to think about, do I get the valuation relief off those lower yields in tech, or do I get the earnings headwinds off the reason why those yields have been lower in the last couple of weeks?
On a Friday, you look at asset allocation because that's what everybody's doing. And it's not funny, John. It is a weekend where you have to readjust your 201k. That's what everybody's doing in January. I haven't said that in years. You know, we used to make a joke about it, John Tucker and I. But Tracy's dealing with a bank with thousands of 401ks that are now 201ks. What's the line? And what I heard there is wicked cautious.
And everyone's saying fixed income. Tom Pilot,
It's scared.
the bid into
All my
fixed
radars
income.
up. All my radars up on this consensus bet.
Do you get frustrated by the fact that the mood seems to change, whether the market is up or down? We have a down week and all of a sudden it's about the damage done to GDP off the back of monetary policy tightening, and you have 2 weeks, 2 weeks of gains, and it's all about China reopening.
That's the parlor game. But the people in asset allocation are out there trying to sell a message for a big bank. I mean that in a constructive way.
They're trying to sell fixed income.
They're trying
Let's
to
be
sell,
very clear about that.
They're selling caution after the carnage that's led to my one. I mean, I have a 101k. Forget about 201k. Look at the Wayfair headlines. Squeeze them in, John.
10% of the global workforce
Wow.
to go, Tom.
Wow. And that's not tech.
1,750 employees. Includes 18% of corporate employees
Wow.
as well. I've heard a lot of people frustrated this week about the decisions the C-suite are making at the financials. What you hear from the big players on Wall Street, the cautiousness, the conservativeness, and then at the same time, you hear the bullishness from the research departments.
Yeah, I think there's a bit of a I think there was a separation at Davos as well. Yes.
You witnessed that too?
I witnessed that.
The happy talk in Happy Valley?
From a distance.
Yeah.
Nancy Griffith moment.
Did you miss that this week? I have not missed that this week.
I missed it terribly.
Did you?
Frankly,
I have not missed the
fresh
happy
air,
talk in Happy Valley.
Equities barley soup at $40 a cup.
Nice. Futures positive a tenth. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The parent of Google has become the latest tech giant to retrench after years of growth and hiring. Alphabet will cut about 12,000 jobs, more than 6% of its workforce. CEO Sundar Pichai says the cost will affect jobs across the entire company. Pichai says he takes responsibility for the decisions that led Alphabet to this point. The Biden administration is sending another major package of military hardware to Ukraine. It includes 90 Stryker armored personnel carriers, 59 Bradley fighting vehicles, and millions of rounds of ammunition. The package is valued at $2.5 billion. The U.S. and its allies are meeting in Germany today to discuss more aid. The Supreme Court says it hasn't been able to identify who leaked its opinion, overturning the constitutional right to an abortion. During an 8-month investigation, the court's aging computer system was examined and 97 employees were questioned. The court called the leak a grave assault on the judicial process. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
best of financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Earnings season is here.
Wall Street expecting a bit of an ugly season.
People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
What people assume is that there's going to be a lot of drama, but in the end, the debt limit will be raised in time. Now, so what that means is if we mess up even just one time and don't raise the debt in a timely way, it's going to be a huge market surprise. So you go from thinking that the probability of default is 0.01% to all of a sudden there is a technical default. It'd be a huge blow to financial markets.
Bill Dudley there, the former New York Fed president and current Bloomberg opinion columnist. Great to catch up with him. From New York, equity futures up about 1/10% on the S&P 500. Yields a little bit higher by 4 basis points on a 10-year. Your 10-year looks like this, 343.47. Tom, on the 10-year right now.
Well, there it is. And it's churn the market. I don't know. We were down yesterday. We were going to go to 3.99 on the 2-year yield, and we've walked away from that.
Sure.
Yeah.
But we've had a big move lower in the last couple of months, that's for sure.
Yeah, absolutely.
But I'm with you. Back to about 417.
I'm not sure what we're doing with Sonali Basak, but she is, with the uproar in Bitcoin, she's coming in. The Bitcoin itself is 21,000, hasn't done much, but the news flow in crypto is absolutely extraordinary. Look for our crypto expertise, I should say, on Tuesday, where they'll sum what is a moving story. Right now, in Washington, there is a moving story. Anne-Marie Horton joins us right now on the president's weekend. Does the president go to Delaware to go into his garage and look at selected papers? I mean, I'm a little bit lost here. They used to go to Camp David, used to be what you do. Nobody goes to Camp David anymore. What's a president's weekend look like?
Well, there are still some trips to Camp David, but yeah, they are much less numbered than, say, the president going to his home in Wilmington or in the summer, Rehoboth Beach in Delaware. He does like to go home on his weekends. We saw this with the former president. He used to go to Mar-a-Lago, his golf course in New Jersey. He's not going to go home looking for documents. I mean, the White House has made it pretty clear that now they believe that this is in the hands of the Justice Department. There's a special counsel. Mr. Hur is going to be handling this. But the president commented on yesterday saying he had, quote, no regrets about how it was handled. But there are so many questions, obviously, about this. And someone actually writing into me after the last hour saying also their question is really about why were the documents found in the first place? What were they looking for? But this administration is going to want to really make it clear, black and white, how they handled it versus the former president.
The reason I brought this up, Anne-Marie, is this is the weekend where he decides to run for office. And I don't understand this. Does the present president have to wait for the former president to announce he's running for office?
Well, the former president has announced he's running for office.
But I mean more
We haven't seen a lot.
Yeah, makes a bigger
maybe more
splash
announced,
about
meaning, maybe have some rallies, etc. I mean, a lot of people are thinking potentially, will the former president drop out? You haven't heard a lot from him. But the end of this month, he'll be holding something in South Carolina. They are starting to send out, at least on the campaign side, not his Truth Social, but send out a lot more emails and advisories about this. You know, there was a recent poll, though, from Suffolk County and USA Today about 5-6 days ago that showed that if it was between these three people, and I'm adding DeSantis in this, President Biden would still beat Trump, but Governor DeSantis has a narrower margin over President Biden. So We are waiting for everyone to get in this race, and we still have time.
What did you learn about Ukraine this weekend? It is a jumble of threads, I would say, Anne-Marie, which is like any war. You're going to get different threads in this. I was struck by all of a sudden the word Crimea is coming into the dialogue as well. But you are glued to this story. Inform us on what we need to know into the weekend about a war 1 year old.
Battle tanks, Tom. I mean, today, really, you have this defense contact group meeting in Germany. Lloyd Austin, the U.S. defense minister, is there. And there's this public spat. I don't think they want it to become public, but Germany, and the reporting is that Germany is pretty much saying, we will not supply Leopard 2 battle tanks or not allow other countries to supply them, like Poland, which already said whether or not Germany gives the okay or not, we're sending them. Germany is saying we will not send them unless the U.S. sends their Abrams, which is almost comparable, or it is more of a wartime battle tank. This has now become out there in the public, and what you had from the economy minister, Robert Habeck of Germany, saying that it would be much easier for Germany to do this if the U.S. was on board. Now, there are logistical and technical differences between these two that if you talk to defense experts, they'll say the Abrams have a jet engine, they need a lot more fuel. The Leopards, there's hundreds of them. Tons of NATO countries have tons of these tanks. But you can still see that reluctance in Germany, right? They had forever this foreign policy with the former Soviet Union of Ostpolitik, building these commercial bridges, not being too defensive when it comes to Russia. They have made a massive U-turn, and you can still see them lingering a little bit when it comes to these decisions because they don't want to provoke Russia and that this spreads outside of Ukraine's borders.
So which one is it? Who's hesitating here, Anne-Marie? Is it the Germans or the United States?
That's a good question. At this moment, it feels like it is the Germans hesitating because you have other countries like Poland saying, we will send those Leopard tanks, but because they're German-made, we need Germany's sign-off, or Germany saying that they would need to give that sign-off. So if you have countries already lining up, waiting to send them in, and they're waiting for Berlin's green light, and that's not happening, I would say at this moment it does look like Germany is the one that is hesitating. Although we did hear from Boris Pistorius, who's now the brand new defense minister. He's been in the job 48, 72 hours, and he said he wasn't aware of such package, meaning this deal of I'll send the Leopards if you said the Abrams. So potentially, let's see what the news is out of the contact group today at Ramstein, and if not, this debate will go into next week.
Anne-Marie, just out of interest, just to put two stories together, does this debt ceiling debate and how money is spent in this country shape how this war in Ukraine between Russia and Ukraine is supported by the United States?
Well, we saw more than 2 million already draw down this week from to go to aid to Ukraine, but there is a linkage because what you have in discussions in Congress and these backroom deals McCarthy was making is that they want to cut spending, 130 billion at least. And there are reporting, especially from us, that potentially this could be defense spending. Potentially that means aid to Ukraine. Now, potentially this will not be an issue for 2023, but certainly if this war continues into 2024 and 2025, this is going to be a major discussion.
AMH down in D.C. Anne-Marie, thank you. As always, the latest from Senate Republican leader Mitch McConnell. He said the following: periodically, the debt ceiling has to be lifted. It's always a rather contentious effort. He went on to say, Tom, in the end, I think the important thing to remember is America must never default on its debt. It never has, and it never will.
It's as straight as you can get, and this,
it's always bizarre. Every single time we do this,
and it goes back. I mean, the history of this is real simple. It was up to 1917, up to the realities of World War I. Congress controlled it in a traditional way that we learn in civics class or social studies, whatever you want to call it. And then it was amended through the Depression and the crisis of that. And in 1939 and 1941, they changed the rules. It's just as simple as that. And that's where this started in. And particularly for our international audience, and John, I think this is very foreign to the British process, there is a huge politics here wrapped around not so much religion, but just what is debt? Is debt evil? Is debt good?
Well, it depends if you're in power or not, right?
And Rogoff and Reinhardt, capture this in their wonderful book, and there's others as well. But is debt evil? Is debt good? This is a moral thing that folds right over to particularly Republican politics. I'm sure there's Democrats that feel the same way, that debt is evil.
We try and talk about this with anyone in the bond market right now, Tom. They just shrug and say, can we talk about something else?
Yeah, Brian Weinstein.
And the question we're asking, is it different this time? Kelsey Barrow is going to join us shortly. Looking forward to that. Portfolio manager at JP Morgan Investment Management. That conversation coming up. Equity futures right now up 0.1% on the S&P. No real drama here with Tom Keene. I'm Jonathan Ferro. This is Bloomberg Surveillance.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Live from New York, equities up 0.1%. Here's a flavour of the price action for you on the S&P and on the Nasdaq too. On the Nasdaq 100, positive right now by 0.5%. Equities pushing just a little bit higher. In the bond market, 2s, 10s, 30s. Look a little something like this. Your 10-year in the 330s a little bit earlier this week. Right now, 343.29, up 4 basis points on a session, but down and down hard from where we were back in October at about 433, 434. In the FX market, Tom, we look a little something like this on euro dollar. Not doing much this morning. We're down 0.1% or so at 108.19. And President Lagarde echoing the words of Vice Chair Brainerd yesterday. Vice Chair Brainerd said we need to stay the course. We're determined to stay the course. And President Lagarde this morning said staying the course, Tom, is my mantra for policy.
Let's go to the real yield and in curve inversion. We've got a greater curve inversion, John. We're not out to negative 80 basis points, but on a moving average basis, the curve inversion 2s10 spread has my attention, negative 73 basis points, a difference in yield of 0.75% between the 2-year higher than the 10-year. And John, all of a sudden on this Friday, can we consider a 10-year real yield that would fall below 1%?
That would be interesting.
We haven't framed that
Would
yet.
the Fed push back against that if that started to develop?
They'd have to. I mean, I got a Bloomberg Financial Conditions Index, which is anti-Powell, and if you get a continued diminished inflation-adjusted yield, what do they do February 1st? Hollenhorst in the next hour will discuss
Looking forward to that. Clearly, those high real yields are starting to bite in big tech. Let's take a look at 2 names for you and start with Alphabet. Google cutting 12,000 positions. We're talking about 6% of the workforce. The stock reacts positively to that, up 3.6%. And Netflix, Tom, up in the pre-market by 6 or 7 percentage points, just to go through those numbers again. The company added 7.66 million subscribers in the final quarter of 22. The average estimate was about 4.5 million. And I've gone on a rant about this before. The estimate game is just shut your eyes, throw a dart, and see what it lands on.
Yeah, and I wonder if it's a password thing where they started getting stricter about password. I mean, VetBill uses my password.
Maybe.
You know, I don't know.
I'm going to crack down on that a little bit more.
The scope and scale, I'm going to bring this up, and so somebody can tell me I'm wrong. Google is 10 times bigger than Wayfair. Google's got 180,000 plus employees. Wayfair has 18,000, and I'm watching the Wayfairs of the world. Google gets all the press and
10% of the workforce.
Amazon and all that. I'm watching the cumulative Wayfair into the earnings season.
I'm comparing it to jobless claims at 190,000 and wondering when it starts to show up.
Yeah,
it's pretty impressive that we're still at 190,000. We see headlines like this, left, right, and center.
Should we move forward?
I would like you to, yeah.
I think we should. What we're doing here is we're talking to people about asset allocation, but that rolls over into hardcore, careful strategy. We enjoyed a lengthy conversation this week with Mr. Michael of J.P. Morgan. I thought he was informative. Why don't you bring in our next guest, who has a diametrically opposed view to Bob Michael?
Kelsey Barrow, I think on the same page, portfolio manager. Kelsey, it's wonderful to catch up. You've heard all this communication from central banks worldwide, from the ECB, from the Federal Reserve as well. Have we seen peak rates, and how far can this Fed take things?
Yeah, so I do believe we've seen peak rates, particularly as it relates to the long end, 10s and 30s. But there's this motto, higher for longer, right? I think this higher for longer motto could be the new transitory. So let me explain exactly why. So the Fed was saying transitory, transitory, transitory. Inflation is transitory. The market didn't believe it. They looked through it. They priced ahead of the Fed. They pushed the Fed to hike more. Now we're seeing actually the reverse. The market is saying, let's keep rates higher for longer, higher for longer, higher for longer. And what is the market saying? I don't believe you. It's pricing in rate cuts. It's already seeing the data roll over. And so the Fed's going to keep trying to communicate higher for longer, but the market is already looking through it. The market is leading the Fed on the way up and leading the Fed on the way down as well.
You think the market's right?
Yeah, I do think the market is right. I think the market is seeing things in the data. You highlighted is a manufacturing. It's been below 50 for 2 months. We don't just look at the headline index. We dig into the numbers. For instance, you look at the ratio of new orders to inventories. New orders is falling. Inventories is rising. Not a good situation for companies. That level has never been this depressed outside a recession. I think it's just a matter of time before we see in the initial jobless claim numbers what we're seeing in the rest of the economy.
What do you see in vanilla corporate debt? You don't remember when there was a blue S&P book and you'd thumb through it to see what Boise Cascade was doing with their massive 3% coupon. But corporate debt matters, and now there's a lot of issuance as well. What's that dynamic? How do we take advantage of that?
Yeah, so we do see a lot of opportunity in investment grade credit. We think that the yields there are attractive to get invested, and we're staying very high quality.
What's a typical yield there? Very high quality corporate.
So you can get between 5 and 6%, you know, depending on the maturity, depending on exactly.
Yeah, that's almost what triple leveraged all cash does. I mean, it's not there yet.
How's that portfolio doing,
It's
Tom?
doing good. I mean, it's really out there with a nice pop, but netted to the twos 20s take. It's,
Crazy inflows for you last year.
It was amazing, but if you take out the 2 and 20 fee on the triple leveraged all cash, it doesn't get down to Kelsey's.
We need to talk about high yield. Never mind IG. You've talked about where you're at on this economy. Some people might be different. They might look at jobless claims and say we're still resilient. What recession? You're on the other side of that. I get it. So Treasury yields have peaked. You think ultimately the Fed can't go as far as it goes. Got all of that. What business does high yield have rallying in that world?
So we were talking to our portfolio managers within our high yield desk this week. And yeah, I mean, we were getting that same sense. We're not seeing huge demand into high yield so far this year. What we're seeing, I think, is more technically driven. There's no supply. So essentially, the people who are looking to get invested are just driving spreads tighter. It is incongruent with the data that we're seeing. I think it is more technically oriented. And we're still staying defensive, looking forward to what the data is telling us and what company earnings are going to say, which, you know, we're not particularly constructive on.
So this is just the sales force that all these big asset managers going around saying, buy fixed income. It's all the inflows in the new year coming into fixed income funds. Ultimately, you think that's going to fade for some of these credit stories?
So when we say buy fixed income, we're focused on high quality. So when you think about somebody investing into the aggregate, that's generally treasuries, mortgages, and investment grade. And so, yeah, the whole spectrum of the fixed income universe is going to benefit from those flows, undeniably. But, you know, when we're thinking about adding duration to portfolios, you have to think about not just the mathematical calculation of duration, but the empirical duration. So how does it actually trade when treasuries rally and there's a flight to quality, safe haven bid? Investment grade is going to get capital appreciation. Prices are going to go up on those bonds when it's risk off. High yield, if spreads are blowing out, you're not going to get that.
And you expect high yield spreads to blow out this year?
So we are still anticipating a widening of high yield spreads when that recession comes. And timing that recession is difficult, but when we do see that recession, spreads tend to widen to at least 800 basis points.
Guys like you at 60,000 square feet. Kelsey, I love to go to the individual. I'm looking at a high quality piece, which I bought, John,
what was
at
that?
par. It's like this close as I get to golf.
Was it the Century Bond in Austria?
No. It was better than that. And I've enjoyed the Google piece of 50 this century, okay, 50. So I'm out 30 years-ish, 2.2% coupon, 2.05, and I've seen a price reduction of 100 down to 64. Is that an opportunity? Something like that? Is that high-quality corporate when a ginormous company like Google is on sale for 30, 40% under where it was?
Yeah, so, you know, within the bond market, to kind of translate that, one of the attractive opportunities that we've been finding is when yields are rising, you're having a lot of bonds that you can buy below par at very discounted dollar prices. And so, yeah, those are opportunities. And we want to be investing in companies where we have vision on the cash flow. We know what they're doing in terms of leverage.
Right. I mean, and then I want to be fair here in that Bob and Kelsey are not in the individual name. That's not their mandate at J.P. Morgan is not to give us individual names. I'm just picking this out, John. I don't think our audience understands yields up.
Price down.
100 to 63 on a 30-year piece at Google, which is not a high-yield bond.
Do you want to take the 30-year piece at a tech company? Can we make it broader than that? Is that the kind of risk you'd want to take?
So I think that we were generally all of last year very focused on keeping both our duration risk and our spread risk concentrating in the front end of the curve. So minimizing the interest rate sensitivity of our portfolios. We thought yields would be rising, and of course those longer end bonds are going to get hit the most. Now that we're kind of in the reverse of that story, I think that you can feel more comfortable extending out the curve and extending duration of your portfolios to those 10-year and those 30-year high-quality instruments.
Tough times ahead. 25 or 50 at the next meeting? 25? 25. Yeah. That's it. Everyone's saying 25 now, Tom. 25. Done deal.
Well,
early February.
And again, Hollenhorst with us here in the next hour to brief us.
Look forward to it. He's dropped from 50 to 25 too.
Yeah. Yeah.
Cassie, this was great.
Yeah.
Have you ever watched Wednesday on Netflix?
I haven't.
That's all we want to know. I've never heard of it. Have I never heard of this?
It's the Addams Family.
It's just the. Who's in it? Do you know who's in it?
I don't know.
Why is it called Wednesday?
Because that's the character of the Adams. John, get with American culture.
I've got no
idea.
idea.
The Adams Family. Very good.
I've got it.
Nailed that.
Great. That was great. That should be a jingle
Wednesday,
for this show.
And, you know, my afterthoughts calling me Gomez.
Right.
You know, she's at dinner calling me Gomez. And I'm like, what's that about? But it's just another example, as Geetha said, of their narrow casting to what does Kelsey Barrow want to watch. I mean, they're in Hollywood saying
Not Wednesday, apparently.
Well, I don't know. There's others.
So what does a portfolio manager watch on Netflix? What does a PM do? Does Bob keep you too busy? You don't watch Netflix?
You know, I like the more mindless stuff when I'm watching
like
Netflix.
what?
Wednesday is Socrates. Okay, continue.
That's not right. What is the mindless stuff?
You know, a baking show.
Like a baking show.
Cocktail competition.
What's the British baking show? Francine Lacroix addicted
Yeah, the Great British Bake Off, that thing.
Yeah, that thing. I watched.
They moved networks, they changed the cast, kind of fell off the cliff.
Can we bring you up to date on my portfolio? Maybe, Kelsey, hold
Which
my
one?
hand here. We're on TV. Hold my hand. It's not an HR violation. Austria, 97 year. I bought it. I top-ticked it. 140 to 47.
That stuff, when you reflect, Kelsey, just to finish there, on the last decade and what's taken place in this fixed income market,
Yeah.
Tom will look back at a century bond. What will you look back on to say, this was crazy?
Okay, 18 trillion of negative yielding debt at one point in the last decade, now completely wiped out. That's pretty crazy. And thinking about this idea of structurally higher yields, are we moving into an era of that? And I know you spoke to Bob about that earlier in the week. You know, what we noticed, this rate hiking cycle, the first time that we've peaked at a higher level than the prior cycle. First time in 30 years.
In the bond market here, somebody else had this. This goes back to the establishment of Nevermore Academy in Jericho, Vermont. 1788 was the last carnage.
To Kelsey's point, what Bob said earlier in the week, the first time that we've had a higher high in how many cycles?
30 years.
30 years. And Bob is basically suggesting that he thinks we can have a series of higher lows and higher highs at each additional cycle where we get a rate hiking cycle and a rate cutting cycle. I think that's fascinating just to think about unwinding the last few decades. Kelsey, this was great. Fixed income, bit of Netflix. Netflix is up this morning. The stock's advancing by about 6%. Do you want to take us out with a jingle?
I like
what
the British chefs. I like the British chefs. Gordon and Jamie and those guys.
Marco Pierre White was the man.
Yeah, but they're way better than the American chefs. You know, they're not in $250,000 kitchens. They got a knife, they got an onion, they're chopping it. Seriously.
Futures responded to that, Tom. Up a third of 1% from New York. This is Bloomberg.
And my daughter, a huge Wednesday fan. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Google is joining the list of tech companies drastically scaling back operations. Its parent, Alphabet, says it will cut about 12,000 jobs. Now that's more than 6% of its global workforce. Google has been dealing with a slowdown in digital advertising, plus its cloud computing division still trails Amazon and Microsoft. In Germany today, the U.S. and its allies are meeting to discuss more military assistance for Ukraine. The U.S. has unveiled a new aid package that includes 90 Stryker armored personal carriers and 59 Bradley fighting vehicles. Meanwhile, pressure mounting on Germany's Chancellor Olaf Scholz to deliver Leopard main battle tanks. President Biden says he has no regrets about his handling of the discovery of classified documents at his private office and his home in Delaware. He predicts an investigation will find no wrongdoing. The president told reporters he's cooperating and, quote, there's no there there. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
In the U.S., our research team, which is the best in the business, has a mild recession predicted sort of mid this year into next year. They pushed that out, and so why they keep pushing it out? It's the strength of the U.S. consumer. They have the Fed getting over, 5%, 5.25%. Just this week, they moved that to 25 basis point rate rise as opposed to 50.
I've got a ton of time for Brian Moynihan of Bank of America
Always.
on this one specific thing. Whenever he's asked about the economy, he always does this. He refers to his chief economist in the research department. And in this case, in this instance, it's Mike Gapin over at Bank of America. And Tom, I think that is so classy because it causes so many problems when the CEO goes out there pontificating on the economy, on interest rates, and not referring back to what their own research department is producing. And every single time he's asked about it, he does the same thing.
You're busting my chops on a Friday because you know this is a third rail with me. We're going to stop the show for 45 seconds right now to talk about one of my favorite bankers. 24 hours ago, somebody said to me, how did Brian Moynihan become Brian Moynihan? This is a kid out of Brown University who grew up in the crucible of brutally competitive New England banking. And in the Bank of America disaster, out of the Carolinas, the heritage of San Francisco, and the acquisition of the mid-Atlantic states, this guy in that pitched warfare survived, and Moynihan picked up the pieces of Ken Lewis by being a banker first, as you and I did in our conversation with him, and just as you say, farming out intellectual expertise within Bank of America to his economists and the rest.
It's classy. I'd like to see more of it. We don't see enough of it.
I strongly, strongly agree. Are we done?
We're done on that. I've just got this one from Liz Ann Saunders at Schwab. The legend of Charles Schwab. Sadly, I remember the original Addams Family on TV in the mid-1960s. That from Liz Ann this morning. Liz Ann's fantastic. We need to get her on the show soon, Tom.
Yeah, we should. And frankly, she can give us some great perspective on where these markets are and where these industries are. That's what we're going to do now, the culture and the fabric of big tech. And there's no one better with true tech expertise than Mandeep Singh of Bloomberg Intelligence joining us this morning. Mandeep, I'm going to go to a guy who was I'm still not over, folks, the great Clay Christensen dying. It was cancer. He went very quickly. And Mandeep, you know the effect that Clay Christensen had on the religion of Silicon Valley, and that was disruptive innovation. Right now, the disruptive innovation is being moved aside with mass layoffs. Tell us what the next disruptive innovation is for Google, Amazon, and the rest of them.
Look, I think we keep hearing about, ChatGPT these days and just how these companies are pivoting more so towards AI and large language models. But for a company like Alphabet, when you have got a cash cow in the form of search, $200 billion, almost 40 to 50% EBITDA margins, you have to ask yourself, what is it that will protect that cash cow? And I think right now, they are trying to diversify their revenue through cloud. The problem they have is the incremental margin is negative on cloud. YouTube also is much lower than their core search. And look, these companies grew too much in the last 2 years in terms of expanding their employee base. So this is just kind of making sure their operating income at least stays flat. And, they can prove to the street that they can grow their operating margins going forward.
To Jason Del Rey's magisterial effort at Vox on Amazon, just out overnight, Mandeep, Jason Del Rey makes clear there's a cultural change at Amazon going on now. Bezos out, Jesse in, and they're going to see if it works. Is there the same issue at Google or at Microsoft where there's a true cultural shift from founding tycoons over to actual adult management?
Yes, I think to an extent that is the case, in terms of how management really pivots to the next phase of growth. But you look at Satya Nadella, what he has done at Microsoft. Clearly, when he came over, there were a lot of doubts around Microsoft, going around Windows to a cloud or something else. And he did that successfully. In the case of Alphabet, I think you still have to ask yourself, this is still a search company. That's where the majority of the profits come from. And what is it that's going to drive the next phase of profitable growth? And I don't know if the answer is autonomous driving, Waymo, or is it YouTube? My bet would be on YouTube because that's a proven business. Connected TV is a real secular trend. And I would say if I had to pinpoint one driver, that would be YouTube.
Mandeep, there's this phrase that gets thrown around in moments like this. It's right size. They have to right-size the business. And Mandeep, the question we've got to ask is right-size the business for what? For how long? Mandeep, I think Satya Nadella, and you mentioned him at Microsoft, has been pretty open about this lasting more than just a quarter, more than just 12 months. This could go on for a number of years. What kind of timeline are you thinking about? What kind of time frame enters your mind?
Yeah, so look, ad pricing is very tough right now, and we know ads revenue is cyclical. Depending on the duration of this downturn, and no one has a crystal ball here, in terms of how long this is going to be, ad pricing is set by the advertisers. It's a bidding mechanism. It's not software where you get to set your price and, you can raise prices because it's sticky. Ad pricing is all, bidding based, and I don't think it's going to come back until the economy rebounds. So depending on the duration of the downturn, you will see pressure on Google search revenue, YouTube ad revenue, but guess what? I think they still have the kind of the timeshare when it comes to people spending time on their products, and eventually this cyclical rebound will happen. So it's just a matter of controlling costs right now.
The labor force, as you know, at these companies, Mandeep, over the last couple of years have grown almost exponentially. They just exploded. I look at Amazon, it went from 800,000 and basically doubled to 1.5, 1.6 million. Mandeep, the question I keep asking, and I'd love your insight on it, are we unwinding the excess of the last 2-3 years, the pandemic years, or some of the excess of the last decade? How do you think about it? 2 or 3, or about 10?
Well, I think there was a massive pull forward in pretty much every sector of tech, whether it was, gig economy, ad side, you name it, software side as well. And we are kind of normalizing for that pull forward right now. Whether it takes, 3 quarters or 6 quarters, I think time will tell. And then you add the interest rate complexity because these are all long duration assets. So you have to, normalize the valuation. But clearly on the top line front, there was a pull forward over the last 2-3 years for pretty much all the tech companies, and now that's why they're seeing slower growth.
Mandeep, just a final one from me. I think a lot of people might reflect on maybe the tech boom, the tech bust. For me, what's original about this moment for these big names, in their current mature form, I can't think of a real cyclical test that they faced, Mandeep, in the United States, because we had this long period of almost undisrupted growth in America. And Mandeep, in the pandemic, that didn't turn out to be a cyclical test for them whatsoever. Is this their first real economic test in their current form, Mandeep?
It is, and given how much they expanded their employee base, remember, all these companies grew their employee base 20% every year. So they really thought that, the growth, 40% growth will continue for the foreseeable future. And that's why I think they are right-sizing. So I do think digital transformation is a secular trend. It's not going away, and it will come back. And that's where you will see these companies rebound and come out much stronger in terms of their margin structure.
Mandit, this was great. You're one of the best, and I think I'm going to catch up with you a little bit later around the opening band. I'm looking forward to it. Mandeep Singh there of Bloomberg Intelligence. Just got to tee up the next ad, Tom, next couple of hours on Bloomberg Television.
We're doing the same thing, too.
What are you up to?
I'm up to thinking about David Crosby, and there's a very British angle here.
Talk to me about it.
Very British angle here. I can't say enough about this. I'm not going to do the history walk here now. Everybody will learn about Mr. Crosby, who is younger. The Byrds stunned the Beatles. The Beatles came out of Hamburg in the 50s in a veneration of black music. Andy Leck nails this in Cadillac Records with the Rolling Stones. And over on the West Coast, and David Crosby, frankly, is an LA brat, it was real simple. The Byrds scared them. They went over to England as the Byrds, and they were not greeted too politely by the rock and roll press there. And they wrote a song on the way over that changed music called 8 Miles High, and buried in that is a rain-gray town known for its sound. That's maybe the most famous single line. David, that song, John, 8 Miles High, in the summer of 1966, was the advent to a literal decade of what was called psychedelic music.
A legacy is a word that gets thrown around a lot, Tom.
Yeah.
When you look back at the life of this individual, what will be the legacy, do you think? The number one thing that stands out?
On a music basis, and I with great respect to Stephen Stills and Neil Young and Graham Nash, I would say it was his construction of harmonies. The Eagles came out of what he did with harmonies in the 60s. It was absolutely original at the time.
The legendary U.S. musician David Crosby has died, aged 81.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
Top-end venture is sort of 3x net of fees. Ideally, you're hoping for more than that. You're hoping for 5x or more. You're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today...
So yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Mitch Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I think we are very much revisiting the more normal dynamics now.
The Fed probably won't need to be raising rates as much as they are telling us we need to worry about.
Fed does have a responsibility here to try to preserve market functioning.
When we look at recessionary bear markets, and we do think we have a recession this year, they tend to be deep and they tend to be very long.
What scares me is really the pricing in of the soft landing that has happened since the beginning of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television on a Friday, setting up the weekend in the path to February 1st. Lisa Abramowitz I think in transit. Maybe we'll catch her in Davos. Maybe we catch her in Davos here before the helicopter takes her out. But what's important, John, and you nailed this earlier, Vice Chairman Brainerd spoke about the uncertainties, the ambiguities for this weekend as we get to February 1.
2 words: risk management of the Federal Reserve. So when you start to get a little bit more conservative, Tom, you go a little bit more slowly. And that's what they're expected to do, to drop down from 50 to 25. Chair Powell would talk about walking around a dark room. You've got to be careful. And I think they're worried about the balance now between 2 risks, overdoing it and doing too little. And that's become more balanced in the last few months.
I would suggest it's uncharted territory, uncertain territory. They're making it up as they go, and they're data dependent, and they saw some lousy data this week.
Data dependent, sure, dependent on what data? That's what we need to talk about.
That.
Jobless claims are 190,000. Unemployment's at 3.5%. Can we continue to see a deceleration in inflation, a softening in wages, without the deterioration in the labour market? So far, so good. Can that continue? And how do you compare what you're seeing in claims with what you're hearing from corporations, large multinationals, Google, Microsoft, Amazon, making big cuts?
Yeah, I agree with that. It'll be interesting, as Michael McKee said, this claims data, the shock yesterday of good claims, is in the non-farm payroll report that I believe we see February 2nd or 3rd. It's right after the Fed meeting. But John, to your point, I think this is so important, is where are we on the inflation continuum? We've made some headway, but there's still a long way to go. Witness Japan
4%.
in the early with that 4% statistic.
4% CPI. So we've got the BOJ still to come in March. We've got to go to the Fed and the ECB first. Tom, if there was something to worry about in the data, it's a sub-50 ISM, manufacturing and services. And it's kind of odd to see high yield rally in the way it has done to start the year in the face of sub-50 ISMs. That's kind of strange.
I look at it as a disinflationary tendency. You go to the work of, say, David Rosenberg, and you've got in place disinflation, but it's the calculus of it, the rate of change of it to get to Q2 or Q3. And everybody's got a different opinion on that, including John Golub.
This would be hard enough. It's made even more complicated by the fact that China's reopening. And you've seen the rally in EM, the rally in commodities, copper and crude, back through 80 on WTI, the rally in the miners, Rio up aggressively, BHP up aggressively from the October lows, and the deceleration of weakness you've seen in the dollar story as well, Tom. That's all complicating the outlook. I don't know what we look like by the time we get to year end.
Just since the last hour, the 10-year real yield at 1.20, 1.21 is now 1.18%. There's something being said there about inflation, and in the fixed income space, the gyrations of the week, you wonder where we are Monday or Wednesday of next week.
To get you some price action, the 10-year right now, 3.43. Yields higher by 3 or 4 basis points. Yields just a little bit higher this morning across the curve. Outside of that, in the foreign exchange market, euro dollar 108.20, negative a tenth of 1% there, Tom. And futures advanced by a third of 1%. Up a third of 1% on the S&P. And Tom, I've got to squeeze this in. Crude had a little look at 81 earlier, didn't it?
Yes.
$80.88 right now.
$87 on Brent crude. Fadi B-roll, I should say. Most eloquent with IEA and Davos with Francine and Lisa here in the last couple days. This is important. It is that every equity strategist has a certain style. The acclaim of Jonathan Golub at Credit Suisse, either courageous bull or right now with some real reticence, is he dives into sector analysis over on page 5 and page 6 of his reports. He darkens the door this morning. What does the sector analysis tell you right now?
Well, we put out a note this morning on earnings that we're having a margin problem in the vast majority of the sectors, with the exception of surprisingly consumer discretionary is better, energy is better, and industrials. But short of that, you're seeing margin contraction everywhere. But if there's a big sector story, it's that tech is really weak compared to everything else, or broadly defined tech. And that's just not something we're used to. The tech is this earnings season, if you take tech out, or tech broadly defined, you have a 5% EPS growth this quarter. I mean, who would think that tech is the thing that's holding everything back? And I think that this continues for longer than we think.
And this is a hallmark of Credit Suisse, is this linkage between strategists and your securities analysis. Do your tech people as a whole feel news-making layoffs can adjust those margins? Can they heal that margin deterioration?
Well, Tom, and we were talking before we went on air about what's going on in terms of layoffs and young people coming into the labor market. A lot of this was an over-exuberance when we went into the pandemic and things were so strong for tech demand. The companies hired as if this was a new normal of strength. And what it really is, and this is why tech's having a hard time, it was a pull forward of activity, and everyone believed, the investment community bought into it, the companies bought into it, and now it's unwinding. Companies are laying those workers off. So do we work through this? Yes, but we saw this with Y2K. It doesn't happen in 2 or 3 quarters. It takes a little bit of time to work through, and that's
where we are. You said a few things now. Y2K, pull forward. And you talked about this can go on longer than people think. So let's build on that. How much did we pull forward, one? And what gives you the sense that this can go on a whole lot longer than people think? And when you say that, what kind of duration are you thinking about?
Maybe this ends up being a 6 to 8 quarter period. I mean, just think about this. You bought a laptop because you're now working from home. When are you buying the replacement for that? Not this year. You went and my mother started using a streaming service for the first time. Is she signing up for the second streaming service now if she wasn't doing it before? And it's not, or the move towards global advertising, which kind of got pulled forward. And so it's not as if the long-term trend is necessarily a negative one, but there was definitely a bit of exuberance as we went into the pandemic, and it just takes a little while. We're also, as an investment community, and if you look at hedge funds in particular, growth in tech has been such a huge win from the time that the iPhone came out in 2008 to now. Everybody staffed up their tech teams. Everybody built processes around it. Nobody wanted to be a value manager. Everyone wanted to be a growth manager. And so it takes a little while for this to kind of
so
play
we're
out.
not used to this, and you've mentioned this. This is not what we're used to. And with that in mind, this is the question of the moment, I think, for a lot of people. How compromised is the index story? Because what we are used to and what we're conditioned by is just sitting in the index on the S&P passively and being very rewarded for it. How compromised is that index story going to be? For how long?
Yeah, I'm not sure it's compromised. I'll tell you. So last night I had dinner with 10 head traders at some of the bigger shops. And I said, if you had a choice between buying the tech basket cap weighted or the tech basket equal weighted, how many would buy the cap weighted?
What did they say?
Not one hand went up. How many would you buy the equal weighted? All 10 hands went up. And so there's a lot of great names. So if you're trading, if you're looking for individual securities, there's a lot of interesting things going on. But these really big cap. Listen, 2-3 years ago, all we were talking about was moats. These are impenetrable businesses.
Secular growth trends.
Yeah, exactly. And listen, and some of these, and they're great. Let's be honest, they're great businesses. But it doesn't mean that they're impenetrable.
So at the dinner last night, which I'm sure you slotted through Credit Suisse Zurich expenses, did you finish, as in the old days of Credit Suisse, with the Hennessy Paradise brandy? Or did you go a different direction now, like get out a six-pack of Utica Club?
No, we were drinking light beer, and that was it's.
Tell us about this dinner. That's what I want to know.
Well, you know, we do this a fair bit. I mean, next week
it's your job.
Yeah, and if I look at where my ideas come from, so last night was 10 head traders. Next week we're doing 10 guys who are either hedge fund founders or CIOs at some of the
What
larger
do they
shops.
want to know from you? Seriously, I mean, we're making jokes about cognac. Forget about that. What do they want to know from you? What's the mystery for traders and hedge funds tycoons when they talk to John Golub?
If the expectations right now are for weaker, if you look at strategists' forecasts, this may be the weakest year I can remember in terms of forecasts. So the question is, if you can't make money just simply by jumping into the market and riding up a beta trade, how do you play the game? Where's that edge that you get in this environment? Because everyone around the table really struggled last year. Managers had a really hard time, especially hedge funds. So momentum traders have a harder time in this environment. We think there's going to be a big movement. Last year, the whole story was value. People weren't there. We think that growth snaps back this year.
Oh.
There's a Golub we love.
So, John, why are you only at 40-50 if you think you get that growth snapback, given the weighting in this index?
Well, there's a couple things. One is that this will be a rare year that earnings are down. Listen, I'm in the non-recessionary camp, and we can talk about that. But I think this is going to be the rare year that earnings are down in a non-recessionary year, and it's because of margins. I mean, take this earnings season. Revenues are up 4.5, margins down 8.5. I don't remember an environment where we saw that much pressure.
So
and
it's
not
Main Street okay, Wall Street bad.
What was that?
Wall Street challenged, Main Street okay.
Well, you know, I guess, but I mean, look at what last year was. Wages went up slower than CPI. So companies didn't have to pay higher wages, but they got to move on pricing. That's a beautiful corporate environment. This year, wages are going to be sticky, CPI coming down. They're paying their employees more. They can't pass it on. And so the consumer, the individual is better off this year relative to companies. Last year, it was the opposite. Companies were better off.
I want to talk about that recession call, if you can stand it a bit longer. Tom and I just have one question. Can we come to the dinner next week? Can we make that happen? You know, why are we getting an invite to the dinner? We can host. I can be at one end, Tom can be at the other. We can ask questions.
Well, listen, at least it has to, check her bearishness at the door, though.
Oh, I love
is that?
Did we?
She can have the cognac at the end. You just have to check
John,
the bearishness.
This is important. I mean, if you're at a Credit Suisse dinner with Golub, you're getting 100 Oaks de Vie in your cognac, and it's a splendid coppery gold.
Could you give me a price on that?
I don't have a price on it. I can't get there right now. Good morning, Zurich.
John, we're going to force you to stay with us for a few more minutes. Equity futures up 1/3 on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The parent of Google has become the latest tech giant to retrench after years of growth and hiring. Alphabet will cut about 12,000 jobs. That's more than 6% of its workforce. CEO Sundar Pichai says the cuts will affect jobs across the entire company. Pichai says he takes responsibility for the decisions that led Alphabet to this point. The Biden administration is sending another major package of military hardware to Ukraine. It includes 90 Stryker armored personnel carriers, 59 Bradley fighting vehicles, and millions of rounds of ammunition. The package, valued at $2.5 billion. The U.S. and its allies are meeting in Germany today to discuss more aid. Russia is trying to limit a plunge in budget revenue caused by EU sanctions and the price cap on its oil exports. Bloomberg's learned the Kremlin may change the way it calculates taxes on oil. One of the options would add a premium to the current price of Russia's key export blend in Northwest Europe. In Japan, inflation has hit 4% for the first time in more than 4 decades. That's twice the pace targeted by the Bank of Japan, and it's likely to lead to more speculation the central bank will change its monetary policy. And Genesis has become the latest crypto firm to collapse in the wake of the FTX exchange's swift downfall. The cryptocurrency lender filed for Chapter 11 bankruptcy protection in New York. Its top 50 claims amount to about $3.4 billion. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority. Bloomberg's Michael McKee speaks exclusively with outgoing Kansas City Fed President Esther George. What has she learned? Where does the Fed go from here? An exclusive interview with Kansas City Fed President Esther George. Today at 10 a.m. Only on Bloomberg TV and radio.
Although we're seeing some signs that inflation is moderating, it remains far too high. And it is my number one concern going into 2023. So with inflation still high and indications of continued supply-demand imbalances, it's clear that monetary policy still has more work to do to bring inflation down to our 2% goal on a sustained basis.
That was John Williams there, the New York Fed president. Some of the top officials at the Federal Reserve trying to get the final word in before the quiet period begins tomorrow. You'll hear from Harker a little bit later and Governor Waller as well. Equity futures right now on the S&P up 1/3% on the S&P 500. In the bond market, yield shaping up as follows on a 10-year. Tom, just a little bit higher, up 5 basis points. Your 10-year this morning, 344.
We are with Jonathan Golub. We're going to continue right now. Global Wall Street giving a nice response with this, the gentleman from Credit Suisse. John, I'm going to go back, and of course we have to use the Dow Jones Industrial Average in honor of Lou Rukeyser. 1974, the bottom, world's coming to an end, sort of like now, sort of like 1788. The Dow 616 to 852, and the next year we enjoyed going from 852 topping out above 1,000. We were up 38% off the gloom of the 73, 74, Pittsburgh's going to die recession. Is that where we are right now?
You know what I would love to, I think what every strategist wants to see is that the Fed crashes this thing, we get a really hard recession, you get a V-shaped bounce, and you get a normal cycle. And I think, we were talking about just a moment ago how the strategist expectations for this year are as weak as, as we can see. And I think that the idea of a soft landing is way more likely than people think, but it's not something to get excited about because it also means that you're looking at anemic returns with a lot of volatility.
But if we get a soft landing, does that express out to a 38% up like 1975?
I don't think so. I think that what you're looking at here is the Fed doesn't raised rates enough to crush the. Listen, here's what people are getting wrong in this inflation story: is the headline CPI is falling, but wages are not falling, services are not falling, and rents are not falling. It's goods that are falling, which means that we're not really addressing the underlying cause of this thing. So the market is getting very exuberant that the Fed is going to pause. They're not pausing because they're stopped. They're pausing because they need more data. They want to slow this down a tiny bit. The street's looking at that wrong. The market sees falling inflation. They're getting really excited about that, but it's goods, and that's a comps issue. It's a one-off thing. It's not that we've gotten rid of inflation. It's we've gotten rid of that component temporarily. And so what I think you're going to see, like last year, a lot of chop without a lot of upward movement, and that's a hard. Tom, you were saying this before. It's a hard investment environment for most people, especially those who are shorter term.
The epicenter, though, of your call is that you think recession is avoidable. You think we will avoid that. What gives you the indication that we will?
The big surprise this year is that if the consumer gets what looks like, let's say, a 5% raise, or for that matter, a retiree gets an 8.1% COLA, so they're getting a lot more money, and we end the year with 2.5% or 2% inflation, which is roughly what the break-evens are saying or the Bloomberg survey is saying. This will be a great year for consumer purchasing power. Their wages are going up higher than inflation. And in that environment, and you've seen now we're 6 months in a row of consumer confidence rising, and we're going to see that all year long this year. And that's, well, just think about it. Jobs are abundant. Your raise is going to be running at 3% above your cost of, cost of purchasing things. And that is going to keep us out of this recession. Now, from a profit perspective, companies have to pay those higher wages and don't get pricing power. So you have this weird thing that the consumer's okay, the recession gets pushed off, but corporate profits are really anemic, and investors are shaking their head because they don't know what to do with it.
So pick a sector, discretionary.
Yes.
Where's discretionary in that world?
If you are a company that, like a retailer that has a lot of labor, you're going to have a harder time. If you have a business model that is less labor intense, you do pretty nicely.
I took the Dow math that we were just doing here. In 1975, up 38%. In 1976, up 17%. And that obscures that over a 49-year period without dividends, the Dow or the S&P was up 5.4%. You overlay on dividend reinvestment, I get it. When you go to work or when you have a fancy dinner with 10 fancy people like John Farrow, is it a single-digit return world for you? Or can we get back to 9 or 10 or 11, a small double-digit return?
It's a lower return world. So we're talking about what was the group saying? I surveyed the group. I asked, how many of you have taken some of your equity money personally and moved it towards something that looks like a bond? And the majority of the table said, how do you not? And that doesn't mean, they weren't saying I'm panicked about equities, but if you can get, after-tax equivalent of 4.5% on a muni bond, do you put something in? Is that attractive compared to a world where you're looking at negative earnings growth?
Does anybody in the dinner look at the Dow Jones Industrial Average, or do they only look at the Standard & Poor's 500?
Yeah. Only, I don't want to say dinosaur, but there's not a lot of people who talk about the Dow Jones.
Can I have that on the record? Can you actually just say it? Because I'd love that.
It's all S&P, TK. You know that. It's all S&P.
I have a nodding acquaintance with that.
But the S&P story, and I want to finish on this because it is important, has become the dominant story, particularly over the last decade, because it's rewarded investors so handsomely. You mentioned the equal weight. If you had to pick the tech sector right now, would you take it market cap weighted or equal weight? That was a conversation you were having about these investors at these hedge funds. Can you tell me about where you'd leave that story now at the index level on the S&P 500? Would you want a market cap weighted exposure, waiting for the tech snapback that you're looking for? Or would you want something more equal weight? How would you get your exposure?
I don't have a bias against a cap weighted benchmark, but the outlook has to be for at least the next 24 months has to be that an equal weighted benchmark does better. And it's because I think that some of these larger companies, it's harder for them to deliver an above average growth rate given their size in perpetuity. And I think that there are areas that are smaller in the benchmark. Energy, for example, underrepresented in the benchmark, really low PE. If energy does well, the cap weighted benchmark will lag. And so, yeah, you have to go that way.
John, this was great. Love it. What restaurant are we picking? What cuisine? What did you choose?
He's picking the drinks.
TK's doing the drinks. He'll choose a bar. That's what he always does. Usually at the hotel. It's always a hotel bar. What
Yeah.
is it with you in the hotel bar?
They're just really good service as a general rule. They're quiet, and critically, with a lot of the conversations I have, particularly with the wonderful people of Bloomberg LP, you know, I don't want to be sitting next to somebody
you want it to
taking
be-
notes
you want it to be
from,
private.
you know, somebody. I mean, they're just quieter. They're unlike the trashy disco scenes you're going
You're
to.
saying I go to the disco scene.
You go to like the, you know, they got the ball going around and they're down on
a disco ball.
River, what's it
What
called?
decade is
Down
that?
Well, you have
Soho,
that the
East Village.
thin tie,
It's
you
a
know,
slim
that whole
tie.
disco thing. Yeah.
Sure. You think this is disco? What
No, it's
generation
not
is this? Is
disco.
disco?
No, it's Flock of Seagulls about 1979. That tie is back when Tottenham won.
What is wrong with this tie?
There's nothing wrong with that tie. It's you look like a lad.
You can't throw rocks when you're wearing a bow tie.
You look like a
You know,
mate,
like, don't
you
throw
know.
stones when you're wearing a bow tie, Tom.
That's okay.
John, this was great.
You don't have
Thank
to
you.
talk quietly like Jen Bristow talks about.
That's, you know,
That's
like
good.
the president.
We'll be back.
That's great. Okay.
That's good.
Coming up, Mohammed Al-Arian of Bloomberg Opinion of Queen's College as well. Looking forward to that. We'll catch up with Subhadra Rajappa of
He
SocGen.
talks quietly.
We'll catch up with Subhadra on this bond market and the debt default story of the year. No one thinks it's going to happen. We'll see if it does.
You're already
Woodard
selling
of
Ford,
Bank
your
of
show?
America. Yeah, I'm leaving in a second.
Can I do
and
that
finally,
someday?
here's a conversation on EM you don't want to miss. We'll start on that conversation with Mohammed, then we'll go to Robert Koenigsberger of Gramercy Funds. Really
Really
looking
timely,
forward to that.
timely.
EM is such a massive theme for so many people this year,
And
Tom, with China
massively
reopening, just
under.
huge.
Damien captured this. It's underreported. It's way underreported.
Where do you want to be to leverage that story this year?
Yeah.
How obvious is it? You know, that's going to be the conversation we have, and I'm looking
And the
forward to
debt
it.
dynamics, there's an assumption it's just like us. It's not. There's minimal equity visibility, and the debt dynamic is where the return
And
is.
the real estate piece of it too, which is something you were focused on through much of last year.
Yeah, and domestically, I'm going to focus on real estate this year. I'm really interested to see how commercial real estate U.S. works out.
Going to actually adjust
Huge
here in New York
mystery.
City, lower rents.
Unsure.
I think we're all hoping for that, aren't we?
Yes.
Apart from maybe the landlords.
Maybe catch up with the rest of the country.
Yeah, that would be nice. John, thank you. This was awesome. Thanks for being with us. Equity futures up by
I could
a
trip
third of
over
1%
trip over the Amazon
on the S&P.
boxes when
I can't believe
walk
you've
up.
insulted this tie. I think it's so rude.
I love your tie.
So,
Who
so
said- I
rude.
didn't insult your tie.
So rude. We're meant to be friends. Have I ever criticised your bow tie?
Where do you want to begin?
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. You know, we've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, everyone. Bloomberg Surveillance, a really spectacular week. Major John Farrell, Lisa Bramwitz, and Tom Keene. Shout out to our team, and particularly our booking team, for just giving us wonderful discussions through the day. We continue that. Shonali Basak will be with us here in 15 minutes. And whether you're like me, you really don't care about BitDog or crypto and that world this weekend is blowing up. And Shonali Basak will give us a brief here on a bankruptcy, but much more going on, including the United States Department of Justice. Right now, to have a victory lap, he has appeared in our studios. We're thrilled that Citigroup and Jane Fraser would let him appear. Andrew Hollenhorst with a spectacular call last year on a regime of higher interest rates, and that's where we are. Except at Citigroup, they went from 50 beeps to 0.25%, 25 beeps on the February 1st Derby. So what this is about is Hollenhorst at UCLA learning that one day at UCLA, they actually taught John Maynard Keynes, when the facts change, I change, and Hollenhorst said, what do you do? What did you do yesterday to go from 50 beeps to 25 beeps?
Well, thanks a lot, Tom. Yeah, that's right. When the facts change, you do change. And I think we saw in the data a little bit of softness in the price data. Certainly, we've had softer core CPI readings. And then producer price index usually doesn't get a lot of attention. It definitely got our attention. That was a little bit softer also. It means core PCE inflation is going to be a little bit softer. So I think there's enough softer price and wage data for this Fed to, I think the way they're feeling now is comfortable that they've maybe done enough or getting close to having done enough. I am quite uncomfortable that they've actually done enough here, and I think we're going to see that in some of the upcoming data.
Let's talk about the uncomfortable reality of the x-axis in economics. So you've adjusted for February 1, but the cumulative path out into 2023, does that still give you your high newsmaking terminal rate?
So we're still at 525 to 550 on the terminal rate. And I would just highlight, relative to what I'm hearing Fed officials talk about, relative to what markets are pricing, it would seem to me that that is at the lower end of what would be a reasonable terminal policy rate for this Federal Reserve. So it's very possible, it's our base case, that they're getting to this, 5.25 to 5.5% range. But just like your previous guest was talking about, if we see wage growth that picks back up again, and we think it will over the course of this year, if we see service inflation that stays sticky, then we may see this Federal Reserve reassessing, is that really the appropriate policy rate to get to? So although we're hearing Fed officials saying we're going to stay the course, and it maybe makes sense to move at a slower pace now to figure out where that rate is, will we really be seeing the policy response that you need to slow down the economy sufficiently to loosen the labor market to bring down inflation?
I don't know if Willem Bouter, who founded modern Citigroup Economics, and on to Catherine Mann and on to you, but I'm going to suggest Professor Bouter studied his A.W. Phillips curve over at LSE a long time ago. Link this to unemployment, and if I get Hollenhorst gloom of a higher rate, what does that do to the unemployment rate and the societal change that will bring?
Yeah, so I think that is something that I think Fed officials need to be really honest about when they talk to the public. The idea that the way monetary policy works is through things like the unemployment rate. It is by slowing down the economy. It is by creating slack in the economy, and is damping demand through those channels. So if you think that this is an economy where demand is outstripping supply, you will need to lean against that with higher policy rates, and that probably will increase the unemployment rate. Now, they have that in their forecast, but they have the unemployment rate coming up to maybe 4.5%. When you're running substantially above target inflation, we still are, even though we've had a few months of softer core inflation, we still are substantially above target. You probably need that unemployment rate to move further than 4.5%. So we're probably going to need to see a 5% plus unemployment rate to bring inflation down. Can we be hopeful? Could we be hoping that we're going to get a better scenario where the unemployment rate doesn't need to move as high? Certainly, and I think I would hope for that. Everybody would hope for that. But the honest answer to your question, the basic macroeconomics, is that to bring wage growth down, you need to loosen the labor market.
We got to remember, the gentleman from UCLA, Alan Meltzer, wrote a modest 3,000-page history. The only one I know who's read it is Mike McKee. And come on, Andrew, if we societally, coming out of this pandemic, shift from 3.5% up to the Holland Horse 5%, there is going to be a societal scream about that. Politically, how does the Federal Reserve adapt to that?
Yeah, I think this is one of the reasons that central banks globally and in the U.S. have been made independent, and the idea that they're supposed to operate outside of politics, because politically this is a very difficult thing to do. Now, the education that needs to happen.
Is it happening now with these speeches in the silly micro parlor game that we're doing?
I don't think so. I don't think so.
How do they educate?
So first, be honest. There were large errors in policy making that led to much too high inflation. We're now recovering from that period of time. And the recovery from that period of time means much tighter monetary policy. So we're in a bad position, right? We should acknowledge that. Now that you're in this bad position, how are you going to get out of it? We could say, let's just accept higher inflation, right? And this was, in some ways, this is what happened in the 1970s. So we know from that experience that that actually leads to worse, longer-term outcomes. So if we try to pivot too strongly towards worrying about issues regarding growth and unemployment, of course we care about those things, but the bigger risk right now is inflation. And that's why it's been interesting in the Fed speak, right? Because we've heard Fed officials saying, yes, inflation is still the bigger risk. But meanwhile, we see markets that are pricing out future Fed hikes, pricing out more hawkish policy, and Fed officials being relatively accepting of that. And so I think, we're not there yet, but this is kind of the early stages of something that could end up looking like the 1970s, where you essentially declare victory before that victory is really attained.
Well, we got a lot to talk about. We're going to expand this interview out to 3 hours again, Holland Horse, as we vibe back to the 70s. I don't want to get you in trouble with the General Counsel Citigroup or with Ms. Fraser, but I'm going to ask a delicate question. Your giant and one of my heroes, Catherine Mann of MIT, is overholding court at the Bank of England, I would perceive as a hawk. Is there a Catherine Mann at the Fed right now? Is anybody at the Fed a legitimate Catherine Mann hawk?
I think what the Fed is trying to do is be data dependent, and I think that is the right thing to do. You want to watch the data as it comes in. Certainly, if we are going to get inflation and wage growth cooling off, and we can keep the unemployment rate at a 53-year low, that's something that we would love to have happen. And you have to put some probability on these kind of surprising but possible outcomes, right? And the data most recently has been favorable for that type of outcome. So I think that it's not incorrect to be paying the data its due attention. On the other hand, I think what we've heard in the rhetoric, I think Chair Powell has actually been quite on message in terms of talking about resolve in the face of higher inflation. The idea, if you looked at those last minutes from the December FOMC meeting, and they talked about our markets misperceiving our reaction function, our markets thinking that we're more dovish than we are, and they're concerned about that. So you see that level of concern there. You see that kind of hawkishness. I think the issue for Fed officials is that as soon as you get a short period of time, which we've had, a short period of time where the data comes in a little bit more favorably, it's very hard to maintain that messaging, and that's what they're struggling with now.
With time, I got like 8 ways to go here, folks. If you're just joining us on television and radio, Andrew Hollenhorst of Citigroup with one of the great calls of 2022. For this Fed meeting, he shifts 50 beeps down to 25. I heard a little bit of yeah, but there, maybe back to 50, but he maintains this higher interest rate regime, as Dr. Elarian and Dr. Dudley speak about, is well. I've got to go, I guess because of time, to the glide path and presumption of disinflation. Is it even if it's curvilinear down to 2%, or dare I say, Olivier Blanchard, 3%, are there kinks along the way? Or is there a good force here to keep disinflation smooth and stable as a trend?
So there are always kinks along the way, and that's important to keep in mind. The softer core CPI prints that we've had, softer core inflation prints that we've had most recently, that has a lot to do with used car prices coming down, goods prices that have slowed more down.
Stuff.
That's chunky good stuff. Those used car prices, we monitor the wholesale prices for used cars, and we've seen those stabilize and now start to go higher, actually. So when we're looking at January core inflation, February core inflation, you won't have that same disinflationary factor from used car prices. What does help you glide down is shelter prices later this year. I think that will cool. We have a lot of evidence that that's going to cool. Non-shelter services, it's a mouthful to say. That is the area we should be concentrated on, because that's where that wage pressure matters. That's where tight labor markets matter.
Take the disinflation dynamic and this non-shelter, which I can't pronounce, okay? Great. Bring that over to an initial claim statistic where you would begin to see evidence of Fed success. I'm going to suggest that number's way more ginormous than a 4-week moving average of 206,000.
Incredibly low initial jobless claims, incredibly high rates of people quitting their jobs, right? And that's important, I think, when we look at some of these headlines about layoffs. If you have layoffs that's showing you that, yes, there's some areas, some sectors where maybe you're getting some loosening in labor markets, but if you have very few people filing for jobless claims, filing for unemployment insurance, if you have people that are very willing, historically willing to quit their job because they feel so good about the labor market, that's saying to me this is still a very, very tight labor market.
You're becoming a pro like Catherine Mann. You didn't answer my damn question. Answer it. What's the initial jobless claims number, Andrew, that equates into a constructive Fed policy? Is it 250? Is it 300?
Yeah, I think you'd expect to see that coming up to something more like 300. You'd see that coming up over time consistently, and we really haven't seen anything like that in the data.
Extraordinary. What are you going to write about this weekend? What are you going to think about this weekend? I'm reading Olivier Blanchard's new book, cover to cover, every footnote. What are you doing?
We are thinking about what this process will be between the tight labor market and wage relationship, and then between that wage and price relationship. And I think those are kind of the big unknowns right now. So it's not hard to believe in very tight labor markets pushing up wages. Is that wage pressure then going to push up prices further? We think so, but margins are also wide, right? So maybe
when you talk to Suvin Horowitz and the other criminals at Citigroup and securities analysis, they telling you these corporations have pricing power?
Especially in the services sector. That's where we still see the pricing power. So goods, maybe not so much, but in services, yes.
This has been great. Andrew Hollenhorst with a clinic there on how you get to a 25 basis point idea for February 1, but decidedly he keeps that high interest rate regime that so many fear out there. Red and green on the screen right now. I'm going to call it a churn in the market. The VIX 20.54. John and I looking at the yield spaces to say the 2-year yield, could we get to 3.99? Not 4.17 on the 2-year yield. The backstory here into your weekend. Brent crude, $86.52 a barrel. That is decidedly not given way in any way, shape, or form. Dollar fractionally stronger. Stay with us. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Google is joining the list of tech companies drastically scaling back operations. Its parent Alphabet says it will cut about 12,000 jobs. That's 6% of its global workforce. Now, Google has been dealing with a slowdown in digital advertising, plus its cloud computing division still trails Amazon and Microsoft. In Germany today, the U.S. and its allies are meeting to discuss more military assistance for Ukraine. The U.S. has unveiled a new aid package that includes 90 Stryker armored personnel carriers and 59 Bradley fighting vehicles. Meanwhile, pressure is mounting on Germany's Chancellor Olaf Scholz to deliver Leopard main battle tanks. In Peru, police battled protesters who are trying to topple the fragile government of President Dina Boluarte. Now they're demanding her resignation and asking that new elections be held. Boluarte took office after her predecessor, Pedro Castillo, was impeached. And Bloomberg's learned that Saudi Arabia's sovereign wealth fund considered buying Formula One motor racing. But a potential deal stalled early in the stages last year when its owner, Liberty Media, lost interest in selling. The Saudi fund valued Formula One at well above $20 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
We certainly see more demand for, if you like, quality and separate custodianship, and I think that the good providers of that will continue to do well. And I think we will see some more of these principles that you see in other parts of the financial system come to the crypto world.
If I was to trust anyone to analyze crypto, it would be the mathematician and engineer from Edinburgh. Ann Richards is absolutely exquisite. I've done many panels with her at Davos over the years. They're speaking with Bloomberg at the meetings of the World Economic Forum. Right now, this is really important, and frankly, in terms of news direction, maybe our interview of the morning. Sonali Basak is going to attempt, and I mean attempt, to brief us on the wide set of stories into the weekend on crypto and exchanges, and not even the price of Bitcoin. 21,000 is really not the story. Away from the price of Bitcoin, what is the distinguishing story this weekend?
There's a reason that this Genesis bankruptcy filing is the #1 read story coming into the terminal as you wake up this morning. I was up till 1 in the morning reading the bankruptcy filing myself. Remember, this is a company that is tied to the digital currency group Empire, run by Barry Silbert, a well-known name not only in cryptocurrencies, but also on Wall Street as his time as a former investment banker at Houlihan Lokey. So the irony of that now is that a unit of his own empire now going under a bankruptcy process. When you read the reports that are coming up this morning for the bankruptcy process, you see that creditors are at odds. Remember, the #1 creditor here is Gemini, the Winklevoss entity, the Gemini Earn entity that halted withdrawals.
Can you predict they could go? I got to be careful in my language. Could the Winklevi go bankrupt?
Well, that's the fight here. They need to get their money back. If they get their money back, that saves them
I don't want to put you in a
some
compromising
time.
position there.
But it's a lot of money. It's more than $700 million, and it's more than 300,000 clients of their own that they owe money to.
I tweeted this out yesterday. I'm going to redo it today. This reads like a James Bond movie. This is Karif and Ghosh of Bloomberg, who truly are writing up the dark dark parts of this story. This is not funny stuff, folks. There's no jokes. I'm going to quote verbatim Shanali. The Financial Crimes Enforcement Network of the Department of the Treasury wrote in an order that, quote, approximately 2/3 of Bits Lotto's top receiving and sending counterparties are associated with dark net markets or scams. Ken Rogoff wrote about this in his courageous book, The Curse of Cash. Are we right now where Ken Rogoff was 3 years ago, where now it's becoming about scams, darkness, and crime?
You have to ask yourself, after so much free money, is it only in crypto for one thing? First of all, there's a lot of financial structures created in the last 2 years that a lot of people had a lot of fun with. I think the thing that's important about the case you're talking about is that this is a Hong Kong registered exchange. The founder of that exchange was arrested in Miami. And remember, this is at a time where you have the SEC going after traditional crypto players like Genesis, which is one of the biggest, not only brokerages in the industry, that lending business helps keep that industry alive and heart beating in a big way. Bits Lotto, I can't say I've heard of it before the Department of Justice went after it. And the reason it's important for the Department of Justice is you see them expanding their reach when it comes to clamping down on the crypto industry.
I got 8 ways to go here, but on a Friday, Shanali Basak, exhausted from her great coverage of the banks this week. I believe over at Fortress JP Morgan, Jamie Dimon's going to come back from Davos. He's going to put on a hard hat and look at the building, the palace he's building on Park Avenue. And there are people in that building who believe in blockchain, believe in Bitcoin. Their boss is calling it a pet rock, okay? Now we've got criminality involved. How can big bank institutions believe in the pet rock or believe in exchanges that are involved with Department of Justice investigations?
Well, there's a moment here in which a lot of Wall Street, a lot of, the Goldman Sachs, the JP Morgans, the Fidelities, it's a big opportunity for them to use the technology and bring traditional financial rails back onto it. So is this a technology that can change FX markets? Is this a technology that can meaningfully change bond markets? JP Morgan and Apollo will tell you yes. There's another JP Morgan story here. I might as well bring it up while I'm sitting with you, Tom, because I just got off the phone with Mike Mayo a little earlier. Late last night, Jamie Dimon's pay package has come out.
34 million large, right?
Yep, 4.5. It is stable, but interesting part of that, and
so is his tax bill, I might point out. A modest portion of that, folks, goes to taxes, I would suggest.
So I called Mike Mayo. I asked how he felt about Jamie Dimon's pay after not as good of a year, and he said it's easier to ask for permission than forgiveness than permission, and that is because more than the pay, JP Morgan has now decided to not allow for the special awards anymore. Remember, they had a special awards package for Jamie Dimon of $50 million or so, and he's saying that, I wasn't happy last year. I didn't think it was fair that any bank CEO gets a bonus on top of a bonus, but now they're saying they'll never do it again. So that's another, new money, old money story.
This is a huge story, and we could go on about this as we can, but is that W-2 pay like mere mortals like you and I have, or is it mostly stock treatment that will be taxed at a lower rate down the road?
It's mostly stock treatment that will be taxed.
Why are we conflating stock-treated assets and the risk of JP Morgan in with his W-2 compensation?
Because I think you have to look at their overall pay at the end of the day. When you look at it, actually Glass Lewis, the shareholder advisory firm, last year gave him a D. I think the year before that, they gave JP Morgan an F. What does Jamie Dimon fail anything at? And so it's interesting to see shareholders for the first time really start to speak up against.
They're saying he's making too much?
Certainly relative to the median worker at JP Morgan. And I think that will...
Yeah, but he's not the median worker at JP Morgan. I mean, I don't think, Matt, where are we on time here? I'm losing track here with Basak as usual. Oh, we got plenty of time. Folks, stay with us here. I'm going to use the great financial assets screen, and I'm going to look. Hopefully this is going to come up. I can see pre-pandemic, Fortress Dimon has moved operating income from $45 billion out to $60 billion. And I'm not saying he should be paid $157 and take the subway, but did he earn the money?
Well, let me ask you something else. A ton of bankers that are there that are not the CEO of the firm, they're watching their bonuses decrease this year, no matter if it's stock or not. So how do they feel about it when the tippy top pay is quite stable? My colleague at CNBC, Hugh Sun, used to work with us. He had an interesting tweet out earlier this week.
Excuse me, on this show we call
And so he
is,
had
and very good.
and very, very good. And he tweeted about how much per employee was being spent on the Goldman layoffs, and it was about $140,000.
This is a severance pay.
Exactly.
Yeah.
And the reason that's interesting, the $140,000, is it's showing you that it's kind of more lower paid workers, it's younger bankers. So it shows you, if you kind of take the two stories put together, that the top end of the pay scale on Wall Street is pretty sticky still, and it shows you that the newer people...
Is that news? It's been that way, I think, back to 1788.
It's news as you're starting
First
to see
Bank of New York
layoffs.
dividend.
It's news as you're starting to see layoffs and pressure on pay. And remember, if wages are sticky. That's certainly true if you're making $35 million.
Yeah, what'd you learn about bank earnings here? It's Friday. We've been able to digest for X number of days here bank earnings. What have you learned?
You know, everyone's talking about the wealth experiment that has been going on over at Morgan Stanley.
Dead on, dead on. Where's it going to be a year from now?
Where's it going to be a year from now? We were talking about the succession experiment. I think it bodes really well for the man who leads that business, Andy Saperstein. You also have something interesting here about the dispersion. People say, okay, the stock on Tuesday, fine. Morgan Stanley flying, Goldman sinking in the best and worst it has been in years. But let's just take a look at the longer term trajectory, because the market cap of Morgan Stanley at that day jumped 40 billion above Goldman Sachs's. When David Solomon, the day he took over the job at Goldman Sachs, it was worth more than Morgan Stanley. Now there's a more than $40 billion difference.
Well, you know, don't keep us in suspense here. Is Mr. Solomon's employment threatened?
Listen, he's year 5. Every day after year 5 is a test of time. And so the investor day is where all the pressure is.
When is that?
And by the way, his birthday was this week on earnings. That was a fun little fact, a tough day in Davos on an earnings day. But he, February 28th is when the investor day is. He's already said, I forgot which analyst, it was the kitchen sink is what this quarter was already called. But is he going to give something to chew on for investors for the next 5 years, the next 1 year?
Do they do that at the Javits Center? You know,
No, at the Goldman
thousands?
Sachs Auditorium.
They do it in the auditorium.
Yeah, with a big TV screen.
Sonali Basak with a very, very busy week here, not only in what we're seeing at Genesis and the bankruptcies and traumas in crypto, but also, of course, what we're seeing in the big bank effort as well. I need to say thank you to our team. I thought the guest quality this week was shockingly good. Just really, really great. Safe travels to our Lisa Abramowitz, I believe by helicopter back to Zurich and on her way here at some point. Red and green on the screen, the VIX, 20.59. Both John Farrow and I looking at Brent crude up $87. Coming up, John Farrow with a gentleman from Cambridge. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Live from New York City this morning. Good morning, good morning. Let's get you to the weekend. 3-day losing streak on the S&P. Equity futures trying to bounce. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Google preparing to cut 6% of the global workforce. Senator Mitch McConnell says the U.S. will never default, and top Fed officials determined to stick with high rates. We begin with a big issue, the Fed's last word.
We have a Fed here who's not backing down.
They're very concerned of being the Fed that paused too early.
Some speakers, members being fairly hawkish, some less so.
Inflation is on its way down. The economy is slowing.
We hope that the Fed will engineer a soft landing here in the U.S.
This has the signs of being a soft landing.
We think that you're going to get a recession.
But the jury is still out.
We have amongst investors a very, very different view.
We're in the don't stop camp.
We're more in the stop camp.
Maybe another 50, 75 basis points certainly does the trick.
We think 25 more basis points.
The Fed needs to get truly restrictive. I agree with Bullard on this.
Lower terminal rate, staying there for longer.
Just a fantastic lineup this morning, and I'm pleased to say we kick things off with Mohammed Al-Erin of Queen's College, Cambridge, and Bloomberg Opinion. Mohammed, fantastic to welcome you back to the program after about a month, so thanks for coming back, sir. Let's start with this 25 versus 50 debate. Are we ready for that downshift all over again?
It's a really tricky one, John. There's good arguments for both, 25 or stay at 50. There's support from data, depending on what you look at. If you want to go to the 25 camp, you look at the retail sales numbers, you look at the curve inversion. The 50, you look at the labor market, and there's downside risk to both. So it's a really interesting debate. I'm not sure there is the right answer. And then you have to factor in what the market is pricing, which is not what the Fed is telling us, and the credibility issue. I think if you put all that together, I would go personally for 50. And that's because I think inflation is going to get sticky in mid-year at around 4%. And I'd rather get the tightening out of the way now than when the economy weakens. But it's tough. It's a personal judgment. I'd go for 50.
You would typically break this down as pace versus destination. So this is about pace. Does the pace tell you anything about the ultimate destination?
It doesn't. The ultimate destination itself is a variable. The real question is, do you want to link the pace to the destination, where some people are tempted to do that? Say, go slower, but go for longer. I don't think that's a good idea. I think that if you look at the two-sided risk of that approach, I think it tilts too much on the downside.
Back in June 2022, so last summer, I remember the article you wrote in the FT, and I brought it up this morning, and the headline was The Risk of Flip-Flopping. And you wrote this: there is a danger of the classic stop-go trap that haunted many Western central banks in the 70s and 80s. Mohammed, do you think that weighs on them?
Oh, it absolutely weighs on them. Just listen to what Chair Powell says over and over again, as well as other Fed officials. It absolutely weighs. They do not want to be remembered as the central bank of the 70s that made that mistake. And that's why they are maintaining a hawkish narrative, even though the market is not listening to them. It's very strange, John. You know, I grew up when the paradigm was forward policy guidance mattered, and the markets really listened to forward policy guidance. Here we've had one federal official after the other repeat the same message. We're going to 5 and above and staying there, and the market saying, I don't care.
Do you think that's a credibility issue?
I think it is a credibility issue, and I think it is also a market conditioned by a Fed that has always tilted dovish whenever things got difficult.
Well, things are getting difficult right now, and let's think about how they're approaching it. We heard from the Fed Vice Chair yesterday, and really President Lagarde echoed what she said already. We heard this from Brainerd, we're determined to stay the course. We heard this from Lagarde, staying the course is my mantra for policy. What was interesting about the speech, if you read the body of the speech, thinking out loud was a phrase that Kit Dukes of SocGen used this morning. The body of the speech was thinking out loud about a soft landing. And there was this quote right here. It remains possible that a continued moderation in aggregate demand could facilitate continued easing in the labour market and reduction in inflation without a significant loss of employment. Now, traditionally, that's not how we think about this. Bob Michael at JP Morgan spoke to our team here at Bloomberg earlier this week, and he said the equation was simple. Inflation doesn't come down until wages do. Wages don't come down until employment rises. Unemployment rises. Unemployment doesn't rise unless we are in recession. Mohammed, which one is it?
So that's not the end of the thing, right? I mean, that's the trouble, is the debate has stopped where you stopped. And because of that, you end up by saying we cannot have financial stability in terms of inflation without high unemployment. What about labor force participation? What about better skill matching? You know, we can get there. And had the Fed started earlier, the risks would not be as high. But let's talk a little bit about what else needs to be done. This excessive focus on the Fed means that we're not looking at things on the supply side that would resolve a lot of the uncomfortable trade-offs that we're seeing on the policy front.
Something we need to discuss more, something we won't hear more of after today is Fed Speak, and that might be good news for some of you. It is the final day before the quiet period, so the Fed Speak ends today. We're going to hear from Harker. We're hearing from him right now. We're going to hear from, a little bit later, from Governor Waller, and with Michael McKee, the Kansas City Fed President. Mike McKee joins us right now. Morning, Mike.
Good morning, John, and you're right. This is the last day for Fed officials to get their thoughts on the record before they make their next move on February 1st. Pat Harker, as you noted, is speaking right now. There's a tinfoil hat kind of theory on Wall Street that Jay Powell calls these guys into his office and says, here's the message, everybody go out and give it. They don't do that. They give their own individual messages. It's just sounding coordinated these days because Harker, like everybody else, is suggesting it is time to dial back on stimulus, but not to ease the overall pressure. Here's a quote from his speech right now. I expect that we will raise rates a few more times this year, though to my mind, the days of raising them 75 basis points at a time have surely passed. And he goes on to say, at some point this year, I expect the policy rate will be restrictive enough that we will hold rates in place to let monetary policy do its work. That's a very similar message to what we heard from the Fed leadership last night. You already mentioned Lael Brainerd, also John Williams, the vice chair of the Open Market Committee and the president of the New York Fed Bank, saying much the same thing. And they used almost identical language in laying this out. While there has been progress, both said, even with recent moderation, inflation remains too high, according to Brainerd. And with inflation still high and indications of continued supply-demand imbalances, it's clear that monetary policy still has more work to do. Now, Brainerd and Harker said almost explicitly they're looking for 25 at this meeting. Enough people have said that I think you could pretty much put that in the bank. But to get back to Mohammed and what he was saying, the market's just not listening. You look at the forecast for what happens this year ahead, and even with all this Fed speak, you have not seen much change in the market's view that the Fed isn't going to get as high as it thinks it's going to get. The question then becomes, how long can they keep wherever they get to in place before they have to give in? A couple more speakers today. As you mentioned, we are going to be speaking with Esther George at the top of the next hour, and we also hear from Chris Waller of the Federal Reserve Board of Governors, who has been hawkish in the past. So I would expect much the same message.
The last word before the weekend of the quiet period. Mike McKee, wonderful. Looking forward to the conversation a little bit later as well. Don't miss Mike's interview with the president of the Kansas City Fed. That takes place at 10 a.m. Eastern Time, around about 52 minutes from now. Mohammed, I want to come back to you. There is a disagreement here, as you've indicated, between the market and the Federal Reserve communication. At the center of that, I think, is a disagreement over the way people look at the data. The Fed says they're data dependent. We need to talk about what data they're dependent on. If I look at the hard data, it's mixed. You've still got claims at 190,000. I look at the soft data, it's terrible. The ISM, manufacturing services, sub 50 in contraction. Mohammed, how much weight do you put on each?
So it's very difficult, John. It really is difficult. I think, what do we know for sure? And you should have asked Mike, why does he think the market is not listening to the Fed? Because I think Mike's insight would be really important on this. Look, what do we know for sure? We know inflation dynamics have morphed. It is no longer about food and energy. It is no longer in general about the goods sector. It's about services. And services are much less sensitive to monetary policy. That is a real issue. And that's the cost of being late, is that inflation moves to places that you cannot influence as easily. That is why we have three sets of disagreement, John. One is between the market and the Fed as to where our rates going to go and how long are they going to stay there. Second, within the Fed, yes, it's probable that we get 25 basis points, but it's not a done deal at all. There are some who favor 50. Bullet being an example. And third, within the market, when you ask people why are you pricing in cuts in the second half of the year, you get two views. You get the nice view because we'll have nice disinflation, and you get the ugly view because we're going to have a recession. So this is full of disagreement, John, because there's so many potential outcomes here.
One is positive for markets, the other one much less so. Mohammed, let's build on that. You said there were 4 risk factors a little bit earlier this week when you published for Bloomberg Opinion. Buoyant markets need to watch 4 risk factors. Which risk factor haven't you mentioned yet?
So the one that worries me, because it's low probability, high impact, as you know, is market functioning, is liquidity. And that one, thank goodness, hasn't been in play. I think the beginning of the year, and that's why I put that article out over the weekend, the beginning of the year, the market simply got too complacent about growth, inflation, and policy. They embraced a narrative which is a wonderfully comforting narrative, but a low probability narrative. And what we've seen this week is a readjustment of that narrative.
Doesn't China's reopening influence that conversation, Mohammed, and to what extent?
So you know where China's reopening influences the most, John, which is not being talked about except by 1 or 2 people, including the head of the Norwegian Central Bank Sovereign Fund, is whether that creates a leg up in goods inflation later in the year when service inflation is still an issue. For the short term, this is a very messy reopening, really messy, in terms of what's happening on the ground, COVID cases, the pressure on the health system. It's not a smooth reopening in any way. So it's not that demand is going to shoot up and everything on the supply side is going to be fixed. It's going to take a few months for that to happen.
Let's put a bow on it then. If they stopped hiking after the next meeting, do you think there's a real risk they'd have to start again in the second half?
Yes, absolutely.
That's a big problem.
Yeah, and that's why I'm in the camp of actually get more done now when the economy is still doing well. Otherwise, you may end up having to do more later when the economy is significantly weaker. And that would just repeat the mistake of 2021 and 2022. Let's not repeat that mistake.
What do you think the biggest spread is now between you? Between you and this Fed, or between you and market pricing?
That's a really good question, John. I don't think I can answer that question because I see many potential outcomes to growth. And what I do know is if I was in the Fed and I would look at my mandate and I would look at the balance of risk, I would continue hiking and I would ignore the markets for now.
Mohammed, this was great and it's been too long. Don't leave it a month again. It's too long for us. Mohammed Al-Arian there of Bloomberg Opinion and Queen's College, Cambridge, one of the very best and a good friend of this programme. Equities right now on the S&P up 0.25%. The big debate continues on Capitol Hill.
America must never default on its debt. It never has and never will.
The debt ceiling conversation up next.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Periodically, the debt ceiling has to be lifted, and it's always a rather contentious effort. In the end, I think the important thing to remember is that America must never default on its debt. It never has and never will. No, I would not be concerned about a financial crisis.
Lawmakers clashing over the terms for raising the debt ceiling, the Treasury Department tapping into special measures to avoid a default. Secretary Yellen writing in a letter to Congress, the period of time that extraordinary measures may last is subject to considerable uncertainty. I respectfully urge Congress to act promptly to protect the full faith and credit of the United States. AMH joins us now down in D.C. Morning, Anne-Marie.
Good morning, John. What we're hearing from the Senate Minority Leader Mitch McConnell maybe is alleviating some concerns, if there are any at all just yet, on Wall Street about a debt ceiling and going over that cliff. He is saying that he believes that at some point there will be a negotiation. Remember, it's important coming from him because in 2021, he was one of those main Republican, the leaders, to corral a small group to agree to lift the debt ceiling. But of course, Jonathan, we do have a split Congress, and the issues that the White House is really dealing with is what's happening in the House. And the fact that we are going to see a lot more political grandstanding on both sides before they come to an agreement on this issue.
Where is the X date, the so-called X date? How big is the window that we're talking about?
Well, I guess technically we're in it in the sense that they have to use these special accounting maneuvers, but really it's going to be the next 6 months. So over the course of the summer is when this is going to become, I mean, it feels like it's front and center because we're talking about it every day, but it's not yet. June, July, and August, it's going to get heated.
I'm looking forward to it, except I'm not. I'm not sure anyone is. Anne-Marie, thank you. I know you're not. Down in Washington, many others aren't either. Everyone I speak to in fixed income says the same thing. This again, really, let's move on. Bank of America's Michael Hartner had this to say. The U.S. hit a $31.4 trillion debt ceiling. National debt up $2 billion every day, $15 billion every week, $780 billion every year. The biggest contrarian trade of 23 is a U.S. recession, low in U.S. bond yields as markets discount fiscal policy panic and default risk. SocGen Subhadra Rajappa joins us right now. Subhadra, I want to start here, and I might move away from it quickly, but can I ask you this? Is there any reason to believe it's different this time?
Not really. As far as Congress is concerned, we've gone through this many times before. But really what's different this time as opposed to, like, say, the 2011 timeframe is that the debt markets are a lot larger. You're looking at $31 trillion in treasuries outstanding. The debt to GDP ratio is quite large at around 120%. Deficit to GDPs are also quite large. We're expecting the Treasury to start ramping up its coupon issuance as early as spring by increasing its coupon issuance sizes. And also we're at an environment where the Fed's running off its balance sheet, so the Fed's not the backstop buyer that we would have expected otherwise in other circumstances. And then you look at a foreign backdrop where Japanese investors are not buying treasuries. Treasuries don't look to attractive to foreign investors on a currency-adjusted basis. So in this sort of backdrop, I think the debt ceiling debate becomes a lot more important, and raising the debt ceiling becomes a lot more important, because you really don't want the U.S. to go into even a technical default for a short amount of time.
Especially when typically, if I ask someone what would they buy if things got messy, normally they'd just say Treasury. So we still need to make sense of that. Your 10-year Treasury right now is up 6 basis points to 346. What do you think of the factors, Subhadra, on the horizon that could drive yields much higher from here? Because we've had a big move lower from October of about 430 down to the 330s earlier this week.
So I think it's the global bond picture. Over the next month, we have the ECB as well as the Fed meetings. Like Mohammed was talking about in the earlier segment, there's no reason for the Fed not to sound hawkish going into the February meeting. I mean, the data is mixed. The employment picture is still pretty strong. Broadly speaking, inflation is still pretty high. So there's really no reason for them to not sound hawkish at the February meeting. It's the same situation, for the ECB. We've seen a sort of a wall of cash flow into the bond markets is keeping yields, very low. There's also a decline in volatility and a decline in term premium that's sort of weighing on 10-year yields right here. But broadly speaking, I think heading into the meeting, you should start to see yields rise at least modestly from here on.
We've got that this morning. Subhadra, something else Mohammed mentioned is getting down to 4 and then things getting difficult. And I think you're on the same page, that we get to the second half and things get increasingly tougher. That journey from 4 down to 2 is difficult. Is that what you're thinking too?
Yeah, no, absolutely. I think that you're looking at an inflation environment where you could see perhaps some exuberance earlier on this year because of both headline and core inflation starting to come off. But as we head into the second half and even beyond that, inflation could kind of plateau at a much higher level. Even the Fed in its own forecast has core PCE around 3.5% for this year, 2.5% for next year and beyond. So again, really the destination on inflation is what I think is important, not necessarily the journey right now.
Typically, people would get really excited about the prospect of this big bull steepener kicking in, this big rate cutting cycle starting rather, and the 2-year yield just plunging. Subhadra, I've got notes from you that basically indicate curve inversion for most of this year, the whole of this year, and most of next year as well, Subhadra. Why is that?
Because the Fed is going to keep policy restrictive for the remainder of this year. They really want to see inflation head towards its 2% target. So just getting inflation back down towards 3 or 4% is not really their endpoint. They really want to see a trajectory towards much lower inflation. In that sort of context, it makes sense for them to keep policy restrictive for the remainder of the year. That would mean that the front end of the yield curve is pegged. And if anything, you're going to see the back end yields remain relatively low as we start looking towards a potential recession or a slowdown in the coming months, and then a recession in perhaps early 2024.
Can we put a number on that back end? What are you thinking about?
We have 10-year yields at 3.25%, so not really, very far from where we are right now. The reason for why we didn't think 10-year yields would go a lot lower from there is because, one, the front end is going to be pegged to Fed expectations. The Fed's going to keep policy, somewhat restrictive. But also the global backdrop argues for much higher, bond yields and global bond yields. I mean, the Bank of Japan is adjusting its YCC ban. So broadly speaking, we're looking at a global bond picture where global bond yields are going to be a lot higher. Our call is for 10-year Treasury bond spreads to continue to narrow. We've already seen a significant amount of narrowing in that spread. That's probably going to continue. And in some respects, that's going to keep 10-year Treasury yields from declining a whole lot from here.
Interesting. Subhadra, this was great, as always. Subhadra Japa there of SocGen. Your 10-year yield this morning, yields up 7 basis points on a 10-year to about 346 on a 2-year. Let's call it 418. Yields higher there by 5 or 6 basis points on a session so far, at least. Coming up, the morning calls, and later, another round of tech layoffs, this time at Google. More on the fate of big tech with Bank of America's Jared Woodard around the opening bell.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Three-day losing streak on the S&P, trying to snap that this morning, about 5 minutes away from the opening bell. Equities up by 1/3% on the S&P, on the Nasdaq up by 3/4%. That's the price action. Let's get you some morning calls. First up, Barclays upgrading Ralph Lauren to overweight, expecting weaker FX headwinds to fuel potential upside to European sales. That stock is up by 2.4%. Cowen downgrading Salesforce to market perform, seeing elevated risk to its restructuring plan after several executive departures. That stock is softer, negative down 0.9%. And finally, Canaccord raising its Netflix price target up to $400, highlighting its better than expected subscriber numbers and strengthening original content. That stock's flying, up by almost 7% in early trading. Coming up, Google preparing to cut 6% of its global workforce. Bank of America's Jared Woodard weighing in on tech austerity. That conversation up next, your opening bell, just around the corner.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
This does not feel the back end of a shortened trading week at all, does it? We're down every single day this week so far. 3-day losing streak on the S&P 500. We're trying to bounce here, trying to snap that losing streak, up 1/3 of 1% on the S&P, and Nasdaq 100 up 0.6 of 1%. The opening bell rings, switch on the board and get to the bond market. Yields look a little something like this on a 10-year. Higher this morning by 7 basis points to 3.46 in the FX market. Euro dollar, negative 0.2 of 1% at 108.14. I have to say, President Lagarde sounded a whole lot like Vice Chair Brainerd. Staying the course is my mantra for policy. 24 hours after hearing Vice Chair Brainerd say we're determined to stay the course. Crude earlier had a look at 81, back down to about $80.72 on WTI. We're positive there 0.5 of 1%. About 20 seconds into the session, equities look like this on the S&P 500, positive 1/3 on the Nasdaq, up 0.6 of 1%. One stock to watch at the open, Netflix, absolutely crushing subscriber estimates with more than 7 million additions in the fourth quarter, plus a big change in the C-suite. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, John. We're up around 6% on the stock, biggest jump since November. I'd love to say that, you know, the street, the analysts and all the investors are kind of digging deep into what the Reed Hastings move upstairs means, but I think they're probably zeroed in on the subscriber beat for the last 3 months of 2022. 7.7 million subscribers added above the estimate of 4.5 million, which also Netflix was guiding to. There was some limited discussion on the call and in the earnings statement about the impact of the ad-supported tier. Netflix said that they were seeing progress in it, and actually there is some evidence that cost-conscious consumers were lured in by the ad-supported tier, which could have been of benefit or additive to that 7.7 new subscribers add. And a lot of the sell-siders who are responding positively this morning flagged that. On the change-up, look, Greg Peters moves from COO to co-CEO. He has already been the face and leader of this ad-supported tier move. He has been the guy that's also been cracking down on password sharing, something that Netflix has been discussing and will now start charging for password sharing, which could be supportive for revenues this year, according to the street. Otherwise, Reed Hastings remains in the executive chair role. Ted Sarandos already really focuses on Hollywood, really focuses on content, but there was another promotion in Bella Bajaria, who jumps from global head of TV to chief content officer. Overall, given a lot of the challenges this industry is facing, Netflix seems well positioned, and they pledge to get their profitability sorted in 2023.
Ed, why is it so difficult to guess subs? The difference between the number and the estimate is like this wide, off the screen wide.
Yes. I don't want to get myself in trouble, Jonathan, but I'm pretty sure that Netflix guided quite conservatively. They have a history of guiding quite conservatively.
Sure.
And remember, they're going to suspend guidance going forward anyway. I think what was interesting from the earnings call is we're not going to get a number going forward anymore, right, which will do away with this whole problem. But they did give some sort of commentary around how actually first quarter will be a little bit softer than fourth quarter of 22. Second quarter might start to see improvements, etc. So we're not going to get that full forecast, but we will get a few clues as to what's going on. And either way, they seem committed to content. They seem committed to growth globally, and not just here in North America, but think about Latin America, Asia Pacific as well.
And thank you. Stocks up about 5 or 6% in early trading, 3 minutes into the session. For those of you with a Bloomberg, pull up Netflix and then just quickly type ERN, go, and it will give you the surprise screen for earnings for Netflix. If you don't have access, I can just share you what I see. If you look at the price change after earnings, so up about 6% right now. The previous 4 earnings releases, the stock was up 13, up 7, down 35, and down about 22%. So that gives you an idea of how wild post-earnings Netflix price action turns out to be. Another day and another round of layoffs we need to discuss. Google announcing plans to cut 6% of its global workforce, roughly 12,000 jobs. In an email to his employees, the CEO, echoing many of his tech counterparts, writing the following: I take full responsibility for the decisions that led us here. Kelly Lyons, how many times have we heard that over the last few months?
So many, John. Alphabet is just the latest in a long list of tech companies announcing that they are pulling back on their workforce after expanding it so rapidly over the last several years over the course of the pandemic. Of course, that was boom times for big tech. We are not living in boom times anymore, which is why Alphabet is announcing the 6% cut, as you mentioned. That affects globally their workforce across all different segments of its business. Those laid off here in the U.S. will get at least 16-week severance as well as healthcare benefits for 6 months. But really, this is about the weaker macroeconomic environment that Alphabet is facing. It has dealt with the slowdown in its digital advertising business as well as its cloud computing division that is still behind Amazon and Microsoft, and its sales growth has been slowing for 5 consecutive quarters. It was just 6% last quarter. And of course, we're going to get the latest figures from the company when it reports on February 2nd. Our analysts here at Bloomberg Intelligence do say that the layoffs announced today could help offset some of the headwinds the company is facing and aid operating profit this year, help drive faster profitability in its cloud business especially, which is where the bulk of the headcount growth over the last 2 years came from. But Alphabet, as we started talking about, John, is not unique in this and trying to rein in costs as the economic winds have shifted. This is a familiar story that we've already heard just this week. Microsoft cutting 5% of its workforce, an announcement just days ago. Amazon began laying off 18,000 people. Salesforce, Twitter, Meta, the list goes on. All of these companies recalibrating their cost base because the reality just looks very different than what they've experienced over the last several years, John.
The stock right now up 2.6%. It's a major change, Kaylee. Thank you. The C-suite in Silicon Valley taking full responsibility for the recent tech austerity. Salesforce CEO Mark Benioff has said this: we hired too many people. I take responsibility for that. We heard this from Google's leader. We hired for a different economic reality. I take full responsibility. Amazon, we've hired rapidly over the last several years. The CEOs owning their missteps, bracing for a bit of a slowdown. Mandeep Singh of Bloomberg Intelligence joins us right now. Mandeep, you and I had this conversation earlier this morning. Let's explore it further. What is this new era? We've talked about the end of an era. What's this one?
Well, first of all, we're going to look back at this post-pandemic period, and really, I think the way these companies hire their, employees in terms of expanding their employee headcount, this is going to go down as one of those phases where really these companies, I think, acted to an extent irresponsibly in terms of expanding their footprint. Yes, you can expect a lot of leverage from these businesses, but companies of this size, growing employee headcount 20-30% every year, this is an anomaly, and we're not going to see this again anytime soon. But look, I think in terms of right-sizing the business, this is just a first round of layoffs. Guess what? If you're going to see competitive pressure on some of these companies, and I'm not saying it's going to happen to every large tech companies, but some of these companies may have to do an additional round of layoff if they find themselves to be in a weak competitive position going forward.
Mandeep, what kind of time frame are you thinking about?
Well, so again, no one knows the extent of this downturn. There is a cyclical element to it. My sense is, the digital ad companies, especially I think Alphabet is in a strong position still. The revenue base is diversified, and they have to fix the cloud profitability, which I think they're trying to do here. Meta, nobody knows what the outlook is going to be going forward, for just the way it was growing before. Can it keep growing? I don't think so, because they're losing, impressions and time spent on their platform. And that is where, yes, they have done a 13% layoff, but guess what? It may not be enough, because it's not going to fix all their profitability issues. And, right now they're investing in Reality Labs, which is 2% of their revenue, but makes up 20% of their headcount. Same thing for Alphabet. Cloud is like 10% of their revenue, 30% of their headcount. At some point, they will have to right-size all these segments that are not making money.
Huge cuts, austerity hitting Silicon Valley in a major way. Mandeep Singh, Mandeep, love it. Great to catch up, as always. Bank of America's Jared Woodard looking for opportunities outside of big tech. He wrote the following: we see more risk ahead for these $70 trillion of tech growth and debt assets that proliferated over the last 20 years. We favor equally weighted equity indexes over market cap weighted indexes and favor small cap value stocks versus large cap growth. Jared Woodard, I'm pleased to say, joins us right now. And Jared, you also prefer the rest of the world over the United States. So can we start there? Why the rest of the world?
Well, John, when you think about the big equity indexes, you think about where they're concentrated and what the big risks are that they face in a world of higher interest rates, potentially higher trend inflation, big macro pressures. That's not a world in which very expensive growth stocks tend to thrive. And unfortunately, that's still the best way to describe the S&P 500. The rest of the world is exposed to other things, other risks, but not the kinds of risks that we think are going to be as urgent this year. And so whether it's emerging markets, especially outside of China, from a financial investment point of view. Even Europe, even Japan face some meaningful risks, but they don't have the kind of valuation pressure that is still, I think, a big headwind for large cap U.S. equities.
Jared, 3 words outside of China. I heard those 3 words louder than anything else you said. Jared, we've come into a new year. China's ripped. Everyone's getting on board. And you just said outside of China. Jared, why is that?
I think that the most important message is that you can have exposure to the Chinese economy and to the benefits of Chinese economic reopening without already owning Chinese financial assets. I think this is especially important for dollar denominated and U.S.-based investors. Of course, you want to have exposure to the world's largest economies and to those benefits, but it doesn't have to be within Chinese financial markets, because look, a lot of the risk factors that were on people's minds so much in 2021 and even last year around accounting and transparency, good governance, never mind some of the other risks that people have known about for years. These are still live issues that haven't been resolved. You see bipartisan now support for a kind of a disentangling, both on technology and even wider economic applications between the United States and China. And so I think it's worth having exposure, but doing it in parts of the world that benefit in a major way, but without the same risks.
2 obvious places to look. One's EM, the other's Europe. Can we talk about Europe? Europe has ripped so hard off the lows of last year, and it's had a tidy rally as well to start the year too. Can we talk about Europe and whether it's just lucky with the weather and it's a trade, or whether there's something here a little bit longer term?
I think it's a tactically, even for 2023, a good trade. For the longer term, the same issues around, plunging, adverse demographics, lackluster productivity, the absence really of the kind of technology that can be transformative. Some of the big risks structurally haven't been resolved in Europe, haven't been resolved in Japan, and so I think you have to be nimble.
They're victims of bad energy policy. Most people would say that. Jared, bad energy policy has been good for energy equities over the last couple of years. And Jared, you haven't given up on that trade. Why is that?
Look, think about this image. It was in the press a lot last year of that wind farm in Germany that had to be destroyed because they needed to get access to the coal underneath. Okay, the fact remains that you have to walk before you can run, and unfortunately, it looks like some parts of the world have made big investments in the interest of running from an energy policy point of view, but without secure resources to get them to that future. In the sectors that make it possible, whether it's oil and gas or I think nuclear power or midstream service companies, there's a lot of places to invest these days. But we think that natural resources, doesn't matter what your politics are or what your policy preferences, you're going to need copious quantities of raw materials, mined and otherwise, to make the future happen, whether you're on the left, right, or center. And those things are still undervalued in the marketplace today. Look, energy and materials, throw in some industrials, and you had basically half of the equity market for much of the 20th century. Today, those sectors account for like 10 to 15% of equities. And we think that there's some mean reversion from a structural point of view higher that has to happen. You have to recapitalize those sectors if you're going to have an efficient, productive economy.
Hey, Jared, this was thoughtful stuff. I appreciate it. Jared Woodard there of Bank of America. We are about 12 or 13 minutes into the session. Equities are positive 0.2%. I mentioned EM, emerging market assets recording their best start to the year since the 1990s.
I think China is quite pivotal. So that's the one we're watching. That's what we're focused on this year, that will allow EM to possibly outperform developed markets.
A conversation you do not want to miss coming up next with Robert Koenigsberger of Gramercy Funds. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean
What does it mean? What does it mean? What does it mean? What does it mean? It means they have a Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Emerging markets.
Long emerging markets.
The U.S. is not the only market in the world.
We're in the start of a dollar downtrend.
The emerging markets benefit from the weaker dollar.
China is quite pivotal.
Emerging markets assets are cheap, right? They had a very bad year last year.
There are some juicy yields to be had.
And they offer carry.
There's a great confidence around the outlook now.
You kind of can't fight that carry.
Emerging markets kicking off the year strong. Sovereign bond sales seeing the best start in a decade. A weaker dollar, China's reopening, fueling demand as borrowers welcome the lower costs. Gramercy funds calling for significant upside in the next 12 to 24 months. The firm remaining constructive in its Q1 outlook, expecting the destination to be worth the volatility. I'm very pleased to say that joining us now is Gramercy's Robert Koenigsberger. Robert, great to catch up with you, sir. It's been a while. A lot of people are outside of this trade wondering if they should chase it. You're in it already and have been riding this wave for the long time. So let's start there. You've got a different decision to make. Do you stay in it? If you choose to trim some of the winners, how do you redeploy that capital?
That's right. Good morning, and thanks for having me again today. So look, I think there's a tension between FOMO, fear of missing out, and also climbing the wall of worry. And, I think we've got to go back and look historically at the dislocations that we've seen in emerging markets and see some of the returns that have come out of those. And, over the last 25 years, we've had like 11 of them. The peak to trough is down like 20%. The recovery takes about 8 months, and it's typically been like 27%. And then 12 to 24 months over that, after that, you see very strong returns, like 30 to 50%. So from a historical perspective, I think it's hard to stay out here. Now, one of the themes that we vetted in our top down this year is volatility. And, we expect there'll be volatility due to liquidity, due to policy uncertainty, due to supply and what have you. So that's where, Jonathan, we've talked in the past about having the ability to be tactical and to be able to move around, not only from a top-down perspective, but from a bottoms-up perspective.
Can we factor in China as well, Robert, just to jump in? Because China's reopening story has poured gasoline on all of this as well. Can you tell me about how you think the characteristics of China's reopening might be different to what we experienced in the West and what that tells you about where you want to be off the back of this?
Sure. I mean, I think, and I think we talked about China in the past. A lot of the focus was around the property sector, and the property sector, I mentioned it because it's like 25% of the GDP. And I think a lot of the concerns around China and what they may or may not do in 23 were perhaps alleviated a bit in the fourth quarter of 22, when I think they acquiesced, they blinked, the support program that's gone to the property sector to support the economy gives you a sense that that China, the China sovereign is behind it. I'm still of the camp that there's still a lot of pent up demand in China, demand to get outside of China to travel and what have you. So I think we're going to see tailwinds from China in the reversal of COVID.
Let's say you were smart, like you guys were, and you picked up the debt of a Chinese developer at 7-8 cents on the dollar, and that's back to about 70. Robert, do you stick with that?
Yeah, that's a great question. And so it's a perfect example, Jonathan, of being able to be dynamic. So for us, we picked about 4 different baskets of Chinese property developers. The first one you mentioned, if you take something like Country Garden, it was trading around 7 or 8 cents. It is trading around 70. The asymmetry has gone the other direction. But interestingly, the second tier, third tier companies that are going to restructure, and part of what kind of announced in the fourth quarter is kind of the green light to restructure, they're still trading at like 10 and 20 cents. So, that's the opportunity to be dynamic, to move from the 70-cent security down to the 13-cent security.
You said they blinked. Can we just build on that? Because it's only a year or so ago people said China was uninvestable. Why do you think they've blinked? Why are you so convinced that this is a policy shift that is sustainable?
Yeah, and I'm not going to say that broadly about Chinese investing, and I agree with your previous guest that you don't always have to get exposure to China through the local market. But when I say they blinked, we have to go back to the Evergrande crisis. If you remember, everyone was worried, is Evergrande going to be the Lehman of China? And what I think the Chinese government attempted to do was isolate Evergrande and then insulate the rest of the sector. But the entire sector was trading at 5-10 cents. The sector was frozen. This is 25% plus of the GDP. So when they blink, I talk about, the massive amount of support, and one could even argue was the equivalent of a Chinese TARP program in order to support this sector.
Robert, what was impressive about you guys last year is what you chose not to be invested in. You went into the year without Russia, without exposure to that story. It wasn't like you had to race to cut exposure. You did it ahead of time. Can you tell me whether that was your best decision, what not to own, as opposed to what to own?
Look, and I think that takes you into the whole debate about, passive versus active management. And, I think over the past, 5-10 years, passive and beta has been easier to hold on to. But your example of Russia and Ukraine is a great example. I think it exposed people to losses, I think maybe 800 basis points of loss, just because it was in the index. And one of the problems of when something's in the index, it's risky not to own it, right? I hear managers say all the time, well, we have no risk because we're flat to the index. It reminds me when we started Gramercy back in the late 90s, and the JP Morgan Emerging Market Bond Index had an 18% weighting to Argentina. It wasn't, whether you owned it or didn't own it was a huge thing. So yeah, I think 2022 was a big part about not only what you owned, but what you didn't own.
Well, let's build on that. There is this phrase that you've used, this paradigm of non-payment in high yield, sovereign high yield. Robert, where do you think that's going to show up this year?
Yeah, Mohammed and I and the team in 2020, as we huddled up around COVID and all the implications, one of the themes that we identified was this notion of a paradigm of non-payment, and that there would be certain sovereigns that would have adverse effects because of COVID, and we've seen this great balance sheet transfer, resource transfer from sovereign balance sheets to corporate balance sheets. And we thought that would play out, quite frankly, earlier, 20 and 21. And it did to a bit in Argentina and Ecuador and what have you. But remember, there was a tremendous amount of global liquidity in 20 and 21 as well. So what we saw in 2022 is this paradigm of non-payment starting to play out. Places like Sri Lanka and Ghana and what have you. And these stressed sovereign balance sheets not having access to the capital markets. So that's created actual default, and securities have gone down and traded like default. So we believe 2023 could be the year where investing in the recovery of this paradigm of non-payment could be important.
This is fascinating stuff, deeply thoughtful. Enjoyed the outlook too. Robert, let's do this again soon. Robert Königsberger there of Gramercy Funds.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Equities up just a little bit, much more so on the Nasdaq. Let's get you the trading diary. Coming up, existing home sales at the top of the hour. Fed Governor Chris Waller speaking at 1 p.m. Eastern, followed by President Biden at 2 p.m. Look out next week, US PMIs on Tuesday, along with earnings from Microsoft, followed by Tesla on Wednesday. Fourth quarter GDP on Thursday, and another read of the US economy to round out the week. From New York, that's it for this week. Enjoy the weekend. From New York, this was the countdown to the open. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Vayner Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not. I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. Asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Investors all over social media use the free trade